Welcome, everybody. It's really great to see you all here today at the Project A Knowledge Conference 2023. And I want to start with the motto, Beyond the Obvious. What a stupid motto for a conference. That makes absolutely no sense. We know that if you want to be smart, well, you have to learn. If you want to be healthy, you have to eat your vegetables, you have to do sports. If somebody promised you something else, I would be very skeptic about that. If you want to earn a lot of money, if you want to get really rich, most likely you will have to work a lot and get your hands dirty. And that's just how it is. And still in 2022, we were silly enough to have as a conference motto, Beyond the Obvious. And I feel a little bit sorry for that. And we got a lot of comments on that from all the speakers last year. Rightfully so. This year, we spent a lot of money on a new motto and a new design to come up with something fundamentally new. This year, the motto is The Obvious. And that is what we want to talk about today. Before we get into that, PACON23 is the hashtag, and you're kindly not only allowed but requested to take a lot of photos, videos, and post on the social media of your choice. And I hope you enjoy that. So what is it about the obvious, and why don't we more often do what's obvious? Well, if we look at companies that we work with, sometimes it feels as if we don't see the forest for the trees. The things are obvious, but something makes us not do stuff. Some couple of obvious things that we see a lot in our industry. Product market fit. Companies don't have product market fit, but somehow they still spend a lot of money on marketing, and they try to push it, and they wonder why the companies are, why customers are not buying their product, but they don't fix that. They try to push it. Sales. A lot of companies come to the point where they see that their product just doesn't sell itself. You actually need somebody to do that. You might need a CRM, you might need actual people to do sales, you might need a process, might need revenue operations, etc. And I don't know, they don't want to do that because they just imagined it in a different way. Funding, big topic of the last years, like after the big party was over and when every company was getting funding easily all the time. But at some point, it became really crucial to make sure that you always have the money to run your operations. But then you have all your operations and there's so much to do, and you probably here and there forget that you need funding. Diversity, very interesting topic in the context of the obvious, because I thought we had agreed that diversity is something that we need for a lot of reasons, but one aspect here is clearly that it makes companies more successful. And here we are in a crisis, and you would be surprised how often we see that companies say, oh, this is a luxury. This is something that we can do when we have the time, the money, blah, blah, blah. But when things get really rough, diversity comes second. It's not. It's an obvious aspect of making a company successful. Brand. Big aspect of, or a big part of what startups are in our times is B2B companies. So here you are, you're a startup, nobody knows you, your solution is not proven, you didn't sell it yet to I don't know how many companies, so you don't have all the legacy and all the reference cases and all that, and you try to convince companies to buy your solution, right? And the buyer is in a big risk, right? They buy something that nobody has bought before. And you might, you don't need to spend millions, but you need to think about your brand. How do you position yourselves? Seems obvious. Surprising how many companies are actually not doing that. Understand your data. Similar to diversity, seems that when things get rough, a lot of companies treat that as a luxury, but it's just not. You will need to understand your data in order to be successful. And AI, that's actually, in my opinion, the funniest of it all, is that in 2023, still a lot of people and a lot of companies, as obvious as it is, seem to believe they can do without it, sneak around. And an interesting, understandable, but interesting aspect here is that it's very often people who are the most affected by AI, who should actually embrace it and work with it, are the most pushing back on that. And it's probably out of a certain level of fear because they believe that, well, it might kill their job. But it probably will kill their job if they don't embrace it and start to work with it. There's a second aspect to why the obvious is not picked up easily, in my opinion. And that is, we have this idea that things sometimes have to be complicated. They have to be beyond the obvious in order to be really true and valuable. And the question is, isn't it more important for success to keep things really simple or simple stupid? The KISS principle. There is this saying that probably some of us have heard before. For every complex problem, there is a solution that is simple, neat, and wrong. And that puts a lot of skepticism to everything that is just too simple. But then there are those who just go for the very simple, for the very obvious. And they're very successful with that. Tabloids, right? And if you go for these very simple in-the-face messages that everybody understands, as wrong as they might be, that can give you success. You might even be able to make people believe in werewolves. I'm not saying this is a positive example. What I'm saying is that might help with the success. Might be a bad thing. But I believe there are also positive examples. I don't know how many of you are old enough to know how search engines looked before Google came and just made it simple. But it was really like all over the place with complicated catalogs to drill down, and you had to search on the search engine in order to find what you were actually searching for. And then those folks came and just made it very simple and obvious. I mean, you're searching for something, here's your field, enter your, and there you go. And that doesn't mean that it's a super simple solution or that there's nothing in it and that there's no value. But for the customer, it's simple and obvious. So my recommendation here is if you build products, make them so obvious that my mom would understand. That is my mom. Her name is Gisela. She's 80-something years old. And she's really smart. But she's also very old. And she is not a digital native. So she's probably watching the session now on YouTube. So hi, Mom. But I very often do the test with her when I'm testing something like this very presentation. I'm testing it with her. And that doesn't mean that you don't take your audience or your customers serious, that you don't solve a problem. I think the most complex problems can be made simple for your customer or for your audience, and then it should actually work. And if you struggle with that, that might be an indication that your solution is not yet where it could or should be. A third aspect why we are not going for the obvious might be that sometimes we just don't want to see it. We're sitting there and everything's just fine, right? And there are just certain beliefs that we just want to have. Dependency on Russian energy. I mean, for how long did we have that? And yeah, we'll be okay somehow. Obviously a bad idea. Dependency on Chinese supply chain, bad idea. Dependency on semiconductors from outside Europe, from countries you don't know how stable, how long they will be, and no matter if you like them or not, but you know, it's not good to have such a dependency. Bad idea. Dependency on military protection by whoever in the world. Bad idea. Dependency on fossil fuels. Bad idea. All these ideas are obviously bad, but still we are sitting there. I mean, now it has a little bit started, but for a long time we're sitting there, just like living with it and just thought, we'll be fine. Because we always believe there will be some way out, there will be something, some magic solution, some silver bullet, we will just, you know, develop something that will get us easily out and then everything will be okay. But it's just not. We have to address these topics. That's why today we will talk about a few obvious things. We will talk a lot about ESG, about resilience tech, about automation, diversity, no-code, a lot about people and compensation, because without people and compensating them in a way that they come and work with us on the solutions for tomorrow, we will not have them. And I mean, we are usually not dealing with businesses and companies where it's all about like a big warehouse with a lot of raw materials or so, but it's more about people building something. And education as a path to the future and building up entrepreneurs of tomorrow. Obviously, AI will be one of the major topics of the day, and you will see a lot of talks on that particular topic. We will start now with the topic people and compensation. And for that, ESOP is a big, big topic. And the first talk here today, the first session, will be the initiative ESOP ASAP. And that, for a change, is a really good idea. And that's why I'm very happy to welcome Christian Miele, General Partner from Headline Ventures, and also the head of the German Startup Association, together with Johannes Janning from WIPOC, one of the partners of Project A Knowledge Conference, partner there, who will together talk about ESOP ASAP. Welcome.
Wow, Christian, great to have you here. Great to be with you. Before we dive into the topic of ESOP ASAP, I want to start a bit more generally. In your position as president of the German Startup Association, you speak quite frequently with politicians about all matters pertaining to the startup community. How is that? Do they understand the startup community in Germany? Do they speak our language?
So first of all, thank you very much, Project A, for hosting this conference. It's great to be on stage here. And yeah, so to answer your question, I think that over the last years, the dialogue has changed to the positive, I would say, which is also due to the efforts of everyone probably in this room. I think for the first time as a startup scene, as the startup community, we have been standing together very closely and voicing our opinions, voicing our demands, and this has significantly improved. So when I look back on like my first weeks and months in this role as the chairman of the Startup Association, I would say it was still a different time. And then today, it's quite, it's quite good. And of course it could be better, and we always want more. But for the moment, I do think that our voices got heard.
And would you say that unity of the community is key, sort of, getting together behind the Startup Association?
It's the number one ingredient, in my opinion, why our work has been successful. Because I think that if we would not stand together as a group, and if we would not join forces, it would be too easy for the politicians to say that these are like really individual requests that are being made here. And if you make the counter argument, by joining forces, by making sure that we tell the politicians the same things, no matter if Uwe Horstmann is sitting at a dinner with the politician, or if I'm sitting at a dinner with the politician, or you, and we are saying the same things, then we get hurt. Because I think it creates a lot of authenticity in a way that, we are not asking for stupid things as you had on this chart. Like there was this like good idea. So we had good ideas and we were all saying the same things. And I think this has helped tremendously.
Great. Turning to ESOP ASAP, maybe starting with quite an obvious question or more general question. I mean, you are a partner at Headline, you do a lot of investments in startups. Why are employee incentive schemes so important for startups? And
I mean, as Rainer said during his introduction, and I think that it's great that we are talking about people and compensation first. At the core of everything we do in venture capital or startups, it is about the people. And if we are just making a very blunt and rational analysis of the attractiveness of the German startup ecosystem compared to other startup ecosystems in the world, it is not difficult to find out that Germany is behind other ecosystems in this regard when we are talking ESOP. So when we have identified this, it was crystal clear to us that we need to identify a very clear language and articulate very clearly why we need stock options to incentivize talent from all over the world, but also from Germany, to join a startup and to use ESOP as part of the compensation. So it was just so clear that with this tool, we would enable and unleash a totally different way of looking at talent in this country.
Interesting. So today you're not just in Berlin for the Packon, but you're also here to go to the Finance Caucus of the German Bundestag to speak as an expert in your role as president of the German Startup Association. You had a very successful campaign with ESOP ASAP. Walk us through how we got to today, to sitting in front of the Finance Caucus with legislation on the table. What were the steps you took as an...
So it was it is really like almost a 4-year process now. But if we go back to the beginnings, it was really like a small group of representatives of this startup ecosystem who were sitting together, including probably many people from this room, who argued about the most important things that we need to do. And we came up with this idea that, first of all, let's focus on stock options. Let's make this one of the major topics we want to fight for. And how do we best tackle it? And the idea that we had originally was, maybe we as the Startup Association, we're not important enough and not relevant enough, and maybe our voices are not being heard. So let's join forces with some people where we can certainly claim that we are working together with the best of the best, which is why we have joined forces with the Boston Consulting Group back in the days to work on a great report on the ESOP in the German startup ecosystem. And sorry for saying that, we also work together with Hengeler Müller as a fantastic law firm.
That's fine.
And together with Hengeler and BCG, we made sure that we would have the intellectual foundation of stock options available, so that if we approached politicians, nobody could tell us, hey guys, this is not really bulletproof, but we were bulletproof. And with this, we would start initiating a campaign, as you said, involving many people in this room to post on social media, involve the press, and just increase the pressure. And I think really one of the key ingredients was that a lot of representatives from the startup ecosystem would sit at lunches or dinners or hearings, wherever, and they would say the same things and would really repeat the messages. And if you take this intellectual foundation from 2020 until today, this has led us to really create new laws and make proposals on how we should deal with stock options going forward. And this is why I will be at the hearing later today.
So you mentioned sort of putting pressure on the politics. Was that for you like a first thing, or did you sort of take from business context or experience from other areas? I mean, to me that's a very interesting point, right? Putting pressure on a politician as a head of the startup association and as an ecosystem as a whole. It sounds pretty difficult.
I mean, look, I am not a politician. The only thing that I always, when I'm alone in a room, the only thing I care about is making progress as an ecosystem. That's the only thing that matters to me. And I think I'm in a great position in that regard, because I'm not dependent upon politicians liking me. That doesn't mean that I'm trying to be an asshole on purpose, but I think that over the years we have learned different styles. And I would say, and I've did this like 2 times now. It's like the terms at the Startup Association are 2 years and 2 years. So I'm in my 4th year now, and I would say that in the first half of my of me like running the Startup Association, we've been a lot more aggressive, and we've been proving that we can put pressure on politicians. And yes, the sad truth is a lot of that is related to media. I very well remember a few situations where it wasn't moving fast enough, and then we would call up the ministries and the ministers and said, hey, we need to be faster, this is too slow. And then they will always tell, yeah, we're working on this and we are figuring out the details, but we need to do this and we need to do that. And to be frank, like, I don't care. Like, make sure this gets done. And sometimes we had to create like really noisy and loud campaigns to put pressure on these guys to really execute. And in the second half of my term, I think we have changed the style a little bit, because we proved that in case we want to be loud, we can. Like we can create pressure. So if we call you, let's talk. I mean, nobody's interested in creating noise just for the purpose of creating noise. But we want to make progress. So pick up the phone and let's work on this. And I think these 2 styles, they have advantages and disadvantages. But for now, I'm quite happy and looking forward to see what's going to happen with this Zukunftsfinanzierungsgesetz.
Yeah, you mentioning the Future Financing Act, which is on the table right now, the government proposal, which is, I think, largely, we can agree on that, considered to be a vast improvement for employee incentive schemes in Germany, especially from a tax perspective. Do you think we're there? Or do you think there's still things to be changed? I mean, today there's a hearing, so there might still be room for change.
So I would say that, either you hit or you don't. And there's a slight risk that this reform is going to end nowhere if there are not like very small technical twists and changes being made. So in one regard, we are almost there, but there's still a risk that this is not going to be successful. So that is why we are putting a ton of pressure to explain to the ministries and to the responsible politicians why we need to make these changes, and I'm very happy to talk about this in a little bit more detail. But I think the overall summary is we've made great advancements, great progress. Like the campaigns have been highly successful, but now in order to really make this an amazing reform, there's still like one very small element that we need to fix.
Yeah. I mean, don't want to go too much into detail. What we currently have on the market is, as we all know, virtual employee incentive schemes, ESOPs, which are essentially nothing else than a bonus program, right? I mean, it's wage tax, it's not very tax attractive. What the Future Financing Act changes is actual shares or actual participation in the company can be achieved without dry taxation issues, which sort of was always the underlying problem. Now, if the Future Financing Act comes, what does that mean for cap table? Will we see hundreds of employees now as actual shareholders and exploding cap tables? Or are there other solutions how this will be dealt with?
No, we will not have hundreds of employees in the cap table. I think, and this is something, luckily, which also the ministries understood from the very beginning, that we are talking about compensation here. So how is this going to be fixed going forward? There will be one more line item on a cap table, which is going to be the employee entity, and all of the employees will be shareholders of this employee entity, if you wish. And that's as close as it can get to real ownership in these companies. And much more security, much more advantages towards virtual stock option programs, which are today still like 80% of all option programs in Germany.
So it's a pooling vehicle, which I find quite interesting, right? Because I mean, what we as WIPOC are seeing more and more in the market is growing cap tables, because there's more business angels investing in rounds. So new pooling vehicles started, coming in, trust vehicles. I mean, we've always had sort of voting pools, but I think it will be very interesting also for the cap table dynamic, and might even lead to cleaner cap tables in the future, which I think is sort of in the interest of everybody, because German corporate governance tends to be quite strenuous.
Yeah, no, I agree, absolutely.
So now that ESOP SAP is hopefully close to an end, and everybody, I think, keeps their thumbs pressed for the hearing today, what's the next big thing? What's the next big thing we have to tackle as a startup community?
I think that there are a few things. I mean, first of all, we will actually now we're working on the succession in the Startup Association. So I'm not setting the agenda for the next term, but I think that there are a few things where everyone will agree that this is crucial for the success of the startup ecosystem long term. And this is all about like, how can we make sure that Germany is a really attractive place for talent to come here and to join the startup world. Secondly, it's still about financing options. Like, how can we make sure that there's enough capital available in all stages? In Germany, I would say that this capital crunch is still pretty much in the later stages as of today, and we are very dependent upon foreign forces of capital. Thirdly, it's for sure around competition. I mean, just yesterday, Thierry Breton has again like emphasized the importance of the Digital Services Act, and so there are elements of talent, financing, and competition that probably will still dominate the headlines within the startup scene. And then there are a lot of other important topics that Rainer also had on his chart that we as a startup ecosystem need to take care of long term. But I mean, my personal realization was that you have to focus, and you have to make sure that you don't work on too many things at the same time, but step by step.
Yeah. No, interesting. I mean, you mentioned that you will pass on the baton soon to Verena Pauster. Just very briefly to end the session, what was your highlight during your time?
My personal highlight, and this has never changed since the beginning, was that we as an ecosystem were standing together. I mean, the kind of support that I got from everyone, and the honest intention to do something good for our ecosystem as a team, beyond the firms that we are working with, right? That was amazing, and I will be eternally grateful for that. It was just, I think it's very unique. If you think about it, which other industry has done something like that before, where everyone is joining forces and everyone is trying to do something good together? I've very rarely seen something like that, and that will always stay with me. And that was always my greatest motivation when I see that we are all doing this as a team, as friends, and trying to push it forward. So that was kind of flattering in many ways.
Sounds great. So I guess everybody in the audience who's not a member should become a member.
Absolutely.
To support you, right? Well, Christian, thanks a lot for stopping by on such an important day. I think, like I said before, everybody's thumbs are pressed, and I think this is your applause from PACON 2023 for all that you've done for ESOP SAP.
Thank you very much.
Hello, so the next talk is about automation by Jana and her partner in crime, the co-founder of Merantix. Oh, AI, I'm sorry. But before we go into the talk, I actually wanted to congratulate Jana because she basically turned 33 on Sunday. So, so happy birthday. We got some flowers for you and a gift. And all the best for the talk, and please enjoy the talk about AI.
Thank you so much. Thank you. Should I now hold him for a session? Thank you. All right. Welcome, everyone. Thank you for the birthday wishes. This is not embarrassing at all. I'm super happy to see so many faces here. We are talking about a very exciting topic about technology in a few seconds that is currently shaping our business world and future. But before we jump into this topic, let me quickly introduce myself. So I'm Jana. I'm not 33. I'm a little bit younger, but getting there soon. I am head of demand generation at Project A, and today I'm the host of this session. And to quickly introduce or let you know what our head of demand generation at Project A is doing. Basically, on a daily basis, I am supporting our portfolio companies in various business areas, different kind of growth stages, various of industries, especially in the fields of demand generation, surprise, which is B2B marketing, growth topics in general, engagement, and MarTech automation. So you can say, like, basically marketing is my topic, but today, as in the role of the host of the session today, I'm talking about generative AI trends in 2024. And I'm very happy that I'm not alone on this stage and have with me a true industry expert. And let me quickly introduce my my guest, or my co-speaker. He studied computer science in Oxford, Princeton, and ETH Zurich. He obtained a PhD in computer vision and deep learning. He founded Merantix, which is the world's leading AI investment platform. And in my opinion, he is definitely the voice and go-to person in Europe when it comes to AI. So I'm truly impressed by this vita, and I'm super happy to share a stage with him today. So please a warm applause for Dr. Rasmus Rothe.
Hello. And happy birthday. Happy birthday.
Thanks, Rasmus. So how are you?
Good. Excited for the session.
Great.
Let's get started.
Great. Let's get started. So maybe quickly introduce yourself in your own words, because I think like probably I missed half of it.
Sure, I keep it super short. I'm Rasmus, co-founder of Merantix. We build and invest in AI companies. We've done a lot of AI incubations in healthcare, biotech, manufacturing. We also built more customized AI solutions. Paul is here running the professional services organization. And we also operate the AI campus here in Berlin, a co-working space hosting actually now 270 events on AI just this year. So if you're in Berlin, if you're interested in AI, come by our AI campus. We'd love to show you around and interact with you there. And excited for the session. Let's get started.
Okay, let's get started. Thanks, Rasmus. Okay, short introduction to our topic. We have the title here, Embrace the Obvious, 3 Unstoppable Trends in Generative AI in 2024 is the title. We predict for you 3 trends where we think which impacts our business world in the future. And pioneers, for example, like OpenAI, they really pushed us into this new area where AI models become sophisticated and more capable than ever. And among all of these, there is like this one thing, generative AI, which stands out. And why should we care about it? Why should we care about it? Yeah, basically it's like very easy. Generative AI is bridging the gap between needs and solutions, between products and customers, and between challenges and resolutions. And with that being said, I would say also, sorry, we have some figures here that prove us right. So the generative AI market in 2023 is worth $40 billion US. And by 2025, we can expect like an increase to $88 billion US. When you're now looking at generative AI adoption at the moment, we can see already in our workplace that there's adoption of 23%, which also will increase and will like be expected by a large-scale adoption in 2025 by 46% in our daily work life. And then now, of course, looking into funding, in 2023, the AI startups raised already a sum of over $14 billion US, and it's going to be like super interesting what's going to be next in a couple of years. And with that being said, I think like it's an important topic. Let's jump into the fun part and to our 3 trends.
Sure. So yeah, we were thinking of what to share in this AI session. I mean, you all have used ChatGPT. You all read probably a lot online. You've probably used generative AI in some of your applications, but really wanted to give an outlook of what we think will happen in the next year or two, and what are kind of these kind of new trends and also then applications that will open up. And so we really tried to boil it down to three topics. And the first one is actually multimodality. And to get started with this topic, basically, I want to ask you a question. When was the last time you had a question that you thought ChatGPT might be able to answer, but you didn't ask? Why was that? So when was the time when you tried to input something, but you weren't sure how to put that into the ChatGPT interface? Anyone here in the audience? Any examples?
Oh, great. Lucas?
Or latest news, like ongoing real-time news. Ongoing real-time news is a good example. Any other examples? So I had the other day like a long video, and I wanted to put some images in. I had a specific task how I wanted to shorten the video. Like I was like not sure how to put that in. I could put images in, I could put text in. I also actually was out in nature the other day, and there was this smell, and I was like, this smells really interesting. What is this? Would love to ask ChatGPT that, didn't really know how to formulate that. And so, you know, these are some examples where you basically, the interface is just not right. And also, if you think about the creation side on the other side, like recreate the smell or basically create a certain video, things that ChatGPT is also not able yet. Even though it gets better, right? You can already put in some images, you can put in some speech. And this is because basically, if you think about our daily lives, it's about a lot of different modalities, right? Like, I mean, we smell, we feel, we have emotions, we read text, we look at images, we look at videos. It's all so different data, and all of that ultimately goes into our brain, gets processed, and then also we create stuff again, right? Like we create stuff with our physical hands, we write text, we create images, videos, interact with programs. It's all these different formats. And basically, where we need to go and where we see a trend is that this whole topic of multimodality is on the rise. That basically you end up having a multimodal AI that is a type of AI that is basically capable of processing different types of inputs and also generating different types of inputs. And we started basically back in the days with, you know, machine learning models just processing basically spreadsheets. Then we went to images that started to work really well. Then we figured out how to put text in these AI models. And now the next thing will be videos and all these other data types. And then also on the generation side. And that's actually quite hard if you think about it, because basically you have these input modules that basically, you know, are very good at processing text or images. You then need to somewhat transform it so the machine can read it. I mean, for language, I mean, it's about tokenization, it's about stemming, so kind of reducing the word to the core of it, and then somewhat projecting that into a vector. And you do ultimately the same with images and any other kind of data. And then kind of the ultimate part that is hard is basically fusing these different things together. Because basically one is image, one is text. Like how do you merge this? I mean, both are numbers, but like they mean very different things. And so people have been working on different techniques to basically concatenate these vectors, develop attention mechanisms that basically understand what parts to focus on the input data, also across different modalities. Graph convolutional networks that deal with graphs, which is again a different data format, and generally transformers have been very helpful. And then ultimately it's about, once you've merged all this data, about generating output, right? Which again could be multimodal. And so this is something where, especially on the fusion side, we need to see a lot of progress. And that's actually very hard. And the thing is, like, I mean, for an image or text, you can break it down in something readable. But like, for example, how do you understand that the text and the image means the same, right? Because there needs to be some connection between the two. And for example, one trick people have used is that they look at a lot of images from the internet, train on them, and use the captions of the images as something that kind of probably means something similar than is in the image, because it was a caption of the image. So that gives you actually a relation between the image space as well as the text space, and so you can start learning joint representations. And this goes much further when you think about video, when you get to think about sense, smell, and all these other things. And we believe that this will be an area where we've already obviously seen some progress this year and in the last years, but we will see much more progress in the future, that basically one AI model can deal with all kinds of data. And when I ask the same questions in like 5 years, you will hopefully, nobody will raise their hand, because whatever data they deal with, they can put it into the AI model. And this will unlock a lot, because right now, I mean, we've been at very narrow AI applications that, just look at one very specific data type. Now with ChatGPT and these models, we are already a bit broader, and it feels like already it can solve more of our problems in the real world. And we will go even further, that basically it has the same inputs and outputs as we as a human. And that will create a much smarter combined intelligence. It will make also the AI models much robuster against noise, because no matter what kind of input data it is, the model will always come up with something reasonable. And I think one area we are particularly excited, which is again another modality, is then also to think about building foundational model for brain data, for example. One area we're looking into right now, which is again a very different data type. And so yeah, handing over to Jana to talk a bit about some of the applications related to it.
Thank you. So as Rasmus mentioned already, multimodality is becoming a thing, and also our so well-known ChatGPT just recently launched a couple of weeks ago a new feature called NextGPT, and now enables also input data with visuals and images. And like one very powerful marketing use case in the future is going to be interactive content generation. And it means like the machine right now understands like the dedicated input data, but now also with multimodality is able to connecting the dots. And it means like on the one hand side, you could see like, okay, user is clicking a button, there is a text and there is an image, but then in the future it can understand the reason why the user clicks the button is most likely because the text and the image was really appealing to the user. And this is helping us in the future, especially in marketing, to generate very engaging and personalized campaigns, and also assuming or suggesting visuals that's really like fit to this newly personalized created text. Another topic, which is not marketing growth related, but I think it's very interesting as well, is coming from healthcare. So on a daily basis, healthcare professionals, they're dealing with different kind of data inputs. It means like they look at images from radiology, they look at time series from heart rates from electrocardiograms, they have structured data, lab results, and they have non-structured data, their own notes. And it's like very difficult, and this is like the main difficulty, to deal with all of this kind of different data sources, especially when you are healthcare specialized in one specific area. And now with multimodality, the machine basically becomes like the support of the healthcare professional and helps them to unhidden this kind of relationship of these variables, and of course like to support or improve like personalized patient care. Back to you.
Yeah, the next topic is the autonomous agent or the AI copilot. I mean, you've all heard about Copilot for X, but I wanted to put this a bit more in perspective. So, I mean, Andrew Carpathy, one of the godfathers in AI, said that probably English is the new hottest programming language. And I think this is very true, and it will be very, very important in the future. So I think, like, if there's one language you want to learn, like 5 years ago, everybody said you should learn programming. I think now you need to learn English really well, because that's probably the new interface, how we will actually change the world and have a big impact. And I want to talk about autonomous agents. So autonomous agents are really AI-powered systems that when given a certain objective, can create, prioritize, and complete tasks by themselves. Sounds very simple, it's actually very complex, and ultimately, if you would replace autonomous agents with humans, like that's probably how we all earn our money every day. So it's pretty much how the working world works. And in the past years, we have seen pretty strong advancements on the AI side. So I mean, the first one is factfulness. So yes, ChatGPT still comes up with a lot of stupid stuff, but less so than like a year ago, and probably even less in the next couple of years. So people are really working on also integrating, as you pointed out, current information from the web. So you have not just historic data, and also like systems around it that gives you check and balances to kind of make sure what the model outputs is correct. Transparency is stuff people are working on. I mean, that's also where regulation comes in, like being more transparent. What has your systems been trained on? What do they access? And then explainability, one of the big topics, to really then also reason when things go wrong, why things happened, and if your system in the first stage was trained properly. And the way how we think to come to autonomous agents is actually a 4-step process. So this is kind of the old world. So basically humans doing work, no integrations, humans do everything. Then kind of this is probably kind of the last, like until like a year ago or 2 years ago, where basically humans still are in charge and basically are supported by machines. The machines, show data, maybe give some analytics, some insights, but ultimately there was little integration. There was still like a human looking at some data and then making a decision. So it was really the human in the driving seat supported by a machine. Right now we're starting to see in certain areas kind of a switch. So kind of the machines driving the process and the human just here and there supporting. And that depends a bit on like the application, like how good is AI yet? How safety relevant is it? Is this something startups have tackled or big companies have tackled yet? But basically where the machine is driving the process as such, also like deeply integrated in the workflow, so could probably fully automate the decision making, but there's still a human in the loop that looks at some of the kind of harder examples or maybe still ticks off some of the cases before it then gets shipped. And that's where we start to be now, and that's where also in the next couple of years we will see more workflows where there will be deep integration and basically the humans just look at it here and there. And obviously that creates crazy productivity. That's the next step, the final step, basically where a lot of process steps are actually completely autonomously done by machines. And all you do, coming back to the autonomous agent example, is give an objective and then the machine completes the task end to end. Now, how do we get there? So, I mean, this obviously creates crazy automation. It creates actually also crazy interactions because suddenly you can also have machine-machine interactions. So, you have your machine, if you're a consumer, calling the call center. On the call center, there's also a machine. They both interact and they fix, your issue you have with your, telco company, not in 45 minutes, but within like 2 to 3 seconds because they interact directly. Or if you think about sales, you have AI sales agent and then directly interacting with, somebody on the side who wants to buy something, both machines. So you have really machine-machine interactions, negotiations. You have 2 machine lawyers negotiating with each other. You don't end up paying lawyers like hundreds of thousands to negotiate and take weeks, but basically, the whole negotiation is done in 7 seconds. So I think that's kind of that when the world is like that, where we can go. And the key challenge to get there is actually we don't have the interfaces yet. So if you think about ChatGPT, you can do all kinds of things and you get all kinds of results back, but the integration into the real world is still something they're working on. Obviously, some things have been already integrated, but there needs to be many more integrations. And these complicated function calls are actually what is needed. So if I, for example, for tomorrow want to book a flight, I can ask ChatGPT and something come back, but it will still not book my flight. Now, the next step is if I say, look, like I want to fly to London tomorrow, and ChatGPT gives me back an answer and says, look, like here are 3 options. And then I say, I want the flight at 11 a.m. And then it has my credit card details. It goes on the website, books the flight, sends me the booking confirmation back, and it's done. So that is something where we'll go to and which is also technically possible. It's just a matter of now building the building blocks together. And kind of the challenges people are working on is one part is like you need to suddenly interface with another interface, right? Like a lot of the things, like if you think about shopping, Amazon, if you think about, booking stuff, if you think about like, CRM, Salesforce, like you need to interact with those. So you need to somewhat be able to deal with this interface. And you need to also understand when you can do these function calls. Also, training loops is very expensive. Like I don't want, some LLM trying to book 10,000 flights until I kind of learned how to book it correctly with my credit card. Like that will be even more. People complain about how expensive training is. Like this will be even more expensive. So there's a lot about like being efficient on learning that. And there's so many different websites. So how can you build a system that can robustly integrate with any kind of service? So that's kind of what all people will be working on. But like this integration into these like real world workflows will be something that where we see a big push in the next 1 or 2 years that ultimately will lead to crazy AI adoption and ultimately allow these more autonomous agents. So yeah, I think this will basically enable anyone to be kind of equally good at all these specialized tasks. It will equalize playing fields because with those co-pilots or even these autonomous agents, we will all be as good on the same task. But yeah, for that we need to do the workflow integration as I mentioned.
All right, thanks. So one example for our application, which really exists already, comes from the London-based company 11x. By the way, 11x is in the house right now. Someone here? No, doesn't seem like, because it's one of our portfolio companies. 11x, they are developing digital workers that basically save our resources from human employees. And there's like this example we're currently on the market. It's Alice. Alice is a AI SDR, and Alice supports the growth team around every activities in the side circle. This means Alice, on the one hand side, can identify leads, can enrich leads, can build lead lists. But Alice can also do sales outbound on a very personal level, and also even answer inbound sales messages. That means also Alice can book meetings and supports basically the entire growth sales team tremendously by, for example, generating faster pipeline, and also, as mentioned already, saves resources of the growth team, especially when it's like repetitive tasks, and so they can focus on more human-driven tasks, for example, strategy, or really like outreach to, let's say, highly qualified leads and opportunities. So Alice is not alone right now, she's on the market, but there is like also something on the product roadmap. So new other digital workers will enter the stage soon. For example, a customer success specialist, I think his name's Mike, and junior recruiter, I think is Eric.
Let's see who's next after that. Yeah, one last topic is hyper-personalization. So again, hyper-personalization creates fine-tuned, customized, and targeted experience through data analytics, AI, and automation. Just the definition, and that's something which is, I think, also quite important. And the main driver behind it is really that we are able to do AI much faster. Because if you want to personalize stuff, I mean, if you look, I don't know, at advertising, back in the day there was one billboard out there, everybody saw the same. Then people came up, okay, for like Facebook ads, you have some stuff for the younger, for the older, for men and women, and that somehow worked better, and maybe for different regions. So you have 10 different versions now. What if you like hyper-personalize this? Like you create millions of different ads, for example. Like for that, you need actually crazy compute because you need to create all of them. So one of the kind of bottlenecks for this hyper-personalization was really, improving hardware that allows faster inference, and that's where we see a lot of progress right now. So we're seeing faster chips that are basically able to generate, ultimately this personalized data much better, that are also more adaptive. So basically more specialized chips. It's not all NVIDIA, where these specialized chips basically are very good for certain AI models. And when you want to run them at highest capacity, that makes a difference in your cost and energy consumption. And then the other part is also people are working on making AI models much more efficient. So everybody's talking about AI models getting bigger, and that's true. But at the same time, if you look at a model today and like 5 years ago, to achieve the same model performance, actually the model starts to be much smaller today. So we are getting more model efficient, and so that also allows, running inference much cheaper, which then again allows much more hyper-personalization. And to kind of put this into like a vision, I believe we will have an endless stream of content, basically. So this concept that a song is like 3-4 minutes long, that a movie is like 1.5, 2 hours long, that when I do like an online learning course, it ends somewhere. I think we won't have these ends anymore in a few years. So we'll basically be able to generate endless streams of movies, videos, advertising, education content, and all hyper-personalized. And that's another trend, again, that we will see continue in the next year. I mean, there's still hardware inference still needs to be much cheaper. I mean, we still need to improve the models, but this obviously opens up a lot of very interesting business models, and also actually will disrupt some of the existing business models in the content industry. And all we need for this is really just the data we can train on, and then the data to generate it.
Okay. Another application which currently exists already on the market is Rewind AI. And Rewind AI is a tool. It sounds a little bit creepy, yes, but it's a tool you can basically implement on all your devices, let's say smartphone, laptop, etc. And in the background, it records all the data streams. That is like everything what is written on your device, everything what is said via meeting, and everything what you can also hear via meeting. And like the use case for Rewind AI is it helps in the business world to sum up or wrap up meeting notes or summarize meetings. And also it helps you, for example, when you forget something, you can ask Rewind AI, hey, please, what was said in this meeting 2 weeks ago? Please, can you help me? And it gives you the answer. So now with this technical solution, we should now go into this direction of a marketing use case, and we're talking about product placement. And this is, for example, something which is like extremely, for me, like that's wild. It's a wild thing. So, for example, streaming providers like Netflix. Netflix, they have this product placement, for example, in this case, Coca-Cola. And with Rewind AI in combination with Netflix, brand could, for example, they know, okay, Jana's taste is Coca-Cola, but Rasmus, you, for example, like Sprite. They know exactly, okay, Rasmus is more into Sprite because like we recorded already the data, we recorded his preferences, and then in real time, you could put, for example, Sprite in place of Coca-Cola for product placement. It's sick, yeah, but let's see if this is the future. I'm really curious about that one. Okay, another example, of course, like retail, e-com. First phase of e-com was people searching for goods. You need something, you go either to the retail store or you go to Google and search for the good. The second phase of e-com is goods searching for people, and this is right now what we're having currently. That we have this recommendation engine, and we also have those hyper-personalized product feeds where we get unlimited of product offerings and recommendation, sometimes from products we don't need or don't even want. And then the third phase is definitely connecting goods with people. AI bridges both the preferences of the customer and of course also from the our time is up, so and also from the people and also from the products, and enables basically like this a very autonomous checkout flow coming from the decision to checkout in the end. And sorry, we are already over time.
Yeah, I think that's it. There's many more trends. It's going to be very exciting 2024. If you have any questions, I think we'll be around here after the session. So thank you very much.
Thanks for listening. Thank you.
Wollen wir es abschicken?
Also ich bin dafür. Okay.
Ihre Druckidee jederzeit online bestellen. Online-Printers. Jetzt testen.
Welcome, everyone. Very excited to announce this panel. So for the next talk, we will have our very own Anton Walz, general partner at Project A, on stage, together with Max Lambsdorff, who's the founder and CEO of our portfolio company Express Group, where Project A has led the Series A together with Insight Partners last year. And they will talk about the untapped potential of underserved markets in Europe. So without giving away too much, I welcome the two of you on stage.
Yes, hi everybody. Also from my end, thank you very much for joining this session on finding untapped potential in underserved market, which is actually a topic that we in the investment team at Project A are discussing a lot, because it's quite ridiculous when you think about it that some customer segments are totally overflown by products and software solutions, very competitive spaces, and some of them are really not needed by anyone. A good example, and then on the other hand, there's big customer segments that are totally overlooked. A good example is if you compare high-income workers and low-income workers. So you see the vast majority of startups targeting the top 20% of income, and the other 80% are mainly overlooked. And not only by entrepreneurs, but also by investors. And that we want to discuss today with Max, founder of our portfolio company, Express Group, a company that has always first and foremost focused on low-income workers. Max, again, thank you very much for being with us. Please tell us maybe what Express Group does and in what sense you are actually tapping into unseen potential.
Yeah, thank you, Anton. Thanks for having me. Really great topic to talk to. Was excited when I got the request. Express Group is offering digital services and products that are aimed at solving multiple problems in the lives of the classical working class, and especially targeted at their financial wellness. And we believe that there are so many products out there that probably many of you use to manage your daily life, especially your finances. Tools that are sometimes apps, sometimes it's services that are always targeted at the people that kind of come to this conference and sit here and are very good with numbers and documents and kind of digital natives, professionals, young professionals. But there is a huge gap when it comes to these digital products and services aimed at the problems of the working class, the people that have built the world around us, probably this cinema as well, that are running our infrastructure, that are maintaining our infrastructure, that are doing incredibly important jobs. But since their disposable income is a little bit lower than probably the mean income here in this room, they are harder to monetize, and that's probably one reason why they're so underserved. There are many of them. We'll probably talk about a couple of those reasons, but that's why we focused on that. And our biggest product is Expresssteuer. Expresssteuer solves one of the issues that we believed was one of the most significant issues that people in Germany had, especially the working class had, in relation to their financial wellness, and it was claiming back their hard-earned money that was unrightfully claimed by the government. That's usually around 1,000 euros on average, and claiming that back. That's what we do.
So I mean, your big competitor in that space, basically helping users to make your tax report, is TaxFix.
Mm-hmm.
They are more targeted on young professionals. Why wouldn't they go for the other 80%?
So our competitor started in 2016. Nothing really was on the market. There were a couple of, there's a government software, Elster. There was here like these very, very old kind of desktop software. So, you know, it was an easy target to go after people that wanted to use their phone, to give them a better UI, a better UX in total, and kind of build a tool that helps you to do your taxes yourself. And just as, you know, N26 did as well, they targeted those that are very proficient with their phone, that know how to do all that stuff, and you don't have to really offer so much to these people. It just has to be an incremental improvement to the user experience, and with that, you get them moving. You can move them to your platform or to your product, and that's probably why they started with that. And it's much harder to build for people that have more needs when it comes to user experience, that need a better user experience, because they're way further away from doing it themselves. 12 million people in Germany have never done their taxes. Most of them are working class. And to get them to do this incredibly annoying process, even if you make it much easier, is harder. And also it's harder to monetize them. You know, they have less disposable income, so they're not ready to pay that much. They're not ready to also invest into a tool, to buy a tool and then do the tax return themselves. That's also harder. So I think in 2016 it was just, would have been, the easy way was kind of the smaller market, which is the young professional, the digital native. The bigger market, I think at that point, was too hard to crack, and left some open space for us.
I mean, when we first met you and saw Express Group, the model reminded us a little bit of Robin Hood, not the neo-broker Robin Hood, but basically Robin Hood from Nottingham. As you are basically, I mean, in a sense, you're taking money back from the States that people have a claim for, but many of them don't know, and then basically giving it back to the people. How much, like when you started the company, how much of your motivation was mission-driven? How much of it was simply the opportunity to make a big business out of that?
Yeah, I think it's, to be honest, it's something I think every entrepreneur really is looking for. It's very hard to find, but the moment you find something that combines both of these things, you get really excited. And that's what happened in 2019. I was just coming out of my first startup, haven't even quit at that time, but was open to new opportunities, wasn't that happy. And if I look at a market and a market opportunity, I try to look at numerical signals that there's a huge problem that has not been solved properly, and then there's a numerical proof that it's actually there. And if you can do that, then you can go and explore on a qualitative basis. If you're sure on the quantitative, then you can try to validate that. And that's what we did. And obviously, the fact that it actually makes sense to try to get these 12 million people to get their refund, that was a huge argument for me also to move in that space, to do a topic that maybe is not that sexy. I think taxes, is not I as a 14 I wasn't envision myself being a entrepreneur in the tax space. But that was a really big aspect, and then obviously combining that with this insane market opportunity. If you have 40 billion euros sitting at the tax office waiting to be claimed back by those that rightfully earned it, and you know that you can move at least some of that back into the pockets of people, and you can be part of that transaction, and you can grab some of that transaction, then you know that you have a huge net positive. But also you are able to build a billion-dollar business or multi-billion-dollar business with this. So if you match those two things, I think no entrepreneur shies away from an opportunity like that.
Is that kind of missionary aspect in any way contradicting with that goal to build a multi-billion-dollar company? Or a question differently asked, do you sometimes reach intersections where you ask yourself, Robin Hood or Elon Musk?
It actually. And that's that's the beauty of our business model, right? We monetize on a provision base, so we take 20 to 24. We are right now in pricing tests. % of the refund of someone. So the more refund we get for the person, the more money we make. Even the fact that we can claim this refund only in that instance, we make money. So it really is a perfect alignment of the interest of a person, of a user, and the interest of the company. And that makes it incredibly easy to never really have to ask yourself these questions. There's one exception, and it's with pricing. We just increased our pricing because people were, quite frankly, very willing to pay this. Then, you do not create a positive effect for your users. That's the only situation where you really have to ask yourself, okay, is it fair? Is it not fair? Are we, is it a good thing to do that? But in every single other situation, if you optimize on conversion rate, if you even trick people to use your product by doing these kind of little conversion psychological things where people then, you know that they convert a little bit better, you always create a positive effect for the user as well. And that's really easy because you sit in a meeting room and say, we could say this instead of that and move them faster through the funnel, or we could, change the signature version or something like this. And it never feels like you're messing with your user and trying to trick them. It feels like you are helping them because they just, sometimes they don't know better, or sometimes they don't have time, whatever. And that makes it really easy to balance these two things.
Let's get a little bit more operational maybe. So research shows that when it comes to broadband access and internet adoption in general, lower income consumers are lagging a full 10 years behind their higher income counterparts. They also use the internet around 30% less and purchase nearly 40% less online.
Yeah.
How do you factor that in when targeting lower income customers in terms of marketing, in terms of branding?
So I usually characterize our users by people being more digital consumers than digital managers. So all of these people, most people in this room have a wide array of apps on their phone that manage their life, that help them to solve a small problem or a big problem or whatever. They've moved a lot of processes into the online world that for some are still offline. But all of us also have a huge amount of consumable tech on our phone. So it's it's YouTube, it's social media, it's information, everything that you just consume. And this is our target group is in that sense very similar. So they consume a lot. They have realized that entertainment is much better in that way. Straight line TV is losing on every basically every demographic. So we have these people consuming a lot, but they're not managing that much. So we can go to TikTok, we can go to YouTube, Instagram, Facebook. The people are there, and we can then convince them that getting your 1,000 euros of refund on average is a good thing to do, and if it just takes a couple of minutes, maybe now is the time to do it. And that intersection, then we move them from being only a consumer into into a also manager, and that's where you get them. And I think
maybe in terms of maybe to get a little more concrete, are you using different marketing channels and branding channels? I mean, I as a big like a long year fan of FC St. Pauli know that you're using that platform also.
Yes. Yeah, I think you have to go where they are. You have to be very honest with your marketing, very straightforward. They don't want any tech bullshit. They just want, what's the USP? What does it cost me? What's the invest? What's the time invest? You have to be very clear in your messaging, and you can go where they are. Yes, definitely. In the St. Pauli Stadion, there's a lot of people that can use our product, so we worked with them. And it's...
but are there, for example, social media marketing channels that work different than others?
So I think, what you're playing into is TikTok. In 2022, we were one of the biggest TikTok advertisers in Europe with 1.3 billion impressions. To be honest, I think that it was not something that was inherently unique because of our user group. It was something that was inherently unique to the platform at a point where it was very new, where it was not that regulated. Ads didn't show really that they were ads for 5 or 6 seconds. So you had a huge advantage to everybody, to Instagram, to YouTube, where it tells you instantly that this is an ad. So I think we capitalized on a platform that had a huge opportunity, and we found our user group there as well. We canceled out everyone below 18 years old. We were able to really reach them there, but it was nothing really special to that user group. I think everybody could have done it with basically every target group. But yes, it just shows that they are also there. What many people probably wouldn't have expected, that you have construction workers and nurses and bus drivers on TikTok a lot.
When it comes to business model and monetization, any potential pitfalls here? Anything that any mistakes you did at the beginning, or any specialties?
Yeah, I think if you talk about monetization with a user group that has low disposable income and very low trust into tech in general, then you have to go with a provision-based monetization system, in my opinion, because it alleviates the risk from your users. They can go into the process, they can go into your product, they can try out, they can do it only if they are successful, and only if they actually receive money, they have to pay. There are some exceptions, but that's how you kind of alleviate the risk of investing 30 euros into a tool and then not succeeding with it. And that's what people are very scared of, so that's why we chose that monetization strategy.
You mentioned UX and UI, which can be very different. I think this is also a big differentiator. I mean, if you look at, if you get to the Expresssteuer website, I mean, when I did that for the first time, I was a little turned off, I have to say. But you do that very deliberately. So what was the reasoning behind that?
So, as I already mentioned, right? We believe our audience doesn't want tech bullshit. If the design and the way lots of tech tools or services are marketed is very avant-garde and very kind of as modern and high tech as you can get in order to show your users we are the coolest new thing, and we don't believe our users need that and want that, and they are actually they would be turned off by maybe a website that you really would feel like is really cool. So we try to be a little bit under the radar with the design and with the brand itself, and a little bit more down to earth. We're testing a lot, so maybe it's starting to look like we can go a little bit more cool and a little bit more fresh and new, but those tests are not done. But yeah, so we really felt that we didn't have to be so techy and high tech.
Yeah. When you talk about cool and fresh, what impact does the fact that you are targeting that kind of underserved target group or customer group have on A, company culture, and B, also employer branding and your potential to hire?
I actually want to answer one thing before that, because you also asked about UX and UI, and there's one really, really important aspect that I always love to talk about, and it's that especially for people that, especially for user experience that people don't really are hugely passionate about. You're never going to be passionate about your taxes, or most people won't. No UI is the best UX. So the less UI you can put into your product, the better the UX. If you can do stuff in the background, if you can do stuff yourself, if you can do maybe a little bit manual help actually, so you can get like a whole UI flow out of the way, that's how you create an amazing UX. And that's also different to the digital native young professional that they are happy to do everything themselves if it's quick and you can click it fast and input everything fast. So we try to really reduce the amount of UI we need for a customer to be successful. So that was one aspect I really never shy to mention. And then, on company culture, that's actually really interesting, because if you have a product that wants to be very down to earth and very, it's taxes, it's not going to be sexy, then your employer brand is not going to be that cool either. So that's something you really have to think about. I think there are areas where you can match both and even go into it. So I think construction business has made some good examples where they actually did a great job in kind of combining a construction brand, which is also traditionally not that cool and not Berlin startup, and making it really honest and making it work as an employer brand. For us, we really separate. So Express Group is the employer brand. The merch here is very different to the design of Express Steuer. You really have to also show different kind of the how you talk to your potential hires is very different to the way we talk to our users or to our potential customers. And that's a decision we made, that we just didn't feel like we could get both together perfectly. So that's why we separated.
Mm-hmm. And does it have effects on culture also, like internal culture? I mean, apart from employer branding, to separate those two?
So the good thing is that, one big culture driver can be this mission that's insanely, net positive. We try to claim back as much money from the government and put it into the pockets of those that rightfully earned it. It's 40 billion. We will probably never get to the end, but we will make a dent into it, and a big dent. And that drives culture, obviously. So we have a lot of people in the company that are highly motivated by this mission, that also have some kind of connection to the audience, to the user group, to the target group. We have and that definitely creates this culture. And I would also say that our culture is maybe a little bit more down to earth than I've experienced in other startups. Mm-hmm. Probably because our users have 28,000 euros in income on average, and I don't know. You don't tend to splurge around with money that much for fancy, cool, like weird stuff that maybe some startups do. If you try to serve people that don't make that much money. You obviously have to invest a lot in marketing, and you have to invest a lot, but not into stupid gimmicks.
I mean, zooming out a little bit again and becoming a little more macro. So the statistics on internet adoption and internet usage, I mean, that gap will certainly close. Mm-hmm. History has shown that it will. Do you think, I mean, are you already seeing, or are you expecting a lot of competition coming as soon as basically that gap is closing? And maybe also zooming out from your particular product, do you think underserved markets will get more in the focus of aspiring entrepreneurs?
So, I believe when a market is underserved, there's definitely a reason. Maybe the audience is hard to monetize. Maybe the UX you need to build, the technology is just not there yet. Maybe you just can't make money there. That's can also be a reason. There can be many more reasons, but one of these, the key blocking reason has to fall before entrepreneurs move in there. Now with AI, definitely a lot of reasons will fall, because you can, for example, offer intense services that had to be done very manually. Suddenly AI can do a lot of that, so you can offer things that suddenly make sense from a unit economic perspective, and that's where people will move in. Yes, adoption is also a big thing. Our average age is 31, so they will grow with us, or they will age with us as well. People, the younger they are, the more digital they are. It also goes for the working class and the blue collar audience. So yes, with time, I believe we will see more activity in that space. And you also have too much saturation in other audiences, right? I mean, if you have 6 neobanks for the digital native, maybe it's time to build a neobank for the working class or for other people. I see a neobank for young people, but very young, like underage people already coming up. So those kind of successful business models move into different spaces as soon as there's a huge market saturation, and that also will drive. But there's so much space. There's 100 million European working class citizens. They are very underserved in almost every aspect of their life. So it'll take years. It will take lots of work, lots of entrepreneurs, lots of VC investment, and lots of very, very smart business models that actually make it worth it. And if we can get there, maybe with the help with AI, maybe with the help of automation, maybe with the help of lots of education also, and more marketing spend that is targeted at these people that it's usually maybe not targeted at, then you see a change in behavior, and that also drives then a change in behavior from VCs and entrepreneurs. So it's a gradual development, and but it will be pretty powerful, I think. And technology only makes the world a better place if we leave no one behind. So I think everybody should keep that in mind and maybe work towards that as well.
Yeah, I mean, maybe just one more word on that, because I mean, we meet a lot of very talented, brilliant people that want to start a company, but they just do not have a concrete idea yet. And this was also one of the reasons, or one of the ideas of this talk, because we believe, and this is definitely something that we discuss a lot, we believe that underserved markets bear so much potential, and it's incredible. I mean, everybody thinks, oh, it's there is a startup for everything already. It's just not true. And I mean, it's not only this was now on lower income, higher income workers, but it can also be very different communities. It can, I mean, it really doesn't have to be only that. That was the focus, because Express Group does that. So to all the aspiring entrepreneurs out there, go for the underserved markets and come to us. We have some ideas, and we are happy and ready to discuss.
Thank you, Anton.
Thank you.
Thanks a lot to Anton and Max. We'll have a very short break now, and then I encourage you to stay because next up is Tuinan with the analogies between growth marketing and Muay Thai. So very excited for that. So see you in a bit. That's a cool video. Welcome everyone, especially the ones who are new to Cinema 4. We're very excited to have Thuy Nhan, the CMO of Project A, who has worked across probably most of our portfolio companies over the long years she has been at Project A. And so we're very excited to hear about the analogies between growth marketing and Muay Thai now from her. So please give her a warm welcome. Hi, Thuy Nhan.
Thank you. So, first of all, welcome to the Project A Knowledge Conference. I'm so delighted to see you all here. And secondly, I'm so excited about that talk. So it basically combines two passions that I have, my job about growth marketing, but also Muay Thai. So before I start, I want to share maybe a little bit of info why I actually took that topic. So those of you who had the pleasure to work with me already know that I like to talk about very nerdy stuff like privacy laws, server-side tracking, and so on. But I thought, okay, if I do that, then I'm probably going to lose the audience. So I thought, okay, we're going to spice it up with a little bit of Muay Thai. And also one disclaimer, I am not a professional Muay Thai fighter. I'd love to be that, but for that you definitely have to be a full-time training person. And I think I already have a full-time job, which I love already. Okay, so we have a few, basically 4 trends that, or 4 lessons that you can apply from Muay Thai to growth marketing. And yeah, we're just going to start with the first one. Okay, wait for it. Yay! Okay. So what did you just see? Essentially, it's about precision. So precision is really key. So what I mean by that is what you saw is that the first fighter who was fighting, he basically threw a few strikes. But the second one was very precise in how he basically targeted his opponent. So for example, when you think about a cross, that's basically when you basically have that stand and then you throw a cross. Some people only do that. What you actually have to do is you also have to swing your hips so you can actually have more power to target your opponent. So how can you apply that to growth marketing? So essentially, the lesson here is that it's about targeting and it's about data. The analytics that you have to draw insights or actions or actionable insights basically to inform your strategy. I'll bring you one example. So Casavo was starting marketing, and they essentially had the biggest channels live, such as, for example, Google, Facebook, obviously, CM, and so on. And what happened is that when we started to work with them, is we first made sure that they actually have the data that they need. And by that, what I mean is that it's not only about the upper funnel conversions that you have, but also the lower funnel conversions. So with the example of Casavo, you have the first lead coming in, then obviously it's going to be qualified, then later on it's going to be a property sold. So if you imagine that, for example, in the B2B world, if you only optimize for the upper funnel event with your existing systems such as Google and Facebook, that will not be essentially as powerful as you would obviously optimize with lower funnel events such as marketing or sales qualified leads. So what we did is that we essentially made sure that, first of all, we can track that up until the lowest level, but also up until the highest granularity in terms of ad ID. Second one, we also made sure that those signals can actually push back again to the different systems. So we made sure that the server-side tracking was properly set up. The results have been amazing. So in 2022, we essentially acquired 79% more in terms of leads year over year. And we also generated the highest volume in terms of leads in 2023, which is obviously a great result. And I think that's something that every one of you should embrace. So if we talk about data, it's not only about making that data available, but also pushing that back into the systems to really empower or essentially use the power of the algorithms of the different systems. Moving on to the next tactic. So in Muay Thai, it's also very, very important to stay agile. There's a saying that that's basically sabai sabai. So essentially, always try to be agile to swiftly dodge your opponent's attacks or strikes. And so you should also do a little bit of yoga to essentially win your Muay Thai fights. But what it actually also means in the growth marketing world is that you also have to adapt to the market situation, the seasonality, whatever happens in terms of your competitors on the market and so on. So, for example, what Trade Republic is doing really, really well is they have a very, very solid knowledge about the market situation, and they adapt their campaigns very, very swiftly, actually, to make sure that they exactly that they can exactly capture the customer's intention or attention in that moment. So, for example, what they did is for 4 product marketing campaigns, they were targeting derivatives, web version. They had a huge Christmas campaign. I'm sure it's going to also come again this year. So that's everything. On the one hand side, you obviously need the channels, but you also have to think about actually how you want to emphasize that and how you want to build the campaign setup around that. And for that, it's very, very important to have a very strong product marketing knowledge, and essentially also make sure to understand the market and also the competitors, what they're going after. That's one of my favorite fighters, by the way. Hold them tight. So in Muay Thai, it's very important when you actually, when your opponent strikes you or when the opponent attacks you, it's very important to hold them and basically grip them a little bit to not lose them again, because that's the moment when you can basically attack them again. How can we apply that to growth marketing? CRM. So I think it's very, very easy to acquire a customer, but it's also very easy to lose them again. And I'm not sure how many people actually or how they level the focus between those two areas. But for us, it's always very, very important to have as much focus on CRM or engagement as on acquisition. So, for example, at Teleprint, we saw that they had a loyalty program, they had a referral program, but it wasn't as effective because obviously, like with lower resources, it's difficult to build something up that is solid. So what we did is that we built an MVP version, which was way more easy to understand for the user, that can also essentially be grasped in a minute in terms of the tiers, in terms of the incentives, how to access that. We also proactively communicated that on the different channels. And the result from that was quite cool, actually, because across 5 markets, we saw an increase in the reactivation rate by 37%, which is obviously huge if you want to make sure that you, as I said, you don't want to only acquire the customers, but also retain them, actually. And now one of my favorite fighters as well. Also, he's actually from the 90s, so if you want to Google him.
One, 2, maybe 3. Come on. And wait, go. Kick leg, okay.
So what you basically just saw is that it's very important to also diversify your strikes. In Muay Thai, there are different ways how you can attack an opponent. So you can throw different, like you can throw jab, hooks, uppercross, and so on. But also kicks, a lot of versions: low kick, high kick, leg kick, but also thigh, and so on, everything. But what's very important is that you always have to diversify it, because the more you diversify your strikes, the easier it will get for you to essentially confuse your opponent and make sure that the opponent doesn't actually know what you're going to do next. So how can that be applied to marketing? Essentially, it's about channel diversification. I know that there are a lot of opinions around that. Some people say you should just stick with one channel and that's it. I think you should definitely diversify to at least 2 channels, because otherwise it's very difficult for you to basically make yourself independent of that channel. For example, there are companies that are just growing with Facebook, and then obviously that's a bit more difficult than to grow further if the CPM prices are also going up. We had before the Max from Express Group. He also explained a little bit about the channels they're using at Express Group. And Express Group is one of the examples TikTok loves to give in terms of how companies can grow with TikTok. So essentially the growth that they had throughout the first few months was really, really driven by TikTok, and they've probably been one of the most prominent clients on TikTok. What we said was, so okay, I think it's good to have TikTok, it's a very strong channel, but to also reach other, or to also reach the target audience on other channels, it's important to also look into other areas. So what we did is we essentially also set live other channels such as Facebook, Native, and so on, tested them, and made sure that we can, on the one hand side, diversify and scale, obviously not only through TikTok as they did before, but at the same time, we also made sure that we can actually also decrease the customer acquisition costs. Because what often happens is if you diversify, especially with unpaid channels, what happens is basically you drop the customer acquisition costs, because obviously then you have more variances how you want to distribute the budgets. Whereas if you only have one channel, it's just one channel. You can't really distribute the budget with just one channel. So what we saw here is we optimized the CAC by 62%, by 35% lower, but also saw a 62% growth through Meta, and overall it was essentially an increase in acquisitions by 210%, which is obviously massive, and also is one of the reasons why Express Group was or is still growing so massively. So those are the 4 tactics that I would like to recommend to you. I hope that was insightful for you. Honestly, my first goal was, of course, to give you a little bit of insights of how to run growth marketing. But secondly, I hope you want to start Muay Thai now. Maybe give me some hands who wants to start Muay Thai now. Yay! Perfect. Okay. Cool. So mission accomplished. Thank you for listening, and have a great day. And I think the next one is going to be Simon Walter talking about strategy. Thank you.
Thank you, Tunyan. We'll give the audience a minute.
I think so.
All right. Great. So next up on stage is Simon, our Chief Strategy Officer at Project A, talking about disruption by way of incremental change. So very curious to hear what that means. Welcome, Simon, on stage.
Oh, here we are. Okay, hello everyone. I hope you are enjoying this year's knowledge conference so far. And I'm really glad that despite we are all somehow spoiled by choice today, that you decided to join this session about the truth behind disruption. And as you may know or have noticed earlier today, the motto of this year's conference is the obvious. And in the next about, let's say, 20 minutes, I would like to share with you some pretty obvious facts and insights about disruption and how they impact innovation, business innovation in general, and startups in particular. And as the title of the presentation already reveals, this will end up in a plea for incremental change. Okay, so if we think of innovation, if we think of disruption, we think of revolutions. And although we all know the exact date of the French Revolution, the storming of the Bastille, for instance, or the fall of the Berlin Wall, we also know, because history taught us, that revolutions are rarely a single sudden event that changes everything overnight. Instead, most revolutions, most political revolutions result from many smaller cumulative steps going in one direction, and all of them happen over an extended period of time. So if we take the example of the fall of the Berlin Wall, so the last revolution that took place here in Berlin and literally around the corner from Kulturbrauerei, as Bornholmer Straße is really not far away from here. So if we look closer at the fall of the Berlin Wall, the historians and political scientists, they identified 4 main reasons or developments that paved the way for what happened in November 1989. First and foremost, we all remember, or at least the ones who are a little bit older, the reforms by former Soviet President Mikhail Gorbachev, known as Glasnost and Perestroika. Then, second, the total collapse of the state-directed economy in the GDR that led to a very severe economic crisis in the country. Then the mass exodus of GDR citizens to the west, but also to other Soviet bloc countries. And last but definitely not least, the peaceful Monday demonstrations, first in Leipzig, later in all, let's say, major Eastern German cities. And these 4 developments, these 4 reasons together, they forced the end of the dictatorship in the GDR, and they paved the way for what happened November the 9th, 34 years ago. So we can see most political revolution, because this is definitely not the exception, most political revolution result from many smaller developments and steps over an extended period of time. And this is not only true for political revolutions, no, this is also true for technical revolutions. If you think, for instance, of the first industrial revolution, this wasn't a single event either. So these were hundreds of events, hundreds of inventions, hundreds of small steps spread across almost a century. Between the mid-18th century, when James Watt invented the steam engine, and let's say mid-19th century, where many railway lines were inaugurated in major European cities. So if we think of technical inventions, technical revolutions, let's have a look at the list here. So here is a list with the greatest breakthroughs since the invention of the wheel. By the way, this is a really cool topic over lunch or dinner or to do some networking here at the conference. So what is the biggest breakthrough innovation after the invention of the wheel? And the list you can see here was compiled by the Atlantic magazine and, of course, leading historians, engineers, and scientists. And if you look at the list here, so the 10 greatest breakthroughs according to them, we know more or less when these inventions were made. But what we also know is that an invention itself never really changes anything. In order to change something, an invention has to be translated into a product people want to buy, a product people pay for, a product people can buy. Only then one can speak of an innovation. So that's the difference between the innovation and yeah, you know what I mean. Okay, and this process, so from the invention to a product, as we all know, takes a certain time. Often it takes longer than the people who are in charge expect. Okay, so now let's have a look at what is today the most discussed technical revolution and its history. Of course, artificial intelligence. I think each and every session today will somewhere touch upon this topic. And the history of artificial intelligence goes back to 1936, when Alan Turing laid the mathematical foundation for machines processing algorithms, so the so-called Turing machine named after him. Then, 20 years later, the Dartmouth conference took place, and for the first time, the term artificial intelligence entered the at least academic discourse. 10 years later, Joseph Weizenbaum invented the first chatbot. He called it Elisa, and Elisa could understand text input. 20 years later, with NetTalk, the first neural network learned to speak. Then 1997, Deep Blue won against Garry Kasparov at chess. So Garry Kasparov was back then the world champion in chess. Then 2011, Apple launched Siri, and we all started to speak with our computers, to speak with our smartphones. And 1 year later, Watson, also from IBM, won again human beings in a quiz show. So there is no doubt all of these inventions are great. They are real breakthroughs, groundbreaking. But to be brutally honest, none of this invention really changed something for the masses, really changed something for us. Until last November, OpenAI released ChatGPT. And as we know, this changed everything for us. So the release of ChatGPT can be described as the tipping point or inflection point of artificial intelligence. And the development of ChatGPT was only possible because processors have become more and more powerful, because ever larger amount of data were available and algorithms have become more sophisticated. So here we see the revolution of artificial intelligence. It's a collection of small cumulative steps. And this hockey stick curve here, of course, it's exactly the same curve as I showed you when we spoke about the fall of the Berlin Wall. And if this is true, so if a revolution at the end of the day results from many cumulative small steps over an extended period of time, we can say that it's not disruption that changed the world, but it's incrementalism that changed the world one step at a time. And by the way, this is the core message of the session. Okay. So if this is true, so if it's not disruption that changed the world, if it's incrementalism, gradual change that changed the world, what does this mean for business innovation in general and especially for startups? And I think you are all familiar with this graph or with this chart, as it can be found in one form or the other in almost every textbook about innovation management. So basically this chart distinguishes different kind of innovation based on one side the customer needs, the pain point they address, this is the horizontal axis, and on the other side the technology, the skills the invention relies on, so which is the vertical axis. And then you can basically distinguish between incremental innovation, so smaller innovations like introducing a new flavor or a new packaging for a yogurt, and disruptive, radical innovation like the smartphone, mRNA vaccines, or food from the 3D printer. And research shows that most companies are really good at incremental innovation. So because this is the main task of their innovation teams, this is the main task of their R&D departments. And they're really good in constantly improving their product. So no issue. But research also shows that disruptive innovation, they arise in most cases from collaboration. Collaboration between different companies, collaboration between companies on one side and universities or research labs on the other. Because disruptive innovations, exactly like the examples we just show, they build on many smaller inventions. And these smaller inventions, the probability is high that they are made in different companies at different places. And this, so if you want to change the world, if you want to disrupt your industry, you must collaborate. And this is also the reason why most disruptive innovations come from the same very few locations. So-called industry cluster, like Los Angeles for the entertainment industry or London for the finance industry, or so-called innovation clusters, like Shenzhen in China and, of course, Silicon Valley in the US. And compared to industry clusters, so Los Angeles and London, innovation clusters, they bring together companies from different industries. So it's at the end of the day a cross-industry collaboration. So not only incumbent companies and startups, also companies, let's say, from the insurance industry and from the transportation industry and from the health industry and so on. And this is also a reason why innovation clusters are often referred to as entrepreneurial ecosystems. But entrepreneurial ecosystems do not only bring together different companies, they also bring together, for instance, universities, research labs, think tanks, venture capitalists, PE investors, specialized banks, talents, of course, specialized agencies, consultancies, and so on. So they bring together all these parties, what makes it possible at the end to come up with disruptive, with radical innovation. And actually, at least to a certain extent, also Project A can be described as an entrepreneurial ecosystem. As with our platform and network approach, we really try to bring together startups, PE companies, big companies, of course, our operational expertise, talents, and so on. But one thing is important. So belonging or being part of an entrepreneurial ecosystem or an innovation cluster is only half of the battle if you want to disrupt your industry, if you want to change the world. Equally important is to have an open innovation mindset. So this means you have to collaborate. This means you have to be open. Don't rely only on your own innovation capabilities, but no, collaborate with others and try to have your innovation funnel open. Please allow and foster this, let's say, flow of ideas and talent into your innovation funnel and out of your innovation funnel. Because as we all know, you will only get if you give. So ideally you give first and then you will get later, but this is kind of basic rule. And you can do that with crowdsourcing, with licensing, licensing in, licensing out, venturing, research corporations, joint ventures, and so on. So you need to have this open innovation approach. Otherwise, it doesn't make sense to join one of these innovation clusters. And at least for me, still the best example for an open innovation approach is Wikipedia, where thousands of gifted people, they contribute their time, their knowledge, their writing skills, and at the end, all of us, we have something that is really way bigger than the sum of its parts. Okay, so let's sum it up. If you are a startup, or if you are a company, if you're a startup, as this is a VC conference here, okay. And if you want to change the world or at least disrupt the industry you're in, you must join a powerful entrepreneurial ecosystem or innovation cluster. So basically, you have to collaborate with others, with other companies, with university, with labs, with VCs, and so on. So this is the first thing, the first recommendation. Then second, you have to live up to an open innovation mindset and you have to open your innovation funnel. So this means you have to allow and foster this flow of ideas, flow of patents, of licenses, of talents into your funnel and out of your funnel. And last but not least, you have to focus on the small steps. Of course, you can have a big visionary startup strategy. You can have a big, bold purpose for your brand. But when it comes to innovation, when it comes to product development, focus on the small steps. Focus on gradual change, on incremental change. Because we all know that one small step for your company can be a giant leap for mankind. Just to quote Neil Armstrong. Okay, now we all know that incrementalism, step-by-step change, gradual change, is not as far as sexy as a cool revolution. But compared to most cool revolutions, like the one showed here, incrementalism works. And it changes the world one step at a time. Okay, that's all, folks. Thank you very much for your attention. I hope you enjoyed the session. And yeah, if you are into disruption or if you are into innovation strategy in general, you may connect with me over LinkedIn. There we can discuss further about today's topic, and there I also share regularly insights and practice from the Project A Strategy Squad. And if it works, this QR code should lead you directly to my LinkedIn profile. Now, I think we have some time for questions, although I'm not sure. I have to ask the moderator, Miele, if we are behind or ahead of schedule. One question? It would work. It would work. Okay. So, do we have a question? A comment? Yes, please. Maybe you should wait for the mic, otherwise the other people won't get it.
Like, if we assume, like, from this curve, we assume that the startup job is to be as close as possible towards those tipping points, like, or an industry that is close towards the tipping point, because otherwise it's just the incremental change, like you mentioned. But for OpenAI, it was that they reached markets and people with, like, a fairly technical topic, but which were once out of the realm of the target audience of any AI stuff, because in the end, it's just a language model evolution. But how can you, as someone who's just starting a startup or wanting to start a startup, identify industries who are close to those tipping points? Because maybe the market's not even there. Like for OpenAI, no one assumed that people use ChatGPT like they do now.
Yeah, of course, this is the big question, also the big challenge, because on the hindsight, it's always easy to say, okay, this was the inflection point, this was the tipping point. If it's not yet reached, it's basically impossible to say. So there are just two, let's say, recommendations. First of all, don't bother too much with where is the curve now, where are we, when will the tipping point come, but just focus on incremental innovation, focus on making the product step by step better, and just hoping somewhere that the tipping point will be there. And when you speak about how to identify, let's say, industries that are close to that, I think it can be useful to look a little bit at new technological developments, like, for instance, what I think it was Max who told it, like IE, for instance. And then you say, hey, okay, there are maybe a lot of markets that have been for years now on this very slowly part of the curve, and now something changed. This can be a technological change like AI, or this can be a regulatory change or something like that, even a political change if you think of the current situation. And then you have to kind of do some foresight. Okay, may this be the circumstances that change everything in this market? And then if you believe in that, you may believe that you are getting closer to the tipping point. You're welcome. There's a question up there.
Simon.
Simon. I can't see you because there's too much light.
So hi, thanks for the great talk. When I joined here, I remembered your background in branding, and I wondered if for rebranding your thesis holds as well. So personally, I think the rebranding that Twitter does to X works not really well, but this is incremental. Like step by step, they change some little thing to X. And as a product manager, I would actually love incremental rebranding because it would make my work much easier. But in general, for rebranding, everyone prefers the big bang, the revolution. So do you have any comments on that question?
Yeah, so first of all, I don't want to speak about Twitter or X or Elon Musk today. But yeah, I think this is an endless discussion. So I personally think it depends a little bit on, as you are a product guy, it depends on the product, you know. Do you do a rebranding because people didn't like your logo, or your tagline is kind of old-fashioned, or all your competitors are now using the same color scheme you use? And then I would always argue for, let's say, incremental change in the rebranding. So change it like most companies do, to be honest. or you have different touch points from offline to online, and therefore you have to slightly change your logo so it works better on mobile phones, this kind of thing. So then I would always say then incremental change, doing an incremental rebranding is the better way to go. But on the other side, if you really have to do a complete pivot, you know, if the product doesn't work at all, and then you will launch another product, or if the target audience you try to address is still not existent and you have to completely choose another target audience, or if you have to choose from B2C to B2B, or you completely change your earnings model. So if you really do a pivot and change big parts of your business model, then let's say bold, disruptive rebranding makes sense, because then you show to everyone, hey, we reinvented ourselves. So it depends if you want to communicate, we reinvented ourselves, now we are something completely different than last week, then do a disruptive rebranding. If you want to keep big parts of your customer base, making them feel assured that everything is going smoothly and everything will stay the same, then go for incremental rebranding.
Any other questions?
I'm really sorry, I can't see the hands because the spotlight is on me. So if you have a question, just shoot. Doesn't seem to be the case. Hey, then thank you very much once again, and I wish you a great rest of the day and a very insightful conference, and hope to see you the latest tonight at the party.
And before you leave, Simon, so it's actually Simon's birthday today. I don't know how old you are now.
I won't tell you.
Okay, he's 30.
Okay.
So we got you a little something, and we hope we can celebrate that later with you at the party.
Thank you very
Obviously
much.
with all of you as well.
Thank you very much.
No,
you want
to
to sing?
Yeah, no, actually, this after the we asked you to sing. We said, let's not do it, but maybe just give a big applause for Simon's birthday.
Thanks. No, when Rainer announced earlier this year that the PodCon will take place October 11th, I was a little bit disappointed because I thought PodCon and birthday, too many highlights for 24 hours. But now I'm changing my mind. Hey, enjoy the conference.
Just a quick announcement for the ones who want to listen to the TCV talk with John Doran. It's being streamed in Cinema 7 because Cinema 5 is packed.
Wollen wir es abschicken?
Also ich bin dafür. Okay.
Ja?
Ihre Druckidee jederzeit online bestellen.
Always get the best for you, for this one and only
Online-Printers. Jetzt testen.
Wollen wir es abschicken?
Also ich bin dafür. Okay.
Ja?
Ihre Druckidee jederzeit online bestellen. Online-Printers. Jetzt testen.
Hi, everyone. Very excited to welcome Jan Thomas on stage now, who actually the talk will be in German, so but I will still announce it in English. So Jan is the host of Startup Insider, one of the biggest startup podcasts we have in the German ecosystem. I think he's interviewing many exciting founders and investors. So if you haven't gotten a chance to listen to it, I very much encourage you to check it out. And so he will now share his experience and I guess inconvenient learnings from more than 2,500 podcast episodes. So Jan, thank you so much for agreeing to do this, especially because you have a lot of other talks as well. You just recorded a podcast live. So I guess before that it was 2,499. So thank you so much and
Cool.
The stage is yours.
Vielen Dank. Hallo. War das also wirklich sehr hell hier. Ne? Also ich freue mich sehr. Mein Name ist Jan Thomas. Ich halte den Talk heute zum ersten Mal, oder diese Präsentation. Deswegen, ich hoffe, wir kommen in 20 Minuten durch. Ich habe wirklich keine Ahnung. Ich versuche es einfach mal. Ich bin vor ungefähr 12 Jahren nach Berlin gekommen, hatte vorher 2 Agenturen in Frankfurt, hatte irgendwann Lust zu gründen. Bin nach Berlin gekommen, bin total gescheitert. Ich hatte irgendwie keine Ahnung, wie das überhaupt funktioniert, dass man eine Idee umsetzt und habe dann aus einer Not heraus angefangen, einen Kanal aufzubauen, das war ein Blog, Berlin Valley hieß der, und ich brauchte ein Vehikel, um schlaue Leute wie zum Beispiel Florian Heinemann anzurufen oder anzugehen und zu fragen, können wir mal reden, kannst du mir mal erklären, wie es funktioniert? Wie hast du das gemacht? Und es war aber einfach nur so eine lustige Idee und aus der ist dann ein ganzer Verlag geworden, rein zufällig, ja, es war wirklich nicht geplant. Wir haben dann Berlin Valley gemacht, wir haben ein Magazin rausgebracht, das hieß The 100, das seht ihr unten links. Haben viele Konferenzen gemacht, veranstaltet mit ganz, ganz tollen Speakern. Und ja, ich bin da so ein bisschen hängen geblieben in diesem Fragestellen. Also ich bin da irgendwie nicht mehr rausgekommen. Diese tolle Idee, die ich hatte, mit der ich eigentlich die Welt verändern wollte. Ich hatte meinen ganzen Freunden immer gesagt, ich mache einen Google-Killer. Da ist nichts draus geworden. Aber Verlag und Fragen stellen war dann irgendwie auch cool. Aber es gab dann so einen konzeptionellen Fehler. Ich habe ja gerade gesagt, ich bin da so reingestolpert und dieses Reinstolpern bedeutete, wir haben eigentlich nie darauf geachtet, was ist eigentlich so die unterliegende Basis, nämlich das Thema Daten. Wir haben immer wieder gefühlt bei Null angefangen. Das war echt so ein sehr, sehr zäher Prozess und dann haben wir irgendwann gesagt, okay, 2020, wir machen das Ganze nochmal neu. Wir schließen, das ist so wirklich dieser Kill Your Darlings-Moment, das war ein bisschen hart, aber haben dann gesagt, wir packen alles unter eine Brand und die Brand seht ihr hier, ist Startup Insider. Damit sind wir seit 2020 unterwegs. Ein tolles Team hier in Berlin, tolle Mission, muss ich sagen. Und wir haben dann, wenn man an so einer Sache arbeitet, wir wollten eigentlich ursprünglich nur Publishing machen, dann war es Database Publishing und irgendwann wird es immer größer, also man wird dann ja so ein bisschen größenwahnsinnig. Ich habe drüben ja auch gerade gesagt, der Anspruch an einen selbst muss ja auch so sein, dass man eigentlich die ganze Zeit das Gefühl hat, man kriegt das gar nicht hin. Und dann haben wir irgendwann gesagt, wir nennen es einfach das Operating System für die Startup-Szene. Und das kommt irgendwie auch gut an. Hier seht ihr unseren Gesellschafterkreis. Wir haben, glaube ich, den größten Gesellschafterkreis, den es gibt. Unten eine ganze Reihe an VCs und größeren Companies, die uns unterstützen. Aber wir haben vor allem auch unglaublich viele schlaue Köpfe gewinnen können, die unsere Mission mittlerweile tragen, die einfach sagen, hey, ist ja cool, was ihr davor habt. Das ist eine Sache, die fehlt und weil sie fehlt, würden wir sie gerne mit unterstützen. Und da seht ihr, also wir könnten jetzt hier 20 Minuten über diese Folie reden, aber sind wirklich tolle Leute, die findet ihr auf unserer Plattform /Gesellschafter, findet ihr die alle aufgelistet, wenn euch das interessiert. Besonders stolz sind wir auf unser Advisory Board, also auf unseren Beirat. Und da seht ihr schon, Florian Heinemann habe ich gerade schon zitiert. Beiratsvorsitzender ist Josef Brunner, ein super Typ, der 4 Unternehmen schon gegründet hat, glaube ich. Das letzte war Relayer, das er dann für 3,5 Millionen verkauft hat. Aber auch Thorsten Murke von Finvia. Pip Klöckner muss ich, glaube ich, gar nicht erwähnen. Der war ja im letzten Jahr hier, kennt ihr wahrscheinlich alle diesen großartigen Doppelgänger-Podcast. Wenn nicht, unbedingt auschecken. Und Christoph Käse, ehemals Vice President von Axel Springer. Jetzt macht er die Axel Springer High und ist aber auch erfolgreicher Buchautor und Podcaster. Also super schlaue Leute. Wenn ich einen Tipp geben könnte, umringt euch mit schlauen Leuten, seid immer der Kleinste im Raum, das ist wirklich, oder der Dümmste im Raum. Das ist total, also hinten raus zahlt sich das aus. Ist hart im Moment, aber nach hinten raus super. Wir haben dann angefangen, einen Podcast zu machen und der Podcast hat natürlich nichts mit einer datenbasierten Plattform auf den ersten Blick zu tun, aber er ist halt irgendwie Teil von dieser Mission, dass wir sagen, wir möchten eigentlich Startups dabei helfen, sich irgendwie zu connecten, mit anderen zu matchmaken oder vor allem auch ihnen eine Bühne geben, um dann gefunden zu werden von Talenten, von Investoren, von Kunden und so weiter. Haben diesen Podcast gestartet, über den spreche ich ja jetzt auch gleich, das ist ja das Thema heute, aber nur kurz für die Verortung. Wir haben jetzt gerade die 2500. Folge jetzt an diesem Montag rausgebracht, also innerhalb von 3,5 Jahren ungefähr. Haben 9 verschiedene Formate, kommen 7 Tage die Woche, 4 Podcasts am Tag. 1000 Podcasts pro Jahr, also eine ganze Reihe und eine ganze Reihe an Arbeit auch. Ich habe ja das Team gerade schon erwähnt. Nina sitzt auch hier irgendwo, könnt ihr nachher vielleicht mal ansprechen und auf die Schultern klopfen. Ohne Team geht sowas nicht. Und sind da mittlerweile bei 300.000 Hörern im Monat, wahrscheinlich also in diesem Bereich reine Startups-Podcasts wahrscheinlich, sag mal, mit Abstand der Marktführer. Aber das ist gar nicht das, worum es geht. Was ich euch erzählen möchte, ist ja eigentlich das hier. Morgens, ich weiß nicht, wer von euch alles Gründerinnen und Gründer ist oder in einem Startup arbeitet. Hier kann man, also in der Morgensendung, die bei uns, also wir haben eine News-Sendung morgens und dann haben wir den Investment- und Exit-Talk und da kommen diese ganzen schlauen Leute hier, kommen da jeden Morgen und geben sich so das Mikrofon in die Hand. Das heißt, wir haben da das Who is Who der VC-Szene, die eigentlich nichts anderes machen, als Startups zu analysieren, Investmentrunden zu analysieren und da mag dann nicht jedes Investment oder nicht jedes Startup relevant sein für einen persönlich. Man lernt aber immer den VC-Blick. Ja? Also, und der ist immer unterschiedlich. Ja? Capnamic, Creandum oder HV Capital und sowas haben natürlich alle unterschiedliche Thesen und die lernt man dort eigentlich ganz gut kennen. Deswegen kann ich euch wärmstens empfehlen, wenn ihr unseren Podcast noch nicht kennt, da auf jeden Fall mal reinzuhören. Wir haben einen Flagship-Newsletter, der kommt morgens, so 25.000 Empfänger. Da ist immer die Mission, wir fassen das Wichtigste von 500 Nachrichtenseiten zusammen. Schön kompakt, ist für viele so Teil der Morgenroutine geworden. Wir haben aber mittlerweile, deswegen diese vielen Striche da, wir haben eine ganze Reihe an weiteren Newslettern rausgebracht zum Thema AI und Investments und Blockchain und was weiß ich was. Kommen auch noch viel mehr und dann ganz wichtig die Plattform. Der QR-Code führt euch auf den Link, aber könnt ihr euch auch merken, www.startupinsider.de. Kommt auch zum Schluss noch mal kurz. Und wir sehen uns da irgendwo so in dieser Gemengelage Crunchbase, TechCrunch, LinkedIn, also eine Sache, die es eigentlich in Deutschland noch nicht gibt oder auch im vielleicht später mal europäischen Raum. Finden wir also ganz cool, finden wie gesagt viele andere Leute auch cool und das ist jetzt hier so eine Sache, da erkennt ihr so ein bisschen, mit wem wir Startups alles connecten möchten oder wer auch untereinander connected wird. Es ist ein großes Ökosystem, aber es ist halt total, und das ist für Startups natürlich großartig, total intransparent, fragmentiert, keiner weiß eigentlich, was Sache ist und da braucht es halt einen, der sich dafür einsetzt. Und ganz einfach die Formel für uns sind Startups Innovationen. Wir sagen immer, das ist so, also Startups in Summe ist eigentlich so eine Querschnittstechnologie, so ein bisschen wie AI oder das Internet oder sowas. Startups in Summe, deswegen sind die auch so spannend für Corporates zum Beispiel und deswegen wollen wir auch bei diesem Zugang ein bisschen helfen. Startups sind eigentlich, wenn man ein Ökosystem voranbringen möchte, unumgänglich. So, jetzt, ich dachte, wie gesagt, eigentlich dieser Talk ist auf Englisch, deswegen sind diese ganzen Folien hier auf Englisch, aber Lesson Number 1. Ein Podcast zu starten ist total einfach. Ihr braucht nichts außer einem Mikrofon, vielleicht irgendeine Schnittsoftware oder vielleicht seid ihr sogar radikal und sagt, ich schneide noch nicht mal, das ist ein Mikrofon und irgendein Hoster. Investment vielleicht 50 €, dann habt ihr einen Podcast gestartet. Ja? Also, und da vielleicht der Punkt, also ich zeige euch erstmal diese Folie hier, nicht das Starten ist das Problem, das Dabeibleiben ist das Problem, ne? Das Durchhalten. Also wir haben die Erfahrung gemacht, also dieses erste Jahr, das seht ihr hier vorne, diesen unteren Bereich, der sich dann irgendwie gefühlt im Vergleich gar nicht bewegt hat, das war schon eine harte Zeit, weil wir immer wieder gefragt haben, okay, machen wir eigentlich das Richtige und also liefern wir eigentlich überhaupt einen Mehrwert, ist das überhaupt die Mühe wert? Auf der anderen Seite, also ja, die Antwort ist natürlich jetzt rückblickend ja, das weiß man aber in dem Moment nicht. Für viele Startups, ich hatte jetzt neulich den Max von Spectrum im Podcast und der hat auch einen Podcast, also der war bei mir im Podcast, wir haben über seinen Podcast gesprochen und der nutzt den, um mit CRM-Profis auf der ganzen Welt zu sprechen, die eigentlich seine Kunden sein könnten. Und das ist, glaube ich, eine ganz spannende Erkenntnis. Da ist ich weiß nicht, was er für eine Reichweite hat, sagen wir mal, den hören vielleicht 50 Leute, diesen Podcast. Aber vielleicht auch 500 oder vielleicht auch 5000, aber sagen wir, es sind nur 50. Was er sich dadurch geschaffen hat, ist ein Zugang zu potenziellen Kunden. Das heißt, er kann jeden Gast, der ein potenzieller Kunde ist, anrufen und sagen, hey, möchtest du nicht mal zu mir in den Podcast kommen? Und alle Menschen sind ja irgendwie so ein bisschen, hey, cool, ich komme in den Podcast, da hat mich jemand gefragt, natürlich mache ich das. Und das kann natürlich zu so einer Kundenbeziehung führen hinterher. Ne? Also deswegen, das ist so niedrigschwellig zu starten und meine Empfehlung ist, guckt euch das mal an. Der Markt ist natürlich total voll, aber diese Nischenthemen und vielleicht weiß man gar nicht, wie viele man kann sich ja vorher fragen, wie viele Hörer brauche ich eigentlich, damit es für mich Sinn macht und vielleicht beim Max, ich würde mal vermuten, da kommt dann vielleicht alle 1-2 Monate ein Kunde bei raus und dann hat sich das natürlich, vielleicht auch mehr, ne? Da hat sich das vielleicht schon rentiert. So, drehen wir mal den Blick und sagen, ihr seid Gäste in einem Podcast und wir kommen jetzt zu den unbequemen Wahrheiten. Holt euch ein gutes Audio-Equipment. Ja? Am besten wirklich ein richtig gutes, aber da sind die AirPods gezeigt, weil jeder denkt, hey, ich habe ja coole AirPods. AirPods sind Schrott. AirPods sind wirklich Schrott. Also nee, die sind zum Hören sind die super, aber wenn ihr in einen Podcast kommt, Wir haben immer wieder Leute, die sagen, hey, guck mal, ich habe AirPods, dann sagen wir immer, bitte nimm die runter, rede über deinen Mac, ja, weil der Mac auf jeden Fall das bessere Mikrofon hat. Aber vergleicht mal euer Equipment, ihr werdet ja wahrscheinlich immer wieder mal eingeladen, vergleicht das Equipment mal mit einem Porträtfoto. Ja? Ihr würdet ja auch nicht, wenn ihr anfangt, auf einer Konferenz zu sprechen oder sowas, würdet ihr vielleicht auch sagen, ich mache jetzt nicht ein Selfie und schickt das irgendwem und dann wird es veröffentlicht, sondern ihr holt euch einen Fotografen oder bittet irgendjemand, der einen Fotoapparat bedienen kann. Und so ist es hier auch ein bisschen. Also vergleicht das mal, weil ein Podcast, ihr habt ja, wenn ihr in einem Podcast seid, das ist so eine intensive Beziehung, die man aufbaut. Das ist fürs Personal Branding unglaublich wertvoll. Ihr habt die ungeteilte Aufmerksamkeit von Leuten, weil Podcast ist ein Passivmedium, das macht man also nebenbei, während man kocht oder joggt oder was weiß ich was. Und dann hören euch Leute zu. Und wenn aber die ganze Zeit dieser furchtbare AirPod-Sound da irgendwie zu hören ist oder irgendwas anderes, ja, also wir haben auf unserer Plattform auch so eine FAQ-Section, wo ihr Empfehlungen von uns seht. Das sind, glaube ich, alles so Mikrofone zwischen 50 und 100 Euro. So 3 oder 4 Stück haben wir da, glaube ich, aufgelistet. Guckt euch das mal an, wenn euch das interessiert. Also es ist kein großes Investment, was man tätigen muss, aber wenn ihr in Podcasts auftauchen wollt, investiert in gutes Equipment. So, dann investiert in gutes Storytelling. Wir merken, da ist ein Zombie zu sehen, weil wir im Podcast manchmal schon sehen, hoppla, diese Person. Also wir holen Leute in den Podcast rein, meistens mit einer News. Das heißt, haben sie schon irgendwie Investoren überzeugt. Nichtsdestotrotz haben sie nicht gelernt, wie man eine Geschichte auf eine andere Ebene hebt. Und wer seine Geschichte nicht erzählen kann, und das merkt man leider im Podcast, wer da irgendwie die ganze Zeit rumämst oder, keine Ahnung, nicht zum Punkt kommen kann, einfach gar nicht versteht, worüber er reden möchte eigentlich, der wird es nicht schaffen, hinterher irgendwie die nächste Stufe zu erreichen. Das ist zumindest meine Überzeugung, ist jetzt nicht datenseitig belegt, aber man merkt es einfach, ob jemand schon trainiert hat, ja, ob er seine Geschichte auch anpassen kann an die Umstände. Also rede ich mit einem VC oder rede ich mit einem Publikum, das ich hinterher gewinnen möchte, für zum Beispiel, um bei mir mitzuarbeiten. Und du kriegst natürlich nur gute Leute in deine Company, wenn du es auch schaffst, hinterher zu überzeugen. Deswegen investiert in Storytelling, vielleicht auch in Media Coaching oder sowas, macht einen himmelgroßen Unterschied und zahlt, glaube ich, total auf den Erfolg ein hinterher von eurem Unternehmen. So, Relevanz ist so ein anderes Thema. Ne? Also wir werden halt zugemüllt mit Pressemeldungen. Da sind viele tolle dabei, aber wir kriegen halt unglaublich viele Pressemeldungen. Und auch da ist es so, nicht alles, was für ein Startup relevant ist, ist für Leute außerhalb von dem Startup relevant. Dann sind Gründer oder Gründerinnen ganz oft irgendwie beleidigt oder traurig und hey, aber wir sind doch so super und wir haben jetzt, keine Ahnung, den Sales-Chef von dem und dem abgeworben. Ja? Toll. Aber es ist kein Grund, um dann hinterher in irgendeiner Form darüber zu berichten oder vor allem nicht dafür in den Podcast zu kommen. Und dann jetzt nochmal die Brücke zum Storytelling, dann fangen manchmal Gründer an, ihre Geschichten aufzublähen. Ne? Dann sind irgendwie so Headlines plötzlich, wir hatten jetzt neulich wir hatten einmal eine Fake News, auf die sind wir sogar reingefallen, das ist also ganz, ganz tragisch dann, ne? Aber wir haben dann auch irgendwie so Headlines, wo man dann halt merkt, okay, hey, wir haben eine 30-Millionen-Runde abgeschlossen und eigentlich, was die Leute aber eigentlich meinen, sind, wir haben eine 30 Millionen Bewertung. Und das ist dann natürlich, wenn du das dann im Podcast mitbekommst, dann hast du eigentlich, ne, dann geht eine Klappe runter und dann in dem Moment ist eigentlich eine Beziehung versaut. Das heißt also Relevanz, aber auch nicht aufblähen. Das ist, glaube ich, ein wichtiger Punkt, bekommen wir leider immer wieder mit. Hängt, wie gesagt, mit dem Storytelling zusammen und hängt auch damit zu tun, wen ihr eigentlich ansprechen wollt. So, dann dieses Thema, also seid ruhig mal ehrlicher, weil ich meine, natürlich möchte jeder über seine Erfolge reden, das ist total klar. Aber ich habe ja gesagt, ich bin irgendwie in dieses Ökosystem reingekommen und habe angefangen, Fragen zu stellen, weil ich das spannend finde. Und man lernt ja nicht von Leuten, die immer nur sagen, bei mir ist alles super cool. Ja? Wir haben ganz selten Leute, die offen und ehrlich und authentisch, und das ist ja eine Frage von Authentizität hinterher, also bin ich in der Lage, darüber zu reden, was bei mir im Unternehmen nicht gut läuft und wie ich mit Challenges umgehe. Ne? Wenn ich mich zum Beispiel von meinem Co-Founder trennen muss oder wenn ich ein VC mit dem nicht mehr klarkomme oder sowas. Solche Themen sind ja eigentlich super relevant, aber die werden irgendwie so ein bisschen totgeschwiegen. Oder wenn es Downrounds oder sowas. Ich hatte jetzt gerade den Raphael Fellmer im Podcast, da haben wir so eine, vielleicht auch, wenn ihr Surplus kennt, an der Stelle kurzer Aufruf, Surplus sucht gerade dringend Kapital und der hat dann auch gesagt, sie machen jetzt einen Downround, einfach weil das Marktumfeld gerade nicht so funktioniert. Sowas also das ist jetzt nicht wegen Surplus, möchte man es eigentlich nicht hören, aber man möchte eigentlich hören, auch mal die Dinge, die nicht gut laufen und dann zu hören, wie man damit umgeht. Und ich hatte neulich den Christian Wegner im Podcast, das ist der Gründer von Momox. Und eigentlich hat er ja ein großartiges Unternehmen aufgebaut mit Momox, da 2000 Mitarbeiter, hat eigentlich mit diesem ganzen weiß nicht, Cradle to Cradle oder Refurbishment und sowas, hat er ja eigentlich einen super Case, wo er sagen könnte, hey, ich habe das gemacht, weil ich Überzeugungsleader bin. Und der sagt dann immer knallhart, nee, ich habe es gemacht, um Geld zu verdienen. Ne? Das war irgendwie meine Ambition. Und diese Ehrlichkeit, das ist halt so eine Sache, die fehlt irgendwie manchmal. Und ich glaube aber eben, man kann also von diesen Dingen, die vielleicht nicht gut laufen und wie man damit umgeht, also wirklich von den Challenges viel, viel mehr lernen. Ja? So, ganz spannende Erkenntnis, das ist mir gar nicht so bewusst gewesen, aber wir stellen eigentlich fast an jedem Podcast so standardmäßig am Ende die Frage, okay, haben wir was vergessen und wer kann sich bei euch melden? Und dann fangen Leute an mit, ja, bei uns können sich Kunden melden und natürlich Investoren für die nächste Runde und wir suchen auch Mitarbeiter und Mitarbeiter, aber was nie passiert ist, und das ist irgendwie schade, hey, mich können auch mal Leute einfach mal anschreiben, die darüber und darüber irgendwas wissen möchten. Ne? Also die einfach sagen, ich biete mal meine Hilfe an, so ich sammle einfach mal so Karma-Punkte oder so. In den USA ist es immer dieses Pay Forward oder Give First. Das hat sich irgendwie zumindest bei uns im Podcast noch nicht etabliert. Und ich habe ja gerade gesagt, 2500 Folgen, da erkennt man schon so ein gewisses Muster. Also es sind jetzt keine Einzelaufnahmen, sondern das ist schon ein bisschen schade, finde ich, und das wäre jetzt so ein Wunsch vielleicht ans Ökosystem. Ne? Also wir versuchen zu helfen, aber eigentlich kann, glaube ich, auch jeder helfen mit Intros, mit Erfahrungen, mit irgendwie, keine Ahnung, mal kurzes Treffen vereinbaren. Fände ich irgendwie schön. So, dann, das ist, glaube ich, ganz wichtig, je nachdem, mit wem, also wir sind jetzt hier auf einer VC-Konferenz. Ich möchte jetzt nicht VC-Bashing machen, aber ich habe ja gerade gesagt, wir haben jeden Tag einen Investor im Podcast jeden Morgen und sprechen über die Investment des Tages. Und was man da halt sieht, und wir haben wirklich das Who is Who, ne, habe ich ja gerade gesagt, Cherry Ventures, Cavalry und alle sind da. Und jeder von denen ist anders. Und vor allem jeder von denen bereitet sich anders vor und jeder guckt anders auf Themen. Und meine Empfehlung ist wirklich, wenn ihr Geld sucht, guckt euch die VCs genau an. Also guckt wirklich, wen braucht ihr, wer passt zu euch, wer sind VCs, die ja, eure Sprache sprechen, weil vieles macht man ja nur so auf der persönlichen Ebene, aber wenn ihr wüsstet, also wie unterschiedlich die sind, ja, ich glaube, das macht total Sinn, einfach mal vielleicht hinterher auch mit Ventures zu sprechen, wo die schon investiert sind, einfach um ein Gespür dafür zu bekommen, wer ist denn da eigentlich der Richtige für mich, ne? Wenn man die Möglichkeit hat, ne? Also Ziel muss ja immer sein, mehrere Termsheets zu haben und dann am besten irgendwie die VCs pitchen zu lassen. So. Dann ist natürlich gerade so ein Marktumfeld, das keinem Spaß macht. Das sorgt dafür, ne, IPO-Fenster ist zu, jetzt, also wir haben gerade schon über Birkenstock gesprochen, das ist irgendwie so der kleine Lichtblick, aber Klaviyo und so weiter wurden erwähnt, aber eigentlich, das führt dazu, dass irgendwie alle so ein bisschen irrational werden. Die waren 2021 total irrational und jetzt sind sie halt anders irrational und da passieren irgendwie, und das ist auch so ein bisschen eine Kritik an der VC-Branche, dass die halt irgendwie alle immer in die gleiche Richtung laufen, alle Herdentiere, ne? Hier könnte auch ein Lemming-Bild sein oder so. Also ne, du warst bei irgendwie Skalierung, Wachstum um jeden Preis, dann bist du auf Profitabilität um jeden Preis, aber eigentlich meinst du profitable Skalierung oder profitables Wachstum. Und das ist jetzt überall gleich und das wird aber in 2 Jahren wieder anders sein. Ja? Und das ist natürlich so ein bisschen, also da sind Management-Skills auch gefragt, da tun mir die Gründer fast leid, weil das immer eine Herausforderung ist, hinterher ein Unternehmen irgendwie auf Kurs zu bringen. Wir hatten diese ganzen Layoff-Phasen und da haben wir auch immer noch, das ist ja alles so der Auswuchs davon. Und dann hast du natürlich Gründer und Gründerinnen hinterher, die eigentlich überhaupt nicht wissen, wo lang. Ne? Und dann, also schönes Gegenbeispiel, wir hatten gestern Bright Capital aus Schweden, eine deutsche Gründerin im Podcast, kannte ich vorher nicht, 60 Millionen Runde. Und die sind quasi in den ersten VC-Gesprächen vor 2 Jahren gescheitert, haben gesagt, okay, da haben die VCs sie weggeschickt. Und haben gesagt, das, was ihr macht, ist eben nicht, wir sehen den Weg zur Profitabilität nicht. Dann haben sie jetzt quasi denen aufgezeigt, jetzt haben sie eine 60-Millionen-Runde abgeschlossen und sie ist wahrscheinlich sogar die erfolgreichste deutsche Gründerin, die ich bis gestern nicht kannte, also hochgradig spannend. Noch schnell die letzten 2 Folien, wir haben noch 50 Sekunden. Also was mich total aufregt, das ist nochmal VC-Bashing. VCs könnten viel mehr machen mit ihrem Geld, was irgendwie aufs Ökosystem einzahlt. Ich habe drüben mit Philipp Werner schon über GovTech gesprochen. Mein Gott, investiert halt mal in Dinge, die die Bürokratie vereinfachen. Ja, das kann doch nicht so schwer sein. Immer zu sagen, das ist ein rotes Tuch für VCs oder die Sales-Zyklen sind zu lang. Die GovTech-Unternehmen, die wir im Podcast haben Sales-Zyklen, die sind genau wie im B2B-Markt. Und jeder ächzt, die ganze Wirtschaft ächzt unter Bürokratie und die VCs sitzen auf Geld und investieren das halt in irgendwie Kram wie E-Commerce. Ja? Also das kann nicht wahr sein. So. Und dann letzter Punkt noch. Die Berliner Bubble ist gefährlich, also alle, die aus Berlin kommen. Man hat dann so coole Ideen wie, lass mal irgendwie, keine Ahnung, das 10. Fleischersatzprodukt auf den Markt bringen oder Käse oder alternative Eier oder sowas. Das muss halt auch hinterher jemand essen. Ja, und da geht's jetzt nicht, also das ist gar nicht gegen diese Unternehmen, das ist super, dass die daran arbeiten, aber der Markt ist halt nicht nur Berlin und der Bio-Store um die Ecke oder die Hausfrau, die nebenan auch keine Ahnung, ist ja auch egal. Also ich will mich jetzt gar nicht verlieren, aber ich will einfach nur den Punkt machen, sprecht mal dann, wenn ihr irgendwas im Supermarkt, weil ich habe jetzt gerade ein cooles Gespräch gehabt mit einem der größten Lebensmitteldistributoren in Deutschland, der sagt halt, die ganzen Supermärkte ächzen unter diesem Kram, der aus Berlin kommt. So, und das muss man sich, glaube ich, irgendwie einfach auf der Zunge zergehen lassen. Also guckt mal, das ist ja dann das E-Scooter-Thema, ist genau oder Quick Commerce, ist ja alles die gleiche Soße. Ja? Also müsst ihr ein bisschen aufpassen, dass ihr eben nicht mit dem Berliner. So, jetzt kurze letzte Folie noch, dann bin ich durch. So, das. Danke. Ja. Okay, also vielen Dank. Ja. Achso, wollen wir noch? Ja, können wir gerne machen. Ja.
Okay,
ja.
Vielen Dank, Jan.
Ja.
Nächstes Jahr wirst du nicht eingeladen.
Ja, ihr macht ja viele gute Dinge. Ne? Ja, also muss man schon sagen. Nur GovTech hat, glaube ich, noch wenig. Ne?
Ja. Ja. Wir haben noch ein paar Minuten für Fragen aus dem Publikum. Also zeigt, da ist eine Frage. Haben wir ein zweites Mikrofon? Ich weiß nicht. Ja.
Hi, also ich hab 2 Fragen. Ich bin tatsächlich täglicher Hörer von eurem News-Podcast in der Früh in der S-Bahn auf dem Weg zur Arbeit. Ist meine erste Aufgabe, wenn ich in der S-Bahn bin. Und eine erste Frage ist, wie schafft ihr dieses krasse Pensum mit irgendwie 2, 3, 4, 5 Podcasts pro Tag, das ganze Jahr durch, seit Jahren und mit, also wirklich nicht nur Blabla, sondern auch hochkarätig, muss irgendwie organisiert sein, orchestriert sein?
Bezahlung erfolgt später, ja. Mhm.
Okay, ja. Und zweite Frage, ihr seid ja selber dann nichts anderes als ein Startup. Wie ist denn da eure Geschichte, euer Pfad zur Profitabilität?
Ja, wird man sehen. Ne? Also wenn du gut im Storytelling bist, dann kriegst du diese Frage gar nicht gestellt. Ne? Ja, also ich glaube auch da, ne, wenn du was baust mit Relevanz und so weiter, dann ist der Case vielleicht ein anderer. Wir sind kein VC-Case. Ne? Wir haben Geld von vielen Leuten eingesammelt, um unabhängig zu bleiben. Das klingt vielleicht ein bisschen paradox auf den ersten Blick, aber wenn wir Geld von 3, 4 Leuten nur eingesammelt hätten, dann wären wir halt so ein bisschen vielleicht Haus- und Hofberichterstatter geworden. Das wollten wir nicht, deswegen haben wir gesagt, wir verteilen das und deswegen benehmen die sich auch alle. Ne? Da ist jetzt keiner, das ist so ein selbstregulierendes System, ist total, also kann ich auch nur jedem empfehlen. Ist natürlich dann im Alltag hier und da auch mal ein bisschen anstrengend. Aber Profitabilität, ich meine, also wir wollen halt irgendwann in diesem Datenspiel mitspielen. Wir sind jetzt auf der Medienebene, aber wir wollen ja Startups helfen bei diesen ganzen Punkten, die ich gerade genannt habe. Aber wir sagen immer, wir helfen beim Finden von Talenten, wir helfen beim Finden von Kunden und wir helfen beim Finden von Investoren, also von Kapital. Und das ist aber so die Ebene. Und insgesamt wollen wir versuchen, aber Startups schneller zu machen. Das heißt, wir gucken uns den gesamten oder Lebenslauf von Startups an und überlegen, an welchen Stellen sind Entscheidungen, die ein Startup blockieren oder wo sie auch Fehler machen könnten, die irgendwie in eine falsche Richtung, wo man in die falsche Richtung abdriftet. Ne? Das kann der falsche Beirat sein, die falschen Mentoren, der falsche Büroraum oder wie auch immer. Und an diesen ganzen Punkten hast du natürlich viele Dinge, wo man immer wieder mal monetarisieren könnte, wenn man das will. Also machen wir uns nach vorne raus eigentlich wenig Sorgen. Aber wir kommen eher so, jetzt bin ich seit 10, 11, 12 Jahren in dieser Rolle, habt Spaß daran und das ist vielleicht dann die Antwort auf die erste Frage. Solange es Spaß macht, macht man Dinge gerne. Ne? Also ich sage immer, ich werde bezahlt im Podcast, um mich mit tollen Leuten auf einen Kaffee zu treffen und mit denen über Dinge zu reden, die mich interessieren. Ne? Da sind natürlich dann manchmal eben Unternehmen dabei, ich habe dir das Zombie-Bild gezeigt, wo du denkst, also das geht vielleicht auch besser oder das Thema bei einem anderen oder keine Ahnung, der auf einem anderen Thema. Ne? Also da hat man so auch seine Gedanken. Aber das sind auch jetzt nicht unendlich viele Startups. Wir haben schon eine gute Selektion. Und dann habe ich ja gerade gesagt, das Team bei uns ist total wichtig. Das ist ein eingespielter Prozess. Also wir hatten jetzt darüber gesprochen, ob wir auch noch mehr Podcasts machen wollen. Wir haben gesagt, nee, wir sind auf einem Punkt, wo wir auch die Hörer nicht überfordern wollen. Wir bauen das jetzt gerade ein bisschen um. Ja, da kommen jetzt wahrscheinlich irgendwie in den nächsten Wochen oder Monaten kommen ein paar neue Formate, weil wir schon sehen, also auch wir können da Dinge anders machen. Aber ja, also es macht halt Spaß. Ne? Ja. Startups sind halt cool, ja, da muss man schon sagen. Ja.
Eine letzte Frage können
wir beantworten dann. David Wortmann, ich habe selber einen dieser Podcasts, Deep Dive Cleantech, und ich wollte mal fragen, wie habt ihr denn damals geschafft, die Reichweite tatsächlich zu erhöhen? Also am Anfang wart ihr relativ flat und seid wirklich dann durch die Decke gegangen. Was sind so die 2, 3 Bullet Points, die du Podcasts für uns mitgeben könntest?
Ja, also das Podcast, das kennst du selbst, ne? Analytics sind total schwierig. Das heißt, wir können auch nur mutmaßen. Ich glaube, also letztendlich haben wir angefangen, Also wir haben mehr gesendet, das ist der eine Punkt. Ja, wenn du mehr sendest, bist du bei Leuten präsenter, egal ob sie dich jetzt hören oder nicht, aber du baust halt eine Marke dadurch auf. Und wir haben dann halt eben irgendwann angefangen, wir hatten ganz ursprünglich 3 Interviews in einer Sendung. Das haben wir eben auseinandergezerrt. Und ich glaube, dadurch waren wir dann hörbarer. Also das war, glaube ich, auch vielleicht ein Anfängerfehler, dass wir hatten so Sendungen, die waren über eine Stunde lang. Ne, immer mit so einer Viertelstunde, also 3-mal eine Viertelstunde oder 4-mal eine Viertelstunde Interviews da drin. Und ich glaube, das ist dann für Leute auch, da wird es dann ein bisschen irrelevant, weil wenn du halt nicht genau weißt, warum du einen Podcast hören sollst, und dann hast du auch noch 4 Leute, das heißt, ich glaube, da waren wir auch in der Kuration nicht so richtig gut. Ja, ich glaube, so ist es dann Soundqualität besser geworden. Also wir sind, glaube ich, wir hinterfragen die ganze Zeit kritisch. Ich glaube, das muss jeder machen. Und ich glaube aber so, also wahrscheinlich ist es eine Qualitätssache hinterher. Ist jetzt nicht so, dass wir irgendwie gesagt haben, wir schalten jetzt Spotify-Ads oder sowas. Ne? So einfach war es dann doch nicht. Ja.
Super, vielen Dank, Thomas. Jan.
Ja, das passiert aber allen. Ja, genau, cool. Ja, danke. Ja.
Great. Our next guest is Lukas Hauser, who's the GM Germany of our portfolio company Dalma, which is in pet insurance. It's a Parisian company originally, and they're just preparing their launch in Germany as we're speaking. And Lukas is the main guy in charge of that. Before that, he's been the GM Germany for another portfolio company of Project A called Cru in digital health, so very different space. And so very excited to hear his thoughts on internationalization in times of crisis. Thank you for being here, Lukas.
Yeah, thank you, Miele, for the introduction, and thanks, Project A, for having me today. Do I just skip all the way through? I can. Okay, here we go. So what I'm going to talk today about is about market expansion. I've been fortunate enough to be part of 2 teams that expanded into Germany in 2 very different times. I'll mostly speak about our recent journey that started a couple of months ago. Please see it as a case study more than advice or a blueprint of how to do it. So this is relevant for everyone who's thinking about going international, who has successfully launched a home market and now thinks about what's the next step in terms of going global. For everyone who's not interested in that at all and just here for puppies and kittens, that works as well. We've plenty on the slides. So Dalma, the company I work for now, was founded in 2021 in Paris. We've grown quite exponentially over the last 2 years. So we have 40,000 dogs and cats now that we insure. And pet parents come to us mainly for 3 reasons: for super broad coverage, for a fully digital experience, so everything can be done via the app and online, and thirdly, because we reimburse claims within 48 hours. 70 people now, and last year we closed our Series A with Project A, with North Zone and GFC, and now the big next frontier for us is going global and going into Germany. The Dalma mission is really to make pet health accessible for everyone and leveraging technology in doing so. So who am I? I'm the GM for Dalma in Germany. Miele already said so. Previously worked for Cru. And when we launched Cru in 2019, the world was very, very different, right? It was, some say, an easier time. And why was that? Mainly because capital was cheap. So the number one goal was growth. I don't really remember any discussions around profitability when we launched the market. And the mindset really was, let's enter the market and we'll figure it out along the way, right? It will clarify. We didn't really have a super strong plan, and it was about speed and it was about growth. Now, 18 months ago, the world changed, and with the war in Ukraine, with the rising energy costs, with inflation overall, and the spike in interest rates, capital became more expensive. And all of a sudden, the conversation shifted more towards how do we get profitable? What does the path to profitability look like? And with expanding, we really need to be very, very careful now how to allocate each and every single euro. So it's about sustainable growth. It's about having a plan, being very clear what success looks like as well. And so we at Dalma, we went back to the basics, or back to the obvious for the sake of this conference, and came up with this 3-step approach that I think is so generic that probably everyone can follow it. And apologies if it's super generic, right? It is super obvious, but I find it quite helpful in our expansion process right now. So step 1 is check if you have problem-solution fit. Number 2 would be then check, do you get to product market fit? And if you check that box, that's the point when you can go to scaling. I'll go into all these points in more detail and also share our evaluation for Dalma and for the market entry in Germany. So problem-solution fit, right? Very simple question. Does the problem that I'm trying to solve exist? If you plan on expansion, that means you already have a home market and you have a product that works in your home market. Do not fall into the trap of assuming that just because it works in the home market, it will automatically work in every other market. Just because it worked super well in France or it worked super well in Sweden does not mean it will work in Germany. And the second part is, does the solution that you have really address the problem that exists? The way you can do this is obviously desk research. It's qualitative and quantitative user research. And what we learned at Dalma is when doing the desk research, during the pandemic, there was a strong growth in pets, right? Cats and dogs rose quite substantially. And maybe just a question here for the audience. Who knows how many cats and dogs do we have in Germany? 15 million, both combined? Yes, I guess. It's 25. So it's 15 million cats and it's 10 million dogs, right? It's an insane amount. And the market is growing quite rapidly. That is one trend we've seen. The other trend is that we see for the first time in 20 years, there's a vet cost inflation. So the way vets price their services has not been touched for the past 20 years. And now for the first time, those prices have increased, which obviously gives us huge tailwinds as an insurance. The even more interesting part is what we learned when we did user interviews and we asked, hey, what is it that you really value when it comes to insurance? Would you even consider insurance? And what we've learned is, number one, everyone wants, if they are ready to invest in an insurance, they want a super broad coverage. They want to be sure that everything is covered. Part 2 is they want to be in control what they need to pay themselves and what is covered. So the limits and all the different pieces that insurance products have needs to be tailored. Number 3, a need for a fully digital experience. So right now, if you look at the market, it is mostly legacy players, Allianz, Barmenia, Uelzner, and so on. And you can imagine that their digital footprint is scarce, and so is the full experience. So that's really an opportunity for us. And the last super interesting point is pricing is not key. Given that pets are considered family, the willingness to pay is quite high. And so you don't have to be the cheapest to succeed in the market. For us, the measure of success here was, would the majority of people we talked to either buy the product or would it recommend it to a friend and even give us the name of a friend? So the majority did, so that was for us, okay, we are good to go and good to proceed to the question around product market fit. Now, there's a distinction between problem solution and product market fit. And I think a good example for this are the quick commerce players, right? Definitely problem solution fit, right? There's people who say, I want a Snickers bar at 10 at night delivered in 10 minutes, and the solution is I deliver them to you. At the same time, the question when it comes to product market fit is more, can you operate a business in an economically viable way? Do you make money at some point? Is there a willingness to pay? And I mean, with quick commerce, it apparently seems to be super, super hard. The way you do this is by testing. You can test some pieces, right? Reaction is, but in the end, the proof is in the pudding when you start acquiring customers and when you see, am I able to acquire customers at a competitive rate? And obviously, continue doing user research as you go. One super, super challenging point when it comes to product market fit is how do you measure it? When do you know that you actually achieved product market fit? There's tons of metrics, right? There's customer acquisition costs, there's retention, there's NPS scores, customer lifetime values. in the end, it depends a bit on what you value most, what is most important to you, what is the benchmark in the industry, frankly, also what investors would want to see when it comes to the next round. I'll share which metrics we chose to measure our success and to measure whether we achieve product market fit or not. Number one for us is the payback period of customer acquisition costs. How many months does it take for us to pay back a user that we acquired? Number two, and this is obviously the reason why we chose this, is because it shows, can you acquire customers sustainably or not? Number two, contribution margin. So that's a measure of efficiency on a unit level, revenue minus variable costs. Where do we end up? What's the percentage, right? And the last point is, what does our distribution mix look like? Do we get 90% from just one paid channel? Probably not super successful, not super sustainable. Or do we have a differentiated mix that is halfway defendable and that can lead to some organic growth down the line? So when we come to CAC payback, how do we achieve it, right? What is our goal, or what is our way to get there? When we launched Krü in Germany, we mostly pushed paid channels, right? It was fine. It was about growth. It was not about sustainable growth or CAC compliance. Now we think way more about affiliates, about brand partnerships, about brand ambassadors, aggregators, all channels that don't scale super rapidly, but channels where you can control how much you spend. And right now, that's what we value a bit more. We, of course, also do paid social, we do search, but the mix looks very different. When it comes to contribution margin, that's then all about what's the variable cost, right? And that's super different in every case. In our case, variable cost is the cost of managing claims that are incoming. And to just use the buzzword once, this is where AI, where machine learning helps. So in France right now, our home market, 40% of all claims are fully automated, right? That means you upload a claim and you get instant repayment. We'll start at 0, we'll work our way up, but that's how we get there, right? By automating the claims, obviously also by refining the product experience. And then lastly, how do we get to a more diversified distribution? In the beginning, I've already said, right, it's going to be affiliates, it's going to be brand ambassadors, it's going to be paid. Down the line, we see a huge potential in high-trust networks like vets, like breeders and trainers, who recommend Dalma as part of their portfolio, who may get an affiliate fee for it, but who mostly enable us for some organic growth down the line. If you have achieved that, right, if you've achieved all your metrics and it's all green lights, then it comes to the easy part, right, scaling, which obviously is not the easy part. It's really hard. You have to take apart your growth engine. You have to look at every piece, optimize, and push the engine to the limit. I won't spend a lot of time on it because this is far out for us at Dalma, so I can't really say anything about it, but that's the plan then down the line. So what's next for us? Next for us is we are in the launch phase right now. So any day now, probably beginning of next week, we'll go live with our product. So for those of you who are pet owners and you want to secure 3 months free, check out Dalma and sign up for our wait list. And to recap and go back, this is it. This is the obvious pattern that I think everyone can and should follow. Check problem solution fit first. See if the problem exists that you want to solve. Then check if you can make it work in your business model and be super precise in what it means, and only then start scaling. Don't fall into the trap of doing a bit of problem solution fit. It's done. Okay, let's go to scaling. That's simply not sustainable. All right, thanks everyone for the attention. And if you want to get in touch, reach out on LinkedIn, send an email, or if you have any questions, I think we'll have time for some Q&A.
Thank you so much, Lucas. Yeah, we'll have a few minutes if there's any questions in the audience. I'm happy to take them. Yeah, there's one here too.
Thanks. Hi, Lucas. Great presentation. Are you also planning to diversify your portfolio when it comes to what pet you insure, like snakes or any other exotic things in planning, or just cats and dogs for now?
For now, cats and dogs, and that's just a matter of scale, right? You need to have quite specific knowledge when insuring certain animal types. As I said, I think with 25 million cats and dogs for now we are good, but never say never down the line, right? Maybe reptile insurance is where it's happening. Sorry, can yeah, so the question was if the regulation in France compared to Germany is very different. It's not super different. So I worked in healthcare before, and it's a nightmare in human healthcare. In pet insurance, it's regulation is not as tricky for us, no.
Great. In terms of your selection criteria for markets in Europe, take us through a little bit, because I guess from personal experience, you know, the screening filtering system that you have is really the key. And tell us what would make you choose Germany above, example, another market?
Sure. So a couple of things. I think market maturity really was an important factor for us. We like markets that are not super mature, where we can grow with the market. And if you look at Sweden, for example, you know, 80% of pet owners do have pet health insurance, or the UK, 50% already have insurance. That's a mature market where we thought, okay, that's a different battle, not the one that we're choosing. That's one, and then we looked at sort of the other tailwinds, right? Market growth, market size, of course. I mean, Germany is the largest market in Europe, and we see ourselves as a European company mostly. Yeah, those were mostly the points, and then the vet cost inflation is the last tailwind was one where we said, okay, then Germany is the way to go.
One more in the back.
Yeah, so just so everyone can understand it, the question was 25 million pets in Germany, is that a lot compared to or relative to the number of people living in Germany? It is a lot, yeah. So France, but I think it's like, it's roughly on average. So I think France is like 10 million cats and 7 million dogs. So yeah, I think it's about the average in Europe.
All right, I think that's it. Thank you so much, Lucas. Super interesting.
Thank you.
We're going on a break now in the cinema because the talk at 1 was moved to 3:30. So I'll see you guys later, and have a good lunch break, I guess.
Wollen wir es abschicken?
Also ich bin dafür. Okay.
Ja?
Ihre Druckidee jederzeit online bestellen. Online-Printers. Jetzt testen.
Test. Okay. Hi, everyone. Welcome to Cinema 4. My name is Henrik. I'm part of Project A's venture development team. And I have the pleasure of playing the moderator over the next few sessions here. So our next session, or rather fireside chat, is about a very unique, a very powerful, and also a very challenged relationship, or marriage, one could even call it. And what kind of counseling is needed in order to make this love story work and successful will be discussed by Julia, CMO from Casavo, Project A's VP of Data and Analytics, Ole, and Jana, our head of demand gen. Thank you so much.
All right, thanks, Henrik, and also welcome from my side, again, back in Cinema 4. I'm super happy to share the stage today with two true role models, one from the marketing team and one from the data team. Julia, marketing from CMO from Casavo, one of our prop tech companies, and Ole, our VP data. And today, I think it's like a perfect fit, and we're playing a little bit brain picking. So I asked him a few questions because I need your advice for some future. Thank you for some future projects. And the reason why I think you are the perfect fit for this fireside chat today is because basically both of you managed already to build this kind of powerful partnership between marketing and data. And with that, I mean, I'm referring to our last project together, Project A in Casavo. And with that, maybe you can introduce yourself and tell the audience what was this project about and why was it so successful.
Hi, my name is Ole. I run data at Project A. Started out as a trainee in online marketing back in the day, so a bit of a marketeer by background. And yeah, today running the team over here and also doing lots of projects at the intersection between marketing and data together with the likes of Jana, with Julia. And that's an interesting experience that we're going to talk about today. It's always very easy to preach best practices and what to do right, what to do wrong. But then in the nitty-gritty of things, it can be troubling at times. And we'll figure out today, I guess, how to overcome and drive this powerful partnership. In terms of the project recap, Julia, I leave that to you.
Yeah, Ole didn't mention that he was my working husband for 5-6 months. Yeah, and everything went good. So that's the starting point. So I'm Julia. Jana introduced me. I'm working as a CMO for Casavo. And I have, few years of experience on how to manage the collaboration in between these two teams. I think that what is important, and we discussed a lot this topic during the past months, it's that basically I think there is a lot of literature on how to solve the conflict between, for example, marketing and sales. But nowadays, this powerful collaboration between marketing and data, it's the base for growth. And I think that's why we are here today.
Okay, perfect. And we are here today because we want to play brain picking, right? So I have this problem right now, my current project. And it's not only me, I think it's a general marketing and data problem. I think marketing and data, they're not talking the same language. And I don't know what's going on because my counterpart, the data team, and I know we have to work together. And basically, what I wanted to know from you, why are both teams, because they know they have to work together, why do they can't get over those kind of challenges? And what can they do to become better in working together?
I think that Ole mentioned something before that it's key on this kind of collaboration. He mentioned I started doing a bit of online marketing. Yeah. And that's important. Why? Because I think that, as you mentioned, the main challenge is a cultural challenge, is a knowledge gap in between what a marketing team knows and needs and what a data team knows and needs. And the reality is that if you can overcome with a strong communication and collaboration this challenge, and one of the things that you can do is to build a cross-functional team where you have people within the marketing team with a bit of expertise on data and people within the data team of a bit of expertise on marketing, this collaboration, this communication can really move forward. And I think that's why my working husband here really impressed me during our project.
I'm blushing. Thank you, though. I would be curious if we play this bit of brain picking to understand where do the problems come from in your project. Is that the data team is not responsive enough, they don't get the request, or it takes them too long, so you have to pull your own Google Sheet together? Or is it, I don't know, the marketing doesn't fully know what the requirements actually are and kind of needs a guiding hand? Where do you think problems really lie?
Yeah, that's a good question, Olaf. Okay, let me think. What could be like the main problem? I think like sometimes I have the feeling that the marketing team, they are missing a little bit of kind of like data skill set and vice versa. Like this shared understandings, okay, what is basically possible within the other department. And with this understanding, I think like the questions could be like more strategic or like more into depth. So do you have any kind of advice how we can transfer this skill set from data and marketing in each other brains?
I think, first of all, the ambition needs to be there.
Yeah,
and
okay,
a lot of times that doesn't necessarily hold true for both sides, where they sort of rather take the blame game and say they just don't get it or they don't use it properly. So like there needs to be a certain ambition, and that's necessarily driven by C-level, to be honest. And that's what Julia did really well at Casavo, just to basically incentivize both teams. Hey, you got to work this out. You got to work together. Otherwise, we won't like meet our targets in a data-driven way. So, but once this ambition level is set, that becomes a really interesting question. How do you sort of transfer skills between both teams? Because marketeers have a full-time job already. They have to come up with creatives, run the campaigns, orchestrate. You know a lot better what you do day to day. So you cannot necessarily expect from them to now also become analysts at the same time. So you sort of have to meet in the middle. But how that handshake looks like requires quite a bit of iteration. Just having all the data available, you cannot like naively assume that marketeers would be able to understand and have the time to sort of leverage this in the way they see fit. So this like definition of the handshake and how this would look like, I guess this is really key.
Yeah, I believe there are some principles that everyone needs to follow in a C-level position, especially in a CMO position, and it's starting from the basics, right? We need to set up common goals in between marketing and data. We cannot have our own OKRs, the data team cannot have their own OKR. We need to have common goals. When you have common goals, that means that you can teach to your teams to really collaborate towards the success on these goals. And I think that the first principle is setting up common goals. The second principle should be let's fix moments together to review as one team every single project. So we need to share. Sharing is caring, and it's not just nice sentences to say, but in this case it's true. Sharing information means that you can really explain why I need this data for and why my company, in order to grow, needs this data being used by the marketing team. And I think this is the second principle. And the third one, I think it's something about feedback, is a constant feedback loop in between the two teams. If I'm not sharing how my campaigns went, if I'm not open to share my failure as a marketing manager, data team can never ever understand what the issue is coming from. On the opposite side, I think that marketing needs to better explain and accept that every decision that it's taken because of data and insights is going to be more effective. And in terms, when I'm talking about being effective, that means that marketing can drive growth if the decision-making process is based on data and insights. Otherwise, it's just a personal opinion, and we need to go, I think, beyond this kind of concept when it comes to marketing.
Yeah, I would agree. It's definitely important to go beyond like intuition, where you have data available. But the reason we're also growing, and we did at Casavo, was that some intuition is key, right? Creativity and so on. You cannot fuel everything by data. So it's not necessarily like everything that could be automated from the team. But where intuition can be replaced by a bit more of a data-driven insight on, I don't know, how much to spend per channel, you should probably do that. But when it comes to designing the new website, I'm not sure if there's a lot of reliable data for it. So how do you decide, okay, this is where I need to bring in the data team versus thanks, but I'm pretty good on my own here with the experience that I have?
I think that every single decision needs to be backed up by data and insights and a deeply understanding of your customer audience. These are the main three things. The reality is, and I'm always, fight a bit with my CEO on it, that is asking me, Julia, but what is going to be the ROI of this huge brand campaign that you would like to do? So yes, for sure, not everything can be measured in the short term, but I believe that everything that can have an impact on the long term can be measured. So it's about also timing. And intuition came when you don't have time to take a proper decision. And that's when I think asking people that have already experienced this kind of campaign, this kind of project, I think can really help you. So it's intuition, but baked by, expert know-how that you can access to.
Yeah, I'm very happy to join these discussions when it comes to like quantifying long-term investments and how do they sort of pay off long-term. I think this is where we can collaborate really well. My question here is, maybe also to you, Jana, looking at the current project that you're facing, should the data team be more accountable for also growth? Like you work in our commercial team, so there you feel super comfortable owning growth, top line, bottom line, while the data team tends to sit a bit on their high horse and say, hey, this worked well, this worked not so well, so I don't know, do whatever you want with this information and we'll tell you again what worked well, what worked not so well. But the question is, should the data team rather also, you talked about joint targets, should the data team also be accountable for growth? And then if things didn't work so well, it's just as much sort of like my mistake because I didn't come up with better hypothesis, bets whatsoever. Is that happening in your project?
Yeah, I go first, right? So definitely what I can see that we were talking about aligned targets in the beginning, and for that reason I would say data definitely has to be responsible for growth as well, next to marketing as well. And what I can see in my current project is that data, it's playing a huge role, but it is not sitting in the same room when we're taking strategic decisions. It's being like the department which is being asked afterwards when the decision got taken, please provide us now with the data. And I think like this is like a gap, and for that reason I would say definitely data has to be responsible for growth as well.
You know why CMOs, we don't want data people within the room? Because we are scared to lose the budget. That's real. So I think that when it comes, for example, to budget planning, and budget planning comes, after the fact that you are able to really understand your channel mix, you have done a bit of, attribution, you have done a bit of channel optimization, and after you're moving into the budget planning phase. I have a lot of people asking me, mainly by, Italian startups, we are a bit behind, I think, compared to France and Germany. So I have a lot of people asking me, Julia, how do you plan the marketing budget? Like, how much, which channels, which ROIs expect? And I think that, for sure, a marketing team is the owner of the marketing budget. But nowadays, I really believe that an entire business plan should be done together with a data team. Because it's the reality is that we have data people not because we need this Excel file transformed into the dashboard in Tableau.
That's exactly what we're doing the entire day.
Exactly, I know it. So I think that the reality is that we should completely change it and work with the data team since the very start. Because if you are collaborating since the very start, that means that also data people are more aware about the strategy of a company and really can help, the shaping of every single decision. And on the marketing side, when it comes to marketing budget planning, I think that as a CMO, I really would like to have a person like Ole as my, counterpart when I need to fight with the CFO. I don't want to be alone in that room, and I think that this is possible when we stop to be, let me say, closed on our own decision making, and we start to open our decision making, sharing information without the, let me say, without the being worried about, I'm the marketing manager, I know how to do marketing, because the reality is that the world is changing and the way in which we need to look at data is changing a lot as a marketing person. So we need those guys. We cannot do it alone no more.
Basically like a mediator between CFO and CMO.
Yeah, I think that, for me, for example, also, this is a concrete example because we worked a lot on Casavo. The reality is that I was realizing, and this was also a mistake, that we were taking decision in terms of scaling up the budget too much while we were not ready from several perspective. And one of the perspectives is, if you don't have a deep dive understanding at campaign level, at channel level, it's like you're blind, right? And I was recognizing that my team was super good in terms of execution, but when it was about, planning in a strategical way, there was a lack of data. That's why we asked the support of Project A and also our internal data team to really give us visibility on what was happening. And I think this helped me a lot when it's come, the latest, reforecasting exercise, I was more strong. And I was able to discuss with our CFO using a common language that was, Julia, you're investing this, so what we can expect. And I was like, we can expect that. And I was quite confident about it.
Thanks for sharing. So I would say check on a great collaboration between both teams. And also, thanks for the advice for my future project at the moment. So now, let's say the collaboration is great, it's given. And I want to understand now from the both of you which can be accomplished when you have a great collaboration.
So what great looks like, basically?
Exactly, yeah.
We talked about this a bit already today. So it starts with ambition from both sides to work together, really on an eye level. Also, lots of interest for what the day-to-day for the other person sort of looks like. So for us, throwing Excel into Tableau and all the other stuff that goes around it versus marketing optimization. And then when we talk about this handshake between two teams, well, it sort of comes down to relevant context that you then have on the other side, and then just iterating on this. And there will be failures, but there will also be wins. You will understand over time which metrics to look at and sort of what to track and what to expect where. I think what works really well for me and what great looks like is just a really clean division of responsibilities. And customer obsession. So the marketing team obsesses over the end customer. For example, for Casavo, there would be home buyers or sellers. The data team should actually obsess over the marketing team as a customer. Because everything we do, this whole data integration, storage, transformation, visualization, this is all plain useless if it's not used properly. So we should probably obsess a bit more over its actual usage, and I guess that's what great would look like.
Okay. As a marketing person, I think that it's when you're moving from, a concept of data quality to data usability. When Ole was trying to sell to me the project, because I bought the project, so he shared with me one slide, and in this slide there was a room full of books, and the books were the correct one. But he explained to me, Julia, if you are not going to find these books well organized in a shelves, your team cannot use them. And I think that this was a really nice metaphor, but this was the key of me buying the project, yes, but also the key of, I explained this project to everyone in this way, also to my team, and I think that the success is when every single member of a marketing team, even the ones that are more into, the brand part, the creative part, are able to use those books.
It's a good metaphors. That's a good feedback.
That's yours.
Coming from.
Use that slide more often.
Okay, that's great. All right. So we talked about giving advice for cooperation. In collaboration, we talked about being what is great. And now I also want to do an outlook in the future. So and also talk about the role CMO or VP data. So with this knowledge we all have right now, what would be the background of a future CMO? Would it more data background, marketing background, or would it be someone super different? I don't know, for example, what about this RevOps thingy, for example?
I think this is something that I'm really every time discussing when I have dinners with other people working as CMOs or, in a head of position within startups and scale up mainly, because I have a strong opinion on it. I think that 10 years ago, 15 years ago, a CMO was someone who was able to be in an intersection in between, a business sense, a business understanding, and the more creative part, the more, okay, I want to do this media mix offline, but this is the creatives. People that were working a lot with external agencies, external stakeholders, I think that now the things are really different, especially in our sector, let me say in tech companies. So the reality is that I'm managing people that are into the brand team, I'm managing people that are in a performance marketing team, and also BI and marketing analyst. So there is a deep, deep verticals with proper knowledge. And the reality is that I need to know a bit of everything, right? So I'm always thinking what a CMO will look like in 10 years, because I'm also noticing that some big corporations are appointing at CMO people that were not doing marketing in the 10 years before.
And does it work?
I'm not sure. But they were coming more from the, business performance perspective, ops perspective, and a lot of people coming from data. Why? Because they could speak the data language. But the reality is that I really believe that should be a mix, because intuition has a part on it. And I'm not imagining, in a 10 years having a CMO that was completely on data, but I see a CMO that probably have done different steps in his careers, even within different kind of teams. And that's why I think that starting to build cross teams, starting to teach to the new generation how to be a better CMO with a more, let me say, data know-how, it's really going to help the entire ecosystem.
Will you be a CMO in 10 years?
I don't know. Let's see.
Will I be a CMO in 10 years?
I think you can, Ole, you can.
I have a limited understanding of the expectation of a CMO today, much less than 10 years. But I look at the pace of innovation, which is pretty incredible in my domain. It's becoming scarily easy to provide clean data in various shapes and forms. Now we're working on this next problem, which is like the gap to not just having data available, but it being used properly. But once this gets solved with better structures, tooling, processes, whatsoever, I still believe that the final level is this whole creativity, intuition part, obsessing over customer needs and differentiating from competition to fulfill them in some sort of meaningful way, which doesn't necessarily require lots of data expertise. So I'm not entirely here with Julia, where I think that the future CMO might still be someone who just looks and thinks out of the box, not looks out of the box, but thinks out of the box, in a very structured and just like super talented way. Because the tech will just, with all the AI leveraging tools now, it will just pick up. So like someone truly super creative. I see that with our team changing as well, right? So this is my uneducated guess.
That's funny because, I'm a CMO and I'm saying like we need more data-driven people, and it's from data, and it's saying we need more creative people. That's why we are really collaborating well.
Powerful partnerships. Okay. Yeah, super. Thanks a lot. So we are running to an end, and I want to give you now the possibility to give me your last powerful advice for this fruitful relationship or collaboration with my current counterpart data team. What would you give me as advice?
The last advice?
The last advice.
I know what helps my team a lot, and maybe it would...
The counterpart is in your team, by the way.
I think like on a day-to-day operational level, really well thought through requests help tremendously, including a certain time. I understand marketing has to make decisions, sometimes very quickly, and the longer you wait for an answer, the much less valuable the answer will be. If I tell you 3 months later, this is what you should have spent, and that's not going to be really helpful. But framing whatever your need with as much context as possible will very much facilitate that handshake, and also saying exactly something about time criticalness. A lot of times when you do that, actually the request will dissolve because you realize, okay, I actually don't need this, or I can take care of it myself. But for the stuff that is remaining, it's very well thought through, and then the data team can go ahead and deliver. That's
Right.
For me, there is one word that is trust. We need to trust each other, because when we trust each other, I think we can really look for growth. And understanding that in this, especially in this context in which I think that a lot of startups and scale-ups are really looking for cost-cutting, profitability, efficiency, that's when marketing and data became a powerful tool.
Yeah.
So I think we need to trust each other and make the other trust us when it's coming to decision-making related to how you're investing one of the main, let me say, budget that you have as a company.
Okay. Thanks a lot for all of the advice. I think I have now homework. So next year in ParkCon, we're going to see each other again. And then maybe this time I can share some advice
Feedback
with
loop.
you. Exactly. We do the same again. And okay, thanks again I hope you also learned a lot and it was interesting for you. And yeah, see you later. Thank you.
Thank you, Jana.
Thank you.
Hi, everyone, and welcome back to Cinema 4. Great to see so many of you. Yes, I think this year at PACON, but also in general in our ecosystem, no other topic is as widely discussed or as much in the headlines like AI, obviously. And I think everybody has been asking, so what is the next big trend? What can we expect as a new innovation coming from AI? And this question will hopefully be answered by our next guest, senior data scientists from Project A, Saman. Give him a warm applause and thanks for the session.
Yes, as Henrik so rightfully said, I think there's no more obvious topic these days than AI. So I think it would kind of be boring to talk about AI because there's so other talks about AI in this program today. So today instead we're going to talk about causality and why I think it's the next big step. Admittedly in AI, but the focus is more on the causality bit, if you can follow me on that. Yeah, as Henrik said, hi, I'm a senior data scientist at Project A. My name is Saman Arefi, and Project A is not only the host of this terrific conference, it's also a VC. And as a VC, working for the data team, I'm part of this VC. It is sort of my job to work with all of the companies of these ventures in our portfolio and talk about all things data with them. So I need to be on my toes when it comes to new paradigms, new architectures, new trends, because when some venture asks me, like Kosava earlier, hey, listen, what do you think of this, this, and that? I should have an opinion most of the time. The other day, I found this little new tool that's been making quite a few buzz, and I thought I would do a little bit of a show and tell today. I'm not sure if many of you have heard of it. It's called ChatGPT. It's making quite some waves, and it's awesome, right? It's terrific. I think a lot of you, if not all of you, have used it at some point in this past year, and it's awesome, right? It's multimodal. It can work with text. It can work with images, and if you think about it, it can really do anything these days. You can ask it something, it gives you an answer. You want something summarized, it does it for you. And there's now this notion that these systems are so incredibly smart and intelligent that they might even have a conscience, and that's a bit that I sort of have a bit of beef with, because as amazing as these things are, as many things as they can do, I don't want to call them intelligent, right? So I have a bit of a problem with the I part of AI, which I want to explore a bit here. It's a very, very confusing term, if you ask me, because it does so many things and involves so many things. We're now going to get up into philosophy here, because intelligence is very, it's not very clearly defined. In my opinion, AI is sort of any system really that mimics some aspects of human intelligence, which admittedly also would include Clippy from those older Windows versions. If you ask Clippy, hey, my hard drive doesn't work, it's going to say, I don't know. But by giving you this sort of very informal answer, it's mimicking aspects of human intelligence. If you go a bit further, we get into more sophisticated matters. That's, I guess, this machine learning part, which nobody calls AI because that's not sexy enough. You might have something like you discover weekly. This is also AI, technically, right? It learns from your behavior, it listens to what you listen to, and based on that, it gives you a recommendation of what you also might be into in addition. Only here in this very bottom, in this deep learning part, we get all of these cool Gen AI topics, like ChatGPT, like DALL-E, like whatever else you have. And these we consider smart because even more so than Clippy, I suppose ChatGPT is able to seem human. It has this anthropomorphic nature to it, which makes us think it's smart, even though it really isn't. Because if you really think about it, and this is a bit cheeky, all of these three things are actually rather similar, including little Clippy over there. Because what they all do in essence is you give them some sort of input, right? You have a problem with your hard drive, you give them your songs, you give them a prompt, and based on this input, they give you a certain output. And in essence, we can actually summarize all of these into a little function. This seems mathsy, but it's easy, trust me, because all of AI really does, it takes some input X, puts it into some bucket, some function F, whatever that is, can be ChatGPT, can be whatever, and gives another output Y based on this. And really, this can be anything, right? I mean, it can be, marketing data. We had marketing here earlier. You give some marketing spend, you might get some sales in return. It can be a sentence in a language you don't understand, and it gives you the translation. And it also could be you give it a prompt, and again, it gives you an image based on the prompt you've given it. But my issue with this is, and that's essentially where I struggle to call these things smart because they don't really understand anything, is that this sort of goes, does it work? One way, right? It goes from one way. You give it an X and it gives you Y. But DALL-E, with which I generate this image, by the way, DALL-E doesn't know what a startup founder is. It doesn't understand why this might be funny to us. It doesn't understand what Patagonia is. All it does is it learned for some reason that these things kind of relate to each other. Because for some reason, startup founders would make this face if told they can't wear Patagonia. But let's talk a bit more about understanding, shall we? Because the way these things work, as I said, is it's basically just an estimation of what's the most probable, the most likely answer. And that's not really smart if you ask me. But let's talk about ChatGPT here, because I think a lot of people are confused as to how it works. So I want to get everybody up to speed. ChatGPT, what they've done is something great. They just took basically all the knowledge out there that is in text and put this into this massive, massive corpus. Includes Wikipedia, Reddit, books, Quora, whatever the fuck. They scoured all of these things and created this massive database, essentially. And what this allows them to do is when you give them a certain input, any sort of prompt, let's say we want to complete this sentence, it looks what it's there in this database, right? And finds similar things that have occurred maybe at some other point. It makes a selection of words that could now follow this sentence we've given it, and estimates the probability as to what's the most likely answer on this, right? So, hello, have a good day. If you take this a bit further away, now we look at something more applied. You could do the exact same thing with, say, the example of marketing data and revenue. You know, we have some marketing data, some marketing spend. It's in relation to some revenue, and we fit a function to it. Now, this is our AI model. And now, whenever we have some new amount of marketing spend, we can say, based on this, we think we're going to have this much revenue. Same exact principle, X into a function F with an output Y. But with this idea, we're sort of restricted to this microcosm that is the data, right? I can't do anything else apart from marketing spend in this AI model here, because I don't have anything else. If I now want to look at sales data, they're like, oh, bro, I don't know. Fuck no, I'm based on marketing. Same with ChatGPT. If you ask it something that's out of its bones, which these things are, they are bounds, they're going to be like, I don't know. I haven't been trained on data later than 2021. That's what it did in ChatGPT 3, right? And this is actually a bit frustrating because you might actually want to do something that's different. Maybe I'm not having a good day. You know, I had hot pot yesterday and I've got a tummy ache, so I'm not having the best day. Or maybe I want to look at something else that's not marketing spend. Maybe I want to look at my pricing. Maybe I want to know, hey, what happens if I increase my prices? How does this impact my revenue? So with these approaches that we're following, these very linear sequential approaches, we're actually ignoring these knobs and levers we have as a business that we can use to control and steer, but we're not using them for whatever reason. And I think that's actually why we should rethink what we're actually after and sort of tackle the same problem from a different angle. And that's designed for causality. Here we are. What is causality? Now, it sounds super complicated. What the fuck is it? So let's do a simple example, yeah? The first form of the definition. The first form of definition is, when we talk about causality, it's basically the science of understanding the cause and effect of certain actions. That's what it means. What are these actions? You know, we call them treatments here. Actions are basically anything that we can use that affects these cause and effects. But again, let's start from an example. Let's say I woke up today, and I'm feeling sick because of the hot pot I had yesterday. Now I have two choices, two actions, two treatments, basically. I can say, all right, I take some medicine, and hopefully I feel better and I survive this. Or I'm going to play the hero, which is what I've done today, and say, no, it's fine. I'm going to be fine. I'm going to survive this, and just go straight to, or I hope I go straight to the survival note here. And this is essentially how causality, and this is why we're getting into the interesting part, differs already from AI. Because if it's only looked at AI, we would look at the severity of my sickness, you know, how bad is it, and see how likely it is that I'm going to survive this. And that's the only relationship I have. Now, with causality, we enter this additional factor of an action, of a treatment, which allows me to hopefully change the outcome. Because we're actually asking now, based on the severity of my sickness, how likely is it that I'm going to survive if I now add medicine, if I add treatment into this mix? And we want to explore this relationship. So we have the exact same inputs and outputs, but now we have an additional T in it as a treatment that allows us to change these things. And the thing about treatments is that either work or they don't. So that's the cool part about it. To either work or don't. We only have two the versions in its path that we can take at any given moment. But let's sort of blow up this example, because me having a tummy ache, it's fine, but let's take a look at how we could actually make this a bit more scalable. Let's say we have now a group of people who've taken this medicine. They're feeling sick, they had COVID, they took the vaccine, and now we're like, hey, does this thing work? Yeah, 2 of them survived, 1 of them died, that's unfortunate. And now we have another group, same exact idea, but it didn't take the medicine. And we actually kind of hope for that all of them died, because this would at least show us that there is a relationship between you taking the medicine and surviving this, versus you not taking the medicine and therefore dying. So we actually want to answer, would they survive if they take it or if they don't take it, and how much is this based on how they're actually feeling? Because it will also very well be that the first group is just a bunch of very healthy lads who wouldn't need medicine anyway, and at the bottom you have just a bunch of very sickly, old, fragile people who die anyway as well, even with the medicine. And you're really after understanding, is that really so? Is that really based on the starting point that we have, which in this case is our own personal health, or can we pinpoint this to this notion of treatment? And that's causality, that's what we want to explore. But enough about medicine, enough about my tummy ache, let's go into some business, because it's PackCon. Let's go back to this example. Let's say we have a business and we now want to increase our prices. That's interesting, right? We have 2 options. We increase the price, and the people are like, yeah, it's fine, don't worry about it, we're going to pay this. Or they're going to be like, nah, that's terrible, I'm off. Which is exactly what happened with the iPhone 15 is now cheaper than the iPhone 14 at launch, fun fact. And this doesn't help us anymore, though, because this doesn't tell us anything about pricing. This doesn't tell us about what happens if I increase my prices. This only tells us what kind of customers, maybe what kind of orders lead to this kind of revenue. Maybe I have old customers, we have young customers, doesn't matter, but what if I increase prices? This doesn't give us any levers. This doesn't give us any control. What we're actually after is something else. We're actually after the relationship between the treatment, in this case the pricing increase, to revenue. That's a bit interesting, because now we have a different model. You see, this looks different now. Because now we have a model that, based on a certain price increase, can tell you how much revenue you're going to make. And obviously, with any price increase, this only goes up to a certain point. You can't raise prices infinitely. But we want to now see what kind of customers, or how can we get to those customers, to those kind of orders, to that behavior at the very peak of this line. Because that's what we're interested in, right? We want to increase price and make more money. But understanding this relationship is essentially what we're after, and that's what we would refer to as causal inference. It's understanding the relationship between this treatment and our outcome. If you do this well, we essentially get to something like this. Now, this isn't very scientific, but I try to make this a bit more understandable. Because what this essentially is for any sort of customer that we have here, each of these nodes are essentially the data we have of our customers, the things we can't change, because customers, if they're old, we can't make them younger. But what we can see is each of these customers now has this different relationship to the treatment. So if you zoomed in a bit, we can see this little customer here has a wide range that they're willing to pay for this product that we're offering them. So we actually can do a lot with this now, right? Because now we understand how the relationship is to this new change that we've introduced to our system. We can do a customer segmentation, very simple, right? We can now engage specifically with all of those customers who are interested in paying more for whatever reason. And for those who aren't, we can maybe send them out vouchers. We can look into price clustering, right? We can see for what kind of products maybe are people willing to pay more anyway, like iPhones. Or we could see, hey, around Christmas, around holidays, people are willing to pay any price for toys for their kids because it's urgent. And putting it down, raising prices before Christmas made me feel fucking terrible. It's worse. You can do targeted marketing, right? We want to see, hey, listen, what kind of customers are maybe the kinds that are willing to pay more? Can we target them specifically? Can we attract more like them? And we can see what impact this has on our operations, right? We can see, hey, listen, we've seen an increase on our customer service tickets because now people are mad at us that we've increased the prices. And now we can make a decision because we know this is exactly due to this action we've taken earlier, to this treatment we've taken earlier, to what we had before. An additional point about this is, and this is something that I think makes all of this so much more tangible to everybody who's not part of this data AI malarkey, is we turn these functions that essentially are black boxes transparent. We don't know really what happens here. I mean, we kind of know, we understand, the maths behind it, but kind of boring anyway. But if you put ChatGPT in there, it's very intangible, right? That's the issue we have with it. ChatGPT gives us all of these hallucinations. We sort of know why, we sort of don't know why. but it's very intransparent, it's very opaque. With some causal magic, you can actually turn these systems much more transparent, because now you see specifically what kind of customers respond how well to certain changes in the system that we're in already. Let's get back to this slide, because coming up on here and saying this is the next big step is a bit of a clickbaity thing to do, right? I'm not here to argue that OpenAI is wrong and I'm right, because I don't really think that having these next big steps sort of invalidates the previous big steps that we had before. We still use the Discover Weekly, and it still works perfectly fine. Clippy, I mean, is dead, but that's just been replaced by FAQs, which work just as well. And I'm sure we're going to have some certain advancements in the field that ChatGPT is doing that we just don't know yet, because it's so amazing what they do. But what we should really look into, and I think that's essentially what I'm trying to say here, is if you draw a line now from all of these top to bottom, we see how we deal with information. And that's what data really is all about, right? We can either access information, we can predict new information, or we can actually generate new information. And that's essentially the paradigms we see between all of these, let's say, tiers of artificial intelligence. And now causality essentially makes all of these into understanding of information. I'm not saying it's sequential. I think it's just understanding how this changes over these tiers. It's very difficult to understand these LLMs, these Gen AI models, but we can understand relationships between different treatments and their outcomes. And that's what causality is all about. Very big stage. Let's sort of wrap this up now, right? Because I think I only have 2 more minutes anyway. We see a lot of fuzz and buzz about all of this ChatGPT, Gen AI stuff, and we see a lot of people in business rooms saying, "Oh, how do we deal with this? What can we do to also use AI in our businesses?" And the biggest problem I see is that people talk about AI again. So again, go back to the previous slide, because there isn't one AI. I mean, people talk about this AGI, this artificial general intelligence, which is able to do all the things for you, but we're not even close to being there yet. I don't think it's going to happen in this decade. But we have to understand that there's different kinds of AIs which all serve their own specific purpose, their own particular purpose, and that's fine. Causal models can't do what ChatGPT does, and vice versa, but it doesn't need to. We can use all of these things for distinct and different purposes. Next, before we sort of start with all of these AI and Gen AI topics, you should kind of be thinking about how to use this in your business. AI is here to stay. I'm not even arguing that. And so is ChatGPT and OpenAI and all of those other guys. But we should make the mistake of now buying into the hype and going for these super complex and sophisticated solutions if they're not actually having an impact on what we're doing. Most of the time, simple and explainable is much, much, much better for what you're doing than the opposite. There is a reason why linear regression, this line I showed earlier, has been around for 150 years, because it works, and it works well. And last but not least, I think causality is only one approach to think about how you can activate all of these levers you have in your business, and that makes sense to think about them more critically. And I feel like I've talked a lot about levers today, because I've never talked about levers so much. So I'm going to leave you with these thoughts now. And if you have any questions, I'm here around. Feel free to ask me any questions, and have a good PuckCon. Cheers, bye.
Wollen wir es abschicken?
Also ich bin dafür. Okay.
Ja?
Ihre Druckidee jederzeit online bestellen. Online-Printers. Jetzt testen.
Hi, everyone, and welcome back to Cinema 4. So before we start with our next session, I would like to do a little survey with you. So among all of you employees, I would like to ask you to raise your hand if you think that remote working and a hybrid working place is a prerequisite for you guys when you start a new job or looking for an employer. Okay, cool. Then a question to all C-level or to all founders of you. Who of you are trying to get your workforce back to the office? How many founders or C-level people do we have here in this room? Can you raise your hand again? Okay, cool. That's very interesting. And with this, I would like to introduce you to Oliver Lehmann, Germany's General Manager of Mindspace, who will now share 5 trends and expert insights on how to make your organization bulletproof to become a hybrid working space. Thank you so much.
Everyone. Yeah, hello. Thank you for having me today. Welcome again, like at the PACOM here, and super excited to share some insights today. So, topic today: how to prove the hybrid workplace, the future hybrid workplace. The next 15 minutes, I will try to give like an overview about the overall workplace landscape as it is right now, and also the employee and employer trends we are seeing evolving on the market, and most importantly, the trends and the ways you might have to go as an employer to also retain your best talents. Let me quickly, first of all, introduce myself. So, as you already did, so my name is Oliver Lehmann. I'm the general manager of Mindspace. We are a boutique global flex space provider, mainly known as co-working, maybe by the most of you. I have right now, I would say, 15, 16 years of experience in the tech industry and in the real estate industry. And this is a quote I took out, which I gave in March 2020 when Corona started, where I was like, I truly believe in this also nowadays, that providing the right workplace helps, first of all, to increase the increase the productivity for the employees, and also to retain the best talents on the markets. I want to share and start off by sketching a quick overview what's shaping the workplace today. And I think like I'm not surprising anyone here today. What I'm saying right now, that we went through a serious shake-up in the last couple of years, caused by the pandemic, of course, mainly. And it seems that the past 3, maybe even like nearly 4 years now, most of the companies are still trying to reinvent themselves. No one has found the secret sauce right now. How can I bring back my people back to the office? How can I provide a workplace where people flourish and are happy in the workplace they are? And I think also being quite sent abruptly at home during Corona showed most of us that jobs can really be done remote. Let's say at least most of the jobs. And that was a good thing. However, there was an impact on the humans because people were like craving for the social aspects, being home. Not everyone has, a garden where they can have their meetings and their walk and talks. They maybe sit like in a 1-bedroom apartment. And they were missing like these interactions with the people, the collaboration, missing the creativity of meeting their colleagues, having just like a chat in the morning and learning from each other. So in 2022, we conducted a survey. There was around 2,000 people across Europe, the US, and Israel. And we asked them what is most important for them when we speak about the current workplace environment. And there was one necessity which absolutely stood out, and that's flexibility. Flexibility is the most important thing people are asking for, and we can put this now into maybe different ways. What is flexibility? Flexibility could be like working hours, could be like the days I have to be in the office, or even the days I have to work, or maybe where I work from. But people are craving and asking for this flexibility, and that's why it's super important. 92% said that this is the most important thing also when they decide for a job nowadays, to have the flexibility. But moreover, we have like the 51%, so half of the people said that they even think, or not that they believe even in this, that they're most productive being in an office. The office is much more than just having a desk and a chair. And I think like this is something we all agree on. It's like no one of us goes just in an office because there's a nice table and we have our computer on there, you know, and maybe like the coffee cup and whatever. This is much, much more why people are coming to the office. Flexibility, much important, but also they want to go back. 69%, they said they even like going back to the office. And we have 60% of the workers. Why do they like to go back? Because they want to have the social aspect, to be, you know, with their colleagues and to be with people like on the ground. 51% said, and again half, they said it's the atmosphere. Again, it comes back to the point that not everyone has maybe like the perfect home and a 200 square meter apartment where they can do whatever they want, and they just want to get out. They just want to feel, you know, being like with people and not being alone. So flexibility, that was the key in 2022. Jumping into 2023, so just 1 year later, so this year, we did another survey and we asked again the people what is important for them. Flexibility is a given right now. No one is asking for this anymore. This is what the employers have to get used to. Flexibility is what employees want. But now there came a new player in, which is well-being. That's a thing, like they want to be like, we know that, again, like a desk or like an office goes far beyond just having the chair and the desk there. It's a much broader concept today. And we had like 9 out of 10 people, they said that employees consider, or they said like employees considering well-being as part of their facilities. That's part of this, what they want. They're not even asking for it anymore. They want to make sure that their employer is taking care of their mental health, of their well-being, of their work-life balance, and that's 90% of the people. So it's nothing what we can neglect. It's something we have to implement in the nowadays workforce and the workplace, what we have seen. 82%, they expect to take care, so from the employer side, that they're saying, I want that my boss, my company is doing this for me. And we have 43% said that the greatest impact for them when we speak about well-being is having flexible hours. And I think that's also for most of us, it's like these 9 to 5, you know, being punctual in the office, don't be late, you can make your 30 minutes break, maybe an hour, and then you can leave at 5:30 at 6. Don't leave before, because then you're not productive. Maybe you're not a good employee if you leave before. They want to have flexibility. That's super important for the people. And we have 25% who said that they prioritize, or the well-being, if it wouldn't prioritize in the company they would work for, they wouldn't feel productive. And also here, like 50% said that a negative well-being would impact them. So we know what employees want now and where they stand, which is a necessity of flexibility and of well-being. But what about the employers? They also have things they're asking for, right? They also want their people to follow certain things. They ask for the similar flexibility from their employees and expect them to adapt even more swiftly to these changes in the work arrangement. I think the return of office mandate, what we see right now from some companies in the world, it's a perfect example. They're sending, you know, the big tech companies, they're asking the people to come back, and those who don't come back to the office, they get penalized. So you either get fired or you get downgraded, you get less salary, whatever it is, but there's a penalization in place. And if we think about, you know, for the past 3 years, companies always have announced changes. First, it was, I think, in March 2020, April 2020, back then still called Twitter, now a company X, who said home office for life. No one comes back anymore. We will never go back to the office is obsolete. And like maybe 1.5 years later, every company was like, well, we are not going back, well, we are working hybrid. Because we do feel that we need to offer our employees like to work part-time from home, part-time from the office. And then another year later, companies are asking everyone to come back to the office. So the question at the end, I think what backs me is, what is the final decision? What will be the final decision? And I think even more important, what is the right decision? What companies also have to take. And while every employee, in general, they feel confident right now to ask for this flexibility and for this well-being, that this is like, you know, not optional, that this is like given, there's also a big insecurity on the market. We have seen this with the big tech layoffs starting around like June, July last year. So who's leading this also? Is it the employees with their demands of flexibility, Or is it like the employers asking, with a return of office mandates and with the cutoffs on the markets, what we have seen and we will still see? So now that we have seen what's going on or what's shaping right now the current workplace, we're selecting like the 5 most important trends, what we have seen from the surveys and the results of it. And I will go into every one of them a little bit deeper. So what we have is, the first thing is a quiet trend. Second one, we have the mental wellness revolution. Third one, a sense of belonging. Less is more. And the hybrid success formula. So what is the quiet trend? The quiet trend that affects both employees and employers. And this is something what we have seen, while the great, let's say, resignation was far from being like quiet, because employees, like when the corona started, they were like leaving their jobs, looking for something new, maybe a remote job, maybe like doing a new career. This is a little bit more low key. It's not actually the trend of quitting a job. The quiet trend, it's something you can even see on TikTok nowadays, which is a bare minimum Monday. So maybe some of you have seen this. This is like where people literally do the bare minimum. The employer is asking me to work 8 hours, I'm working 8 hours and then I go home. But even in these 8 hours, I'm trying maybe not to exhaust myself too much. This is what we can see right now, and this is striking back because the employers, they are coming with a quiet cutting. The quiet cutting is something when, people get put into roles they haven't done before. Things where people are, maybe getting obsolete or redundant in their roles. Structural changes in the company which are happening. And then we even have the quiet hiring. This is when companies are hiring outside. So the people within the company, they won't even realize this because companies are starting to use freelancers. They're starting to use like contractors, which are working outside from the company, or people were asked to take over roles outside their job description and working on completely different things they haven't signed up for. So this is one thing. And then there's a trend of the companies that we can see this also coming a lot, like in Europe right now, but I think mostly started to be driven from the US, this new mental health and wellness concepts. And we can see this with the 4 days work week, which is where countries are trying to set this up. We see this with vacation bonuses. The companies are offering, we have company-wide days off, what we have seen. So different kind of things where they're trying to set up a little bit of this well-being for their employees. And then, back to the employee side of the things, there is ways that people are showing their dissatisfaction at their job. We have career cushioning. Potentially, like everyone has done this already in his career. This is when you work in your job, you're okay with what you're doing, but you're applying, you're waiting for something, maybe a headhunter will contact you, maybe a better job will come up, maybe a better position, maybe a higher salary. You're not in the need of a new job right now. You don't even want to leave the company, but if someone comes and offer you like maybe a 30% salary increase, you might think about this. So you're just, positioning your career, you're waiting for what's happening, you're applying silently, like you maybe like start to develop new skills for yourself, and you all do this while you're cashing out your current salary with your current employer. And then we have the rage applying. This is completely different. These are the people that just want to get out of their job. No matter what it takes, I have to take a cut, I have to take another position, I have to change companies, even the industry, I don't mind. I apply to as much like positions as possible just to get out because I'm done with what I'm doing. And we have the hires remorse. Like I don't know who had this already potentially like happening when you sign up for a job, they promise you a lot of things, or you expect a lot of things because you thought about them, you start your new job, and at day 1, day 2, you realize, tricky, that's not really what I wanted. And it has potentially a boomerang effect, what we also see on the markets where employees, former employees, are going back to their ex-employer and asking to get rehired. If this didn't happen to you yet, you should ask yourself why, because it should be. It's a good sign if people want to come back because it shows you that something is going well in your company. And we have the resentism. This is completely different. These are the people, I just like stay in the company right now. I'm absolutely unhappy, but I'm absolutely concerned to find something. because there's like these tech layoffs going on in the world, and maybe I'm not worth enough. But you know what? Everyone should know that I'm absolutely unhappy. So I will make sure in the company that everyone knows that I don't like my job, but I won't quit on my own. And maybe I count on it that someone comes to me and offers me a redundancy package so that I at least can leave with a little bit of money in the pocket. And we have the hustle culture. Still nowadays like used by a lot of companies, mainly like in, let's say, like before Corona, that was also like part of it. And hustle culture is nothing else that it glorifies, you know, working hard, working long hours for the sake of your own health, for the sake of your mental health and your own well-being. And now employees, they're striking back on the other side. They're saying like, I don't want this hustle culture anymore, because whatever mistake the company is doing, it always gets excused by, well, we need to, you know, we're growing. You need to hustle. Go the extra mile. I think one of the most used words in the tech industry, you know, that people have to go the extra mile. We have to hit our goals. You have to go the extra mile. So working 8 hours, 9 hours, 10 hours is not enough. We need to ask you, you know, to even work more. And this affects mental health. And this is like when it comes to this less is more, people are saying, I'm doing the bare minimum. This Monday culture, I'm coming to at 9, I'm leaving at 5 or at 6, and then I'm happy with what I achieved because I did what the company asked me for. I signed up for 8 hours in my work contract, so I'm doing these 8 hours. And finally, another strong trend, it's the hybrid workplace and the hybrid chaos, what we can see, because a lot of companies over the last year, they did like these trial and error, right? First of all, working from home, then working hybrid, then the return of office mandates, and then on the other side, we have the employees asking, I need flexibility, I need the well-being, I want to have a great office where it's not just about like to come and to sit there, but by the way, it's also my office where I'm sitting right now with my company, it's too far away. Can you rent another one, which is a little bit shorter so that I can save some commute? And it's okay that they're asking for it. Who wants to travel 60 minutes, 70, 90 minutes every day for one way and then going back home and being like 2 hours or 3 hours on the road just to come on and being in the office? No one wants that. So companies also need to think about this. And at the end, I think like who can ever like gap this bridge, you know, between the employer needs and the employee needs, because it didn't happen, who will also win the game. So it's a step what employees needs to do, but also a step what employers needs to go in the future. So let's summarize how companies can future-proof their hybrid workplace and to also retain their top talents, because I think that's what it's all about right now. Even with all the tech layoffs going on, usually the top talents, you always try to keep them in your company because they're the ones which are also running, you know, your company and bringing them to success. We have, first of all, the work-life balance. Again, this is like where employees are checking out. You know, they're doing the bare minimum because they don't feel that the employer is providing enough resources for a better well-being, for a better resources, a better healthy balance. So that's one thing, you know, to change. We have the second one, which is the purpose. Like employees, and I think every one of us, we want to feel a little bit of like appreciation. So I think it's super important that an employer also to show them you are like an appreciated employee. You know, it's like showing it also in public. Don't praise people like 101. That doesn't matter at all to them. You should always praise people in public. Work from home or not, I think companies needs to clearly start to communicate this. It's still absolutely unclear. If you look at job descriptions nowadays, it says remote. Now on LinkedIn, you can see they started to change this. It's remote Germany, because, you know, in Germany, you cannot really leave the country for more than 6 months and 1 day, and then being taxated in Germany, you're taxated then in another country, but you know better about this. So remote is not really possible. Work from home maybe is possible, but clearly communicate. What do you want as a company? Do you want them to come back? Then tell the employees, and then they know what they sign up for and what they go into. Or you want to offer them the hybrid workplace, then do it. But like communication is absolute key on this. The wellness amenities, without flexibility, there's definitely negative impact on employees' well-being. That's for all of us. So we need to provide also the resources, also within the office, that they can frequently unwind people, you know, that they can just feel like there's like a place where they can go to, where they feel productive, where they feel connected to the company, and where they feel they also want to achieve something. And we have the career expectations. I think that's also absolutely like a necessity for people, for new hires, but also for existing employees. Like, if you want people to grow, then communicate clearly to them. Give them the expectation. Horizontal growth, vertically growth, no matter what it is. But absolutely, like here, communication is the key and transparency is the key. If there's no growth right now in a certain position, let's be honest to employees and tell them that there's no option right now, but maybe something is lining up in the future. Like, keeping people with a lie will never work out, and short term, they will all leave companies and going somewhere else. This is, by the way, what we precisely do. We literally aim to ensure that every company, no matter which size, that they can, find the right workplace, that they can flourish. We have companies that are coming in, they want to grow. We are here. You want to size up, we will take care of it. You want to size down because of your valuation went down, you don't have the finance background right now that you can take all the space you have, then we are here for you and help you with this. But even moreover, when it comes to the well-being. And again, companies are coming to us, they're saying we have people, we need to bring them back to the office and we struggle, we don't know how to do it. So we are doing it for them. We're taking care of the well-being, if it's weekly happy hours, if it's a manicure, if it's a hairdresser, if it's a massage, whatever it takes, then we're taking care of it, and it's for some of us even funny to think about, going to the hairdresser while you're in the office. Yes, it's something people really love to do because it also saves time during the day while you're doing it. You don't need to spend your private time. We're doing this with 15,000 members right now globally, so it's not a test. It's a global thing. As a quick overview, we are operating now out of 7 countries. More than 20 cities and more than 45 locations. So it's a proven concept. It has also withstand, not just a pandemic, but we are doing this over a decade right now. And that's from my side. First of all, thank you so much for having me. I hope that I can provide some insights on what you can do. And let's see what the future will hold for every one of us and how the office will look like in the next 5 years. Thank you, guys. Danke. Gebe ich ihm, ne? Raus hier, ne?
Wollen wir es abschicken?
Also ich bin dafür. Okay.
Ja?
Ihre Druckidee jederzeit online bestellen. Online-Printers. Jetzt testen.
Hi everyone, and welcome back to Cinema 4. So after a delayed flight and a very turbulent journey, I'm super happy to welcome on stage Antoine, founding partner from Felix Capital, and Miele, investment principal from Project A, who will now talk about the latest trends, investment trends, in consumer tech. Thank you.
Okay, the music ends. So, hi Antoine, thank you so much for being here. I think he doesn't probably need any introduction, but I'm still going to try. So Antoine started a fund called Felix Capital almost 10 years ago, I think, based out of London, and they're investing across various stages, both in B2B and B2C. But I think they're especially well known for all the great brands they have invested into on the consumer side, such as Heißnobiety here in Germany, for example, a famous example, Midgery in Canada, which I think is an amazing one. And there's a few more popular consumer brands like Peloton, Van Move, and so on. So really excited to chat about consumer investing in 2023 and beyond, and how I guess we're seeing the future of consumer investing in a world where a lot of investors pride themselves with investing more or exclusively in B2B, with consumer multiples in the public markets being even more down than multiples in B2B. So how does that basically affect the investment strategy of a fund that does both? So Antoine, welcome. Welcome on stage at the Project A Knowledge Conference. And I guess it's been a decade now, so how do you look back on the last 10 years in consumer investing?
Thank you, Mila, and thank you, Project A. It's really a massive production, so really exciting to see many people in Berlin. It's not 10 years yet. It's been 10 years. It will be 10 years soon. We've been working on the ambition to build a brand in venture capital, which we felt was a somehow unbranded market, or a market where most of the firms stand around testosterone and big ambition and so on. We wanted to build something more personable, and which address our thesis, which is looking at shifting behaviors and cultural shift happening across the world, empowered by digital, by the smartphone, and opening the door for creators to build new propositions, which are much more relevant to our expectation today as people, as human, as consumers, as employees, and that's a bit in a nutshell what we do. And what makes us a bit contrariant in the market is we do believe a lot about the power of brand, indeed. But you wouldn't find the word consumer on our website because it's not exactly how we think about the world, even though we do invest in a lot of businesses selling to consumers. How things has evolved in 9 years. I think a lot of things have changed, both on the SaaS world, of course, but if we go back to this behavioral trend, cultural trend, a lot of things have changed. And we can go into detail both on the valuation side, I mean, how we're thinking at it as investors building a portfolio, but if we just take a step back, the way we eat, the awareness we have around the dairy industry, around meat, around how we take care of ourselves on the day-to-day from a fitness perspective, from a mental health perspective, all these kind of concepts that were completely inappropriate 5-10 years ago, talking about burnout or whatsoever. Everything is changing, and I can go on. It can be also our relationship with money, the aspiration for a better life in many different fronts. Everything is changing very fast, and that's our thesis. And if anything, it's changing faster than before due to all these micro moments we are enabling through the smartphone, through communities we empower digitally and that enable us to connect with people globally, and through amazing new generation of entrepreneurs and creators that have this ability to understand the end user, has the ability to understand how to crack community because they're actually building something authentic, but with the support of people like us that enable them to take more risks, to go faster, to penetrate faster big verticals. And that's what we are here for with Felix. And we're not going to win always, but we did. We were first investor in Farfetch, transforming fashion. We were investor in fitness, in Peloton, transforming fitness. Even in Oatly, transforming the dairy industry. Some of these companies are not trading super well on the stock market these days. At the time we invested, it was very exciting and very ambitious. Sometimes, by the way, it's self-inflicted because like any founders or management team, sometimes you execute well and sometimes at some point you execute less well, especially when you have a lot of money somehow. But I'm getting maybe to your question. I still do think that it's an amazing time to invest in consumer. And just today, we've got the Birkenstock IPO. I think it's trading around 8-9 billion. This is 6x revenue. This is, I don't know, 25x EBITDA. You have companies like On Running. I mean, it's just 2 data points, but it just gives you a sense of the fact that it's about finding, it's not about backing everything in consumer, it's about trying to back the ones that are really transforming something and that are very authentic to a community and that have this kind of big ambition and can make it happen. In the case of Birkenstock, it's a company which is, I mean, it's a German business originally, which has been there for decades and decades and decades. In the case of On Running, it's a 10, 12-year-old company. So it gives a sense of how quickly you can make this transformation happen.
Mm. And you were mentioning companies like Oatly, like Peloton, transforming fitness, Farfetch, transforming fashion. And you invested in a bunch of these quite early on, right? And also in Miele, for example, which I think is less known in Germany, but if you go to the States, if you go to New York, there's like, it's all over, right? So they're doing jewelry, by the way. And so if we, as someone who's, we're also doing kind of consumer and B2B, but we're obviously not this great at kind of identifying brand value at an early stage. And whenever we see a company where we know, okay, anyone could come around the corner, have a good supply chain and start a new jewelry company, we struggle to kind of understand at an early stage, why will that be the brand that will be all over billboards in New York? Everyone will be talking about it. Peloton, I mean, obviously everyone in this room knows Peloton, right? So how do you assess the potential of the brand at an early stage when you look at a company?
It's a good question. I mean, if you want to zoom in on Miele, which is not yet present in Germany, but it should come soon. Again, if you take a step back and you go back to this behavioral shift, the industry of jewelry and the high-end premium jewelry industry has been forever, the advertising has been focused on the man, the husband, the lover, about buy something to your wife, to your mistress, to whoever. That has been what people has been put on their face is not about treating yourself. It's about you need to buy something for your wife. It's a birthday coming. Go and buy it. In the case of Miele, they changed it. It sounds maybe obvious right now, but you know, back in 2017, Nora, the founder of Miele, she said, okay, let's actually focus on the women. Let's focus on and let's give them the appetite and the envy to treat themselves with the right price point, with the right product, both in terms of design and quality. It sounds simple, but it's shifting completely the paradigm. And once you can do this, cracking also communities on social media like Instagram and so on, it's very powerful how quickly you can grow. Especially if you combine with someone, there's always a journey, a founder journey. I mean, at least in a lot of the companies we love backing. Nora and her husband, because it's a husband and wife business, they're Jordanian, and they started this. It's been a family. There's a family dynasty of dealing with precious commodities, with gold, with silver, and so on. They've been entrenched into this all their life. So very quickly, what is actually very hard, which is all the supply chain, the logistics, and so on, the price of a commodity to deal with, and the margin that comes with it, that was unlocked very fast in the model, and that enabled to provide a many more connection with the customer, because every Monday, at the time from day one, she was doing drops of new design, new product, and like this, you can just build even more micro connection with all your community that you're building. And we started tracking this business, this company, as an outbound thinking around this category that needs to be reinvented in the way we communicate between brands and the end user, the customer in this case, the woman in this case. And very quickly we saw this company when they were, you know, doing $50K, $100K monthly, which is still good, but a bit early for our fund. And over a year, this company went from 100K to $1 million with not raising any money. And that's also an attribute we love, is people doing a lot with very little, which hasn't been a trend in the last few years, but finally we're back to this, thankfully. And at this point of time, we had built already the relationship. At this point of time, we say, we would love to work together. To be fair, our only concern was, why are we the only one discussing with this company, which is now valued above $1 billion and so on? Why are we the only one? I mean, why there's no, it's not like the US market has no money or no VC or no consumer DNA. I think, frankly, at the time, the US VCs were somehow lazy to go and see what's happening in the neighbors in Canada. But we were the only one discussing with them around, and since then NEA come in and so on. But it's been a fantastic journey.
Yeah, super interesting. That's great. So are you saying also that consumer founders usually have more of an obsession with brand? And do you think that, that's generally, I guess back in the days, there used to be much more of a difference between B2B founders and B2C founders, right? But it seems like with the trend of product-led growth and brand also becoming more relevant in B2B companies, that's kind of moving closer together, right? Would you agree? Or are the founders in consumer still very different from the ones that you're seeing in B2B?
It's converging, and that's why we love it, because it gives us a bigger playground to play with on our side. So that's why, since we're now investing with our fourth vintage, our fourth fund, and with this, we decided to go into the future of work. If you remember what I was saying at the beginning, we focused on the end user, and now we see a lot of new products, SaaS software and so on, built for the workplace, targeting the employees, and where you see exactly the similar patterns that you see in the brand building of a consumer product, or someone going after consumer or people at home or whatsoever. So this is something we're looking at very closely, and where we want to play a big role, because the same pattern around community building, brand building, and so on. A lot of, when we started investing, the stereotype of a tool for the workplace was Salesforce. Salesforce, this generation of software were built to sell to the CFO. They were the buyers. And things are shifting. I mean, and you guys have been doing SaaS even deeper than us in the past 10 years. Things are changing massively on this front. Cracking the community. There was this movement around PLG, which was product-led growth with the Slack and so on. That was the beginning of opening the door to say, we need to first do products that people love using. It sounds basic, it sounds simple, but as soon as you enter this world, you enter our world. Again, because we're not a consumer fund, we're a fund focused on the end user. And when you have entrepreneurs, creators that are very focused on the end user, it talks to us a lot.
Okay, and you invested in a company that I want to talk a bit about that's in B2B called Miracle in Paris. So maybe you can share a bit of their journey, and then I'd love to learn more about how kind of the journey to unicorn and beyond of a B2B company looks different to kind of the companies that you've brought to IPO, for example, on the consumer side. Like what differentiates the journeys of those companies?
Listen, the B2B, I'm trying to answer this question without having a bias, as one of the founders of Miracle happens to be my brother. But
I didn't know.
You didn't know? But it's not the reason why we buy. It would have been the reason why not to back them.
Not? Yeah, exactly.
but when we started Felix, the core was to back a lot of branded play. And again, when we talk about branded proposition, can be physical product, can be platform like marketplace, can be content play, and more, as we just discussed, and the tools for brands and retailers. So all the enablement stack that helping brands and retailers to offer a more relevant experience to the end user and to operate better, more efficiently, and so on. And Miracle fits exactly there. And so Miracle power the marketplace technology for any retailer who wants to start plugging third-party merchants on their platform. And actually, both for B2C or B2B use case. The beauty with the ecosystem we've started to create from day one is that we have the brands on one side, we have the retailers on the other side, and we have the LPs also that are all CPG, big retailers. They're not big in our funds, by the way, but we wanted them part of our journey, and they wanted to be part of our journey, to have this kind of dialogue about disruption, what they can do better, and so on. And when with Miracle, what happened is there's a personal journey in me thinking this is now the time to back my brother, is because it was his third venture. He had done his first company in New York. He was back to Paris, and he was ready to move back to Boston, not to do the American dream, but to build a very, very big business. And that was on the back of having signed the first blue chip clients like Galeries Lafayette or Carrefour or Darty, La Fnac, and so on. Miracle was actually the output of a company they previously sold, which was a marketplace for the gaming industry, actually. And they were just putting it as a white label and starting to sell it to any clients. So there was a lot of ingredients we like to see, proof points that big clients, big enterprise clients were ready to jump in and deploy this kind of technology. You had founders ready to go finally, they did great before, but it was really ready to go for something venture back at really big scale. And we could be very relevant because we could push a lot of these commercial discussions, which we did since. And I would say that to answer the second, so that's the reason why we wanted to come on board. We came on board at Series B due to the relationship we didn't price around. It was a fund called 83 North, which is an amazing fund in Europe and in software and marketplaces, actually. Bain Capital led the next round in the Series C round, and you had the Permira and Silver Lake. Go back to your question, what's the journey for a B2B to B2C? You know how it is. The B2, there it is that a lot of our peers and colleagues are more comfortable in the SaaS world because you can make decision just based on numbers. You put numbers on a grid. Does it fit? You know, it's this amazing 0.9 napkin, which is one of the different Bibles people use. You put your 0.9, you put it on Excel, you put the numbers. Does it look good? It doesn't look good, and so on. And some people actually invest like this. When it comes to B2C or consumer, you're starting to touch intangible elements. And actually, it's even intangible in terms of accounting term or financial term, because a brand is an intangible asset from an accounting perspective. People can't put value on it, but except we call it the goodwill. But the goodwill is what makes you a very big success or not. It's what makes a strategic asset to someone or not. And this thing is either you can feel it or feel connected to it or not. And it's I would think you're in a much easier, better comfort zone if you just need to look at numbers versus having to think about, but it's not rational, because if you want to be rational, you always say a brand, no barrier to entry, everyone can do it, it will be disrupted. And maybe you're right, by the way. I'm not saying it's easy to invest in consumer. I would actually argue that right now it's easier to argue to invest in consumer because there's much less noise and you can build much better relationship. But I think it's this kind of intangible element that is harder to grasp for traditional tech-first investors, I would say.
Mm. And of the almost 10 years that you've been doing this now, obviously so many things have changed, especially over the last couple of years, and then sentiment in the public markets for consumer companies has probably not been worse. I guess at least, you know, if you look at the last 5 years, it has gone tremendously down. Multiples in consumer are even worse now than in B2B at the moment in the public market. So how does that, or does it affect your investment strategy in any way? I mean, you obviously also have investors that you sell Felix to, right? So how do they see it? Are they excited about the fact that you're very different from other funds and one of the only ones managing to do brand investing this well in Europe, and that's why they continue to back it? Or like, how does, I guess public market sentiment and LP sentiment affect that strategy?
I think we're lucky that our LP base, the core of our LP base is institutional. It's endowments, pension fund, and so on that have dedicated program to venture, and actually want to back the weird guys, Felix, at the beginning, because we're doing something a bit different. We have to prove throughout the generation of fund that we're doing it well. But let's not have short memory. I think, again, there's perception in the market, and behavioral trend of LPs, VCs, and so on. And there's already, no one can argue that investing in a company at a lower multiple is better than a higher multiple. I mean, we are long-term investors. We are early-stage investors. We will go through cycles, and the cycles repeat themselves. When we invest in a consumer or not consumer company, we think 5, 7, 10 years, 15 years down the line. When my partner put the first ticket in Farfetch was in 2008. He was still on the board when they IPO'd in 19 or 18. It's a journey, you know. And when the investment memo in 2008 didn't expect to do an IPO either at the time. So that's the beauty of early stage. We go through the cycles. We are actually more excited to invest at a lower multiple with less noise, less competition, than when it's really noisy and people are splashing, the cost of capital is very low. Here you can build real partnerships, which are very interesting. And again, it's not, you know, and I'm quite thankful because in the last 2 years, it's been, you know, since 22, right, it's fairly shit, frankly, since sadly the war started in Ukraine. In the last 2 years, we've sold 3 companies. They're all 3, well, we sold, by the way, it wasn't our decision in all the situation, but we had 3 exits, actually 2 German companies. It was 3 great outcomes. One is in kids content, a company called Moonbug. We were in the first round in 18, we sold it for 3 billion to Blackstone, a company called Kendall Media. High Snobiety, David Fisher, we sold it to Zalando end of 22. And in April this year, we sold YFood, another German company, to Nestlé for 500 million, 3 years after doing the first round or second round of investment. I'm not saying we are rainmakers at all, but again, if you back the right companies, if you back the companies that are doing something that is relevant in a specific category, it would be strategic to someone. And actually, if it's something interesting to see right now is between High Snobiety or YFood, you have 2 companies that has been acquired by big European industrial player. So actually, the market is dynamic here. We always complain that there is no liquidity in Europe, but actually there is liquidity. There's not much IPO, we could have more IPO, but you just have 2 big European industrial players making big bets. I mean, not at this scale, maybe not that big, but significant bet. And, you know, seeing that they were disrupted somehow, they can gain a lot by getting this kind of asset and doing it. So maybe 2 years before we would have sold this company better, but I still think, you know, it's a long journey, what we all VCs into, and let's not forget it's a long journey. It's the same journey that entrepreneurs, frankly. I often say that it's, you know, our world is, you know, I happen to teach in 2 different universities, and when the first class are around the metrics around VC outcome, and we're talking about 5-10% of our industry capturing most of the carried interest out there, and it's mirror a lot what's happening in the entrepreneurial world of VC-backed companies, actually.
And would you like the sentiment amongst European VCs to change, to be cooler again, or do you not want it so that prices will be low, continue to be low?
I think what we should make sure is to be very humble and understand the luck we have to do this industry, to do this what we do, and to partner with great people and build this unique journey together along the long way, unique relationship. They are the one building the journey. No, I think, you know, if you from 2000 to 2014, there was a lot of power around the VC because there was no money out there, and that doesn't create good relationship. That doesn't create good alignment with founders. We went into a zone where there was the payback of the founders, you know, the payback of entrepreneurs with the cost of capital being so low. Now things are level it up. I don't know, sorry, excuse my French. But I think it's a good playground to build actually very authentic and good relationship now.
Yeah.
I'm excited.
That's a great closing word, I guess. So if anyone's here who wants to build a relationship with Felix Capital, I think Antoine will be around for a little longer. So thank you so much for being here and taking the time to do the panel. And I hope everyone enjoyed it. And let's give Antoine a warm applause.
Wollen wir es abschicken?
Also ich bin dafür. Okay.
Ja?
Ihre Druckidee jederzeit online bestellen. Online-Printers. Jetzt testen.
Wollen wir es abschicken?
Also ich bin dafür. Okay.
Ja?
Ihre Druckidee jederzeit online bestellen. Online-Printers. Jetzt testen.
Luckily, it's fake, you know.
It's, yeah, I don't want to burn the hands here.
Let's go, Craig.
Okay, great. So Tony and I worked together when Tony was at Falcon Social, and there was about 4 or 5 years of all kinds of ups and downs, more ups than downs, but so choppy waters for the company. So what I wanted to do was have a discussion about how we saw that. So Columbia Lake Partners, we did loans to Falcon through that to finance the company, and how Tony and the management team and the board saw what was happening and the interaction on both sides of this equation to ultimately lead the company to a very successful exit. So, Tony, if you can take just a moment and describe Falcon, what it was, how you got involved, and how the company grew.
Happily. So Falcon is still, well, the brand doesn't exist anymore because it's now folded into, I think, Brandwatch Incision. But Falcon was a social media management platform. So at the eve of, hey, Facebook, Twitter, all of that stuff, you basically needed a management tool in order to, facilitate being on those social channels for all the employees or for the social media managers that they basically had, right? When I joined the company, I think we were like 5 or 6 or 7 or 8 or 9 or something like that people. We were practically at 0 million AR. I think we were like 500,000 in or something like this. And then over the span of, I think what was 7 years, we got to roughly 50 million in ARR and exited the company to stock-listed company called Cision out of the US, actually. And throughout that period, I had a couple of different roles there, actually. One was, looking back, I was never called that, but looking back now, we know this was revenue operations. Yeah? Spent 3 years also in the US, building out the US office there and the US market. And then eventually became CRO, Chief Revenue Officer of basically kind of that whole business, covering all marketing, sales, and CS was around 15, 20 million, something like that.
Okay. Okay, and then when we first got involved, you'd raised capital from a couple of VCs, and we're looking at doing a fundraise, and we put a combination debt and equity deal together, which gave some flexibility to draw capital to be able to really extend out the runway of the round that you had. So that was like a fairly standard post-Series A top up a round with some debt to be able to give you optionality in running the business. Now, you had some options in that, and I know you were involved in that decision. How did you guys approach, maybe we want debt, maybe we don't want debt, who do we want to work with? What were the things that you looked at?
So, I mean, when you put together the round, you always, the bedrock is always the equity part, right? Kind of you need to get that right. And then it's almost like an add-on, like a padded round almost. Kind of you think then about, what are other components we can use in order to, make the press release bigger, have more money on the bank account, and just maybe raise a little bit more than we really actually needed, which is, it always sounds a bit funny when you say that, but I think it's extremely helpful for you to have that flexibility later on. And then we looked into, what are the different options on the venture debt side, frankly, right? And there are a couple of providers here in Europe, there are a couple of providers in the US. I think this actually was like
16,
7, 8 years ago or something like this,
yeah.
right? Maybe the landscape has shifted until since then a little bit, but we basically kind of went out to try and figure out, what would be the parameters of us getting something like this, right? And I think a venture debt round is always it's all a bit more comparable and transactional, I feel, than the equity piece, right? There's always like, hey, where are you in ARR? Okay, we can offer you kind of this kind of round size for this percentage, and then there's an equity ticket kind of connected to this, and it's really easy to fall into this numbers game and just comparing those different pieces. I think from our perspective, it was also about the not only seeing this from an Excel spreadsheet perspective, but also seeing this from a who can actually be helpful for us in the future, right? And I think one of the things I mentioned, about you and Columbia Lake Partners kind of back then was really the it's a debt provider, but acts like a venture capitalist, basically, right? And I think this is what gave you then the edge, at least kind of in that structure for the initial ticket, and then maybe talk about the rest in a second.
Yeah. So at the time, company's growing really fast, sort of 100% year-on-year growth, no churn. There's no churn. You raise a round, you pad it out with a little bit of debt, and you're kind of off to the races. And then it was all growth. And now, this is from the outside looking in. I think you grew to a couple hundred people. You moved offices in Copenhagen from something that was on top of some stores, maybe 3 or 4 different offices that had been kind of carved up and put into sort of kind of feel like one office, to a building that was designed by a super fancy architect, and people have lunches catered, and it was like, wow, you've hit the big time. All felt great, but under the hood, there were some things that started to happen. The burn started to go up, the revenue growth started to fall off, and then I said before there was no churn. And one of the things I'll say to our team all the time is everybody has no churn until they have churn.
That's right.
And all of a sudden churn hit, and it was like a big wave of churn happened. So talk a little bit about that, what you guys saw, how you diagnosed it.
Yeah, so it's a typical thing, right? You raise a big Series B, for, back then it was considered a big round. And then you go all in, push spend, try and get as much revenue traction as you can. And I think the number one mistake, looking back, we did back then was really this idea that the way you're going to grow more, because that had worked until that specific time point, was just hire more sales rep, more quota on the street, ramp them as fast as you can. Can we maybe increase quota just a little bit, basic kind of spreadsheet this whole thing out, and we did that. We didn't only have it in the spreadsheet. We also had it then on, the profit and loss, if you will. We had a bunch of account executives, and you always have this. I'm not sure kind of, how deep all of you guys are in like this whole B2B commercial thing, but you always have this productivity piece. It's like, someone can bring in $1 million a year as quota. Maybe take a haircut, 70%, productivity. We can deal with $700K per person, right? So that works out. The thing is, we hired all of those folks, and just productivity went down and down and down and down and down, right? Basically to a point where it's, we can't do this anymore.
So what was causing that? What was like underneath that?
Yeah. So this was kind of the big struggling moment, right? So there was a clear feeling, and I think that was well done by the CEO and the management team. Obviously, we saw the wall approaching, or the cliff, whichever analogy you want to kind of use here. We're up to like $1 million burn per month. And let's just say we didn't hit those revenue targets, right? So it was really okay, shit, we need to change something right now. What we realized was, and it's so silly when you look back now, but what we realized, account executives, they don't actually, make you money. They're there to, take something, some people call it a deal, an SQO, an opportunity, and turn it into money. But if they don't have those opportunities to begin with, they basically just sit there and have like completely white calendars, and just waiting for stuff to happen, right? And
leads to come in.
And none of that actually happened, right? So they were sitting there basically burning kind of salaries away. No one was happy because no one was hitting target. And the analysis, and all of this sounds so silly kind of, these days around, but when, as my capacity of CEO of GrowBlocks, I talk to a bunch of different revenue leaders, and it does feel sometimes that realization hasn't fully hit yet, right? Kind of that this finance-driven approach to your revenue plan almost. It's hire more AEs and you're good, right? If you go on Google and you found a blog post, even from reputable VC sources, they say the same thing actually, right? So I don't blame anyone for this. But the reality is you need to have the top funnel in order to support those account executives. It's not much more complicated than that actually, right? So what we actually started doing, we took the whole go-to-market, like everything. We looked at how many opportunities we were actually able to produce on like a monthly basis. We then realized, okay, we have those opportunities now. How many AEs do we actually need to process those? And I just say it was half, right? We could just, half of the AE team, we could just, basically kind of show the door, right? Then we took that money that we kind of saved with the account executives and put this in top funnel. And in this case, it was actually seeing extremely good results on the outbound motion, which until then everyone was like, it's those lazy, youngsters that are acting like this is their new high school and they're just on Facebook all, keep in mind we're a social media management company. They're on Facebook all the time, right? They're lazy. But we actually saw that, what they were producing was like extremely efficient way of producing opportunities. Right. Now, some of that might have changed, until now. So we put a lot of money, from those AEs into the SDR team. Okay. We saw marketing, way overspent, really, really expensive. We compared cost per opportunity from marketing to cost per opportunity from the SDRs. And you would assume inbound stuff converts a bit higher and you give it a little bit of a premium, but there was a difference of like 1 to 4. So one outbound opportunity was maybe $1,000 in cost, and an inbound opportunity was like 4,000, right? So we gave that a massive haircut as well, and basically kind of redistributed this to really focus the whole revenue engine on opportunity production.
Okay.
That was the whole thing was about now we need to hit our opportunity production goals. Right. And then as an afterthought, how many reps do we actually need to work through those opportunities, right? And that's where and this is B2B SaaS speak. This is where we went from, I think, like a CAC payback of like 24 months, so 2 years. Yeah. You're like a mid-market motion. That's not healthy. You should be at 12. We took this over, I think, a quarter or 2. Yeah. Took it down to 12, right? By just redistributing those resources. And then, not to brag, but then we started to kind of have an extremely predictable machine. Yeah. I think we were hitting 12 quarters in a row or something like that, I think. And then basically kind of having the ability to increasingly get more efficient, right? And maybe that's the ball back to you, right? Because it's like really
let's just stay there for a moment. So when you've got, as you've described this, you've got RevOps, you've got AEs involved, you've got finance involved, you'll have your human resources group involved, you've got marketing involved, you've got all these cross-functional groups, and there's an issue. How did everybody kind of rally around this, and what tensions did you see in those different groups saying, you know what, your area is being cut, and maybe we're investing into your area? Yeah. How did you work through all of that?
So the first step was actually that we had a feeling that, it wasn't a feeling. We knew something wasn't working out on the sales side, right? It's a period. There's not a feeling. And the first thing you do is, what can we do on the quality of the AEs? Can we maybe enable them better? Can we, whatever? Yep. And we did this for 3 to 6 months, but none of it worked. Okay. So we pulled in fairly experienced VP of sales, fairly experienced VP marketing, for those times back then. It was not like there was all kinds of VP, SaaS kind of talent out there. And none of that stuff actually worked out. Yeah? Which then basically kind of led to this almost complete reboot of the methodology of how we were thinking about building this company. Yeah. Right? It was really, really silly. We went from everything is about quota, how can we pump up quota, to how can we get more opportunities and who gives a fuck about quota, right? And I think that main alignment step, this is what took a lot of heavy lifting. And I think this is where I believe RevOps really kind of came in, provided some insights, was able to take these insights, push it up to the management team, and then be like, hey guys, this is a potential solution to this whole thing, right? Okay. And I think once that was fully understood, once the CEO basically was kind of fully behind this, and because of the sheer amount and intensity of the crisis, action actually went pretty quickly afterwards, right? There was not long of, there was is that really the bet that we're kind of betting the farm on? That was a longer process. But once that conviction was reached, the roadmap was pretty straightforward, right? Kind of this is how we need to redistribute capital, basically. And it was, surely it wasn't a pleasant process to go through. Don't get me wrong, right? But this was the alignment that then happened afterwards had such a crystal clear path forward. That it wasn't much of a, what do we feel about this? And, maybe this is the right thing to do, maybe not. It was so crystal clear that it basically kind of helped not only align the go-to-market functions, but also make it kind of clear to finance and HR and so forth, that's the path forward.
And it was the key thing here that RevOps identifies this, gets the buy-in from Ulrich, the CEO. Once you have that, then it kind of cascades around the rest of the group, understands there's evidence-based, right? numbers here that show this ought to work.
So I mean, when you make those bets, there's to a degree, it's like, well, is this really actually going to work, right?
Sure.
But I gotta say, this whole idea, and again, it sounds so super silly. Hey, you need to have those opportunities. You need to have those deals. You need to have those demos.
Yeah.
Otherwise, your account executive team won't be able to be successful.
Right.
And then the whole math on the cost side and the efficiencies and the CAC payback side, all of this is just going to topple over. So it made total sense that that was the right way to do. And then, I mean, you know, the board meetings and the board material, I mean, it basically shifted to, or from, hey, you know, our target was X, we only got 50% of this, to we hit, you know, 95% on the opportunity production. And then, oh yeah, we hit 110% on you know, revenue. But actually, because we only hit 95%, you know, this quarter, I think we need to push next quarter a little bit harder in order to get to the 100% on the revenue side again, right? So the focus on the board, and I still remember this because suddenly all the board members started talking. I mean, we made like metrics up, which was like accepted opportunity. That was kind of the big thing back then. And suddenly all the board, the only thing that we're talking about was accepted opportunities. How many accepted opportunities we have? Who's booking those?
And there was one other thing I remember from the board decks was when you were measuring churn, you were measuring customers that were coming up for renewal and how many renewed and how many didn't. And that to me felt like an approach that gives you a very early warning sign into something happening.
So, I mean, it's churn, however you calculate, it's still going to be a lagging indicator, right? But at least internally, and then also bubbling this up to the board, we always said we chose the most brutal way to calculate churn. And, you know, when you come out of, you know, when you read those blogs on e-commerce on how you should be calculating churn, right? Kind of you have this, well, your base divided, you know, what you lost kind of that month. If you take this into B2B with contract length of a year or so, it actually kind of dilutes the picture quite a lot. So the approach that we took was what could have churned, and what ended up not churning.
Who gets a vote today? Are they voting to stay or are they voting to leave?
Exactly. Really brutal to look at it like that. I think social media management also has like an underlying churn problem in general. But basically, kind of that's what we chose in order to very clearly at the end of the quarter have a black and white scenario, could, you know, talk to the VP of CS and the rest of the teams, like, you know, what actually is going on here, right? And fixing this, to be honest, is not that was not, you know, a revenue ops kind of revelation, but getting to the clarity, you know, potentially was, right? And fixing it in the end, lots about product development, lots about, you know, lifecycle management and so forth, right? Lots of other pieces that you need to have in place in order for that to work out. But the clarity, and then, you know, with that, then the urgency, which I think the board also reinforces, like, yeah, you need to look at this churn number, man. You know, I think that created that focus on that side. And
then for us, so we saw all of this happen, and we saw the burn go up, we saw churn start to happen, and as an investor in the company, we saw a management team that just rallied around this and worked really hard to, in looking back on it, very short order, get that under control and start to see the numbers turning. So the unit economics kind of got a little bit upside down. They weren't completely back, but you could see the trend. And so we went then to the company, and we could also project out, because we're getting the financial reporting, we could project out how much cash you had. And we went to the company and we pitched, hey, you know what? We could put this much extra capital into the company and take you this much further before you have to fundraise again. And so that was I think really well received. The VCs wound up doing a small inside round with that. So again, topped up the debt round that we pitched to the company, and the idea being we can get you pretty much to break even. So we financed that. But for us, we saw it was the credibility that you built up in identifying and really working through these issues, and not seeing the result fully come through, but seeing the trend to it. We love that.
No, and the thing is also, right, once you start stumbling at Series B on your way to the C, you know, it's going to be really difficult to get out of the stumble, right? Because we did, you know, lose some traction in that time period. We did burn some money that you just simply don't get back, right? So putting together the external round with another equity ticket wasn't only difficult, it just simply also didn't happen, There was kind of clearly not really an option or appetite in the market, very much similar to what's going on actually right now, right? And then really and I didn't actually know this part of the story, that you were kind of pitching us on this in this regard. So this is pretty funny. But the consideration obviously was like, well, how are we actually going to get to the next milestone here now? How's that actually going to work out, right? Because once you see your cash burn depleting more and more, you really only have two options. You can kind of cut down half of the company, which is basically going to stall it out, and it's you're not going to go anywhere basically, right? Or and in your case, then fuel up through a quicker, faster internal round. And the reason why it makes sense for us on the unit economic side was we were basically down to 12-month CAC payback, right? And we could take that cash, cycle it through. We knew exactly what's going to come out of this. We know exactly how much growth this would actually kind of buy us in the end. And then it was a very quick decision for us to actually go with that.
And then another opportunity came up where there was a competitor that you could spin out of a company, kind of take them off the market, also buy, I think, an R&D center, an accelerator roadmap.
Yeah.
So talk about that a little bit.
Sorry. So it was really a little bit of a distressed asset sale. And we were actually up against a management buyout that obviously kind of limited in the amount of cash they had at the point of time. And I think we were able to win the bid with a 1x ARR, right? Kind of like an extremely kind of, no-brainer case for us actually, because it was a 100% overlap with our customer base. We kind of put those people on, and they had like one differentiating piece on the product side that we could nicely kind of attach to us, right? The thing is, though, you still need to shell out $1 million, and you still need to kind of then cover those additional expenses.
That's right.
So we were then thinking, well, how are we going to get this deal done? And talking to the board, it was just very difficult to get this. How are we going to make this equity round, work out?
Again, you've got these options, right? You can try to get an outside investor, but it was like $3 or $4 million or something like that. So getting some new investor to want to write a $3 or $4 million check is basically zero people interested in doing that. You can go to your current investors and get the money from them, but then they've got limited reserves, so your just-in-case money goes away. And I think that's where we came up and said, okay, we'll fund this. We fund it in 3 weeks and pay the cash part of that acquisition.
No, I mean, I think the main piece was really hey man, this was like I think it was one long phone call. And then it was the paperwork.
That's it.
Took 3 weeks, basically, right? And if you think about, even when you have 3 different funds in your board, it's not going to be a 1-hour phone call and this thing is done. It's much longer than that, right? And we were basically up against this. There was a timeline that was going on the other side. Like, well, we need to make that transaction work out. And we had to maneuver ourselves into a spot where we could actually do it without jeopardizing the company in the process, right? And then doing this quick refuel with you guys was extremely handy in that case.
And then you buy something. Then I think we topped up a little bit beyond that because you also were in potential merger acquisitions with another company. So you wanted to make sure you had enough gas in the tank that you didn't get backed into a position of not being able to negotiate a good deal for that.
No, exactly. So, while there was one distressed asset on the market that we wanted to consume, we didn't want to turn into being a distressed asset ourselves that kind of suddenly sold under value, right? So in order to kind of avoid that, we need to make sure that we're not maneuvering ourselves into a position where we're kind of back against the wall suddenly. I need to make this deal, work out whatever happened. The truth is actually that specific deal didn't actually go through in the end, right? So if we would have just kind of plowed through and put all the chips in the on the table, in the basket, all the eggs in the same basket, I guess, for that specific deal, I think we would have screwed up actually, right? And then this additional optionality kind of worked out actually pretty nicely for us.
Right. So then you ultimately ran a process and sold the company at a much higher multiple than you paid for the company that you acquired. So that was immediately really accretive.
I mean, then suddenly we got into like almost an arbitrage thinking, which is like, I don't know where's that problem here. But basically kind of we were able to acquire them for 1x and then we sold for a much higher valuation afterwards. So it was a really nice deal actually.
Talk a little bit again about if you can, about the economics of your CAC payback comes down to a level, and you want to fund that, and you can just fund that growth in a cost-effective way.
Yeah. So it's almost, think about it, instead of buying really expensive equity dollars, right? You kind of give the cost of capital. I'm not sure how many B schoolers are in here, but the cost of capital is pretty high for equity at the end of the day, right? So if you have the component of just venture debt, basically, which is really the blend of a boring bank and a venture capital, kind of, if you marry those two things, great comes out. And in this case, we were almost thinking about it like we can fund our growth on a credit card. Right. So we took whatever our quarterly CAC was, which was pretty much the ticket that you provided, and then we funneled it through, and our recash time was, I don't know, 3 or 4 months anyway. And then we could take that money and funnel it back into the same machine, basically, right? So it's really, thinking about this, the way of, paying for your growth through a credit card in that case, which I'm not sure if you kind of, like that comparison, but, founders can think about it like that.
Yeah, for you, it was the cash conversion cycle. You have to front sort of 3-4 months of cash to be able to acquire the customer. And it pays back quickly, but then you don't get, and you're selling one-year contracts, but it takes a while to get the contract paid. And so there's that time frame that you just have a working capital adjustment that you want to pay for.
And I think to almost kind of bring it back to, simpler reality, right? I think venture capital makes a lot of sense when you're still figuring stuff out. Later stages, they're able to kind of obviously write bigger tickets. But, if and when you have a repeatable machine, something that really gives you, 12, 15, 8-month CAC payback, when you see clearly what you can scale, so you put another $1 million in and it, has this similar CAC payback in the end. I think venture debt is like an extremely powerful lever to actually use in order to fuel that again and again, instead of trying to always go out and raise additional capital, right? But that for me also on the flip side really means if you don't have that, and I think then that's also then difference from the profiles that you're looking for. If you don't have the repeatability, if you don't have the efficiency in there, then venture capital actually might be potentially kind of a better source sometimes, right?
That's right.
Yeah. I think we're coming up on time.
We're coming up on time, but that had hopefully informative for the group. A little bit of everything.
Yeah.
In a 6 or 7 year journey, you went through sort of 50 years of experience. Thank you for sharing it.
Well, there you go. Thanks, Craig, for having me, and thanks to the Project A team.
Okay.
Awesome. Thank you thanks so much, you guys. I need to apologize again. It's not Columbia Lake Capital. It's obviously Columbia Lake Partners. Thank you so much for your support. All right, but everybody else stay seated. It's about to get so much cooler because Tony's actually going to stay. And then we're going to bring up our very own Director of Sales, the man with no bias, Raul Poroyan. And we're going to have a live podcast going on in here. So we just had fun. It's about to get hotter. And how much time do we need for this? Ready to go? Ready to go? All right, take it away.
Which way do you want?
I'll take my glass again. I'm not sure.
I'll take the other glass.
I'm not sure if this has been switched out, but I'll take mine.
Okay, good. Okay. So as you might have seen, we are doing actually a live recording of the podcast that Tony and I started, which is a little bit of a different thing. This is also the first time we're doing it, but I guess we'll just do what we typically do, which means we have no idea what we're doing. But it's going to be awesome.
So the podcast that we're referring to, just if anyone is interested, called the Super Revenue Brothers. I hope you catch the drift here. If you listen to the episodes, we have a really cool jingle that kind of sets the tone and sets the theme sometimes. I think we're like a couple of episodes in, and we're always trying to aim for like almost a controversial talk.
Yeah.
We're always trying to kind of disagree. My role is the CRO on the venture side, turned founder and now doing something in that specific space with Roblox, and you're the VC,
Well, Hardly. I mean, I understand a little bit about it, but yeah, that's the roles you play. I'd say let's just get going. And we do what we typically do, and let's see what comes out of it. Tony, how are you liking the PACON so far? We're here, by the way, recording live at the Project A Knowledge Conference. How are you liking it?
I think it's fantastic. Really awesome people around. I also had my first beer already, but it was alcohol-free, by the way. No, I mean, it's always a good time to be here in PACON.
Is that the thing you miss here about Germany? Because, I mean, you have to know Tony's German.
Don't spill that secret, but yeah.
It's out now. Is that something you miss, or is it as good in Denmark?
No, Denmark has plenty of beers. Don't worry about that. Yeah.
So how come that was the first thing you got then?
Because I was thirsty, and that was available.
Okay. What are we going to talk about today, Tony?
We're going to talk about that people need to stop blaming the bad results that they're having in their go-to-market engine, and their revenue engine, and their machinery, basically, on, the environment. You're like, macro is bad, so macro environment is bad. And hey, let's just blame that. So we have a good excuse for the board, for ourselves, why a machine is not running as efficient as we actually want it to be, right? And to a degree, you and I are calling BS on that.
Yeah. I mean, I'm not calling BS on the fact that the market is doing whatever the market is doing.
Yeah.
I'm calling BS on the fact that it has to affect you only negatively even. I think there's also some upsides to them, which we'll talk about in a minute. Some very obvious ones, some maybe less obvious ones. But then it's just, I mean, it's the same for everyone. So what are we going to do, stop selling?
Well, so that is one way to kind of approach this. But the other thing is, if you look at Gartner, if you look at G2 Crowd, they did their surveys, they have their expectation on IT spend and so forth. And they actually projected 2023 and 2024 to be double-digit of growth for IT spend in general, right? Which is fairly consistent with what it has been doing in the past. So when you kind of read those numbers and then compare it to like everything is imploding, how the fuck can that actually be?
Yeah. I mean, okay, interesting, of course, is how it was before. I don't know if you have these numbers. Is it growing compared to the years before?
No, it's basically in line. Basically in line with what has been
It's in line with the growth as before.
Yes.
So that's spending for B2B software.
Yep.
It's interesting, isn't it?
No, I mean, and this really kind of gives, I think, the main clue around, wait a minute, something is off here, right? This actually should be going in a different direction. We're all complaining about it. So why is it happening, right? So this is, I think, kind of the main question people might be having around this. I'll just go ahead with my take here. I believe that the environment that we're kind of living in right now, it simply has started to add a little bit more scrutiny to kind of how you sell and how you buy, right? And given the crazy times that just happened before, so the 1 or 2 years before basically, people were hiring a bunch of sales reps, basically out of school, everyone was buying whatever you were selling, everything was great, but it didn't foster actually an environment of, really understanding the basics of sales, really kind of nailing all of those different, steps through, building a strong case, and so forth, right? Which then resulted, now with a simply different environment, and a lot of deals going nowhere, right? And, talk to Jaco from Winning by Design, and kind of his main point is actually really that while the average sales rep a year or two ago has been like hitting 70%, it's now down to 20 or 30%, right? So it's a crazy drop off, but the top percentile actually stayed the same.
Yeah.
So really the sales reps that knew what they were doing 2 or 3 years ago are basically still successful in today's environment, right? And I think this is one of the main clues here that when you really think about it, the parts of this can absolutely be, I don't want to say blamed or something like this, but part of the reason can totally be, put to the feet of those sales reps, right? Kind of that didn't get the enablement, that didn't give the, get the tools in order to actually be successful in what they were doing in the first place.
I mean, you have to put the blame on the companies in the end because they hired them and they did not enable them. So I think I totally agree with you. So I think I did a podcast with a guy, very interesting character, Benjamin from the UK, the UK's most hated sales trainer.
Yeah.
And he said something in a podcast with it, which was the average salesperson in 2021 is so much worse than the average salesperson in 2020 or in 2010 or even in 2000.
Yeah.
So basically there was just this bubble of sales is paying a shit ton of money for really not that much of performance, and it's even easy to sell because everyone's buying everything right now. And in that kind of environment, obviously everyone's interested in getting into sales. And it's true, like there was a big push of people going into sales. We saw it at Project A, so my department grew from 1 person to 15. And I hope that we're better than average or better than we should be, but the demand was there.
Yeah.
And so I think that was the one thing. There's sort of a bubble of sales happening in general. That leads to a lot of people coming into sales who maybe are not actually that interested in it and just want the easy buck, and they can get that buck with not a lot of work. Now, everything has changed. There's a lot more scrutiny. How that comes to be, we can talk about in a second, but it's just way more difficult. So you're reaching 20% quota or 30% quota as opposed to 70 on average. But if you're good at what you're doing, you're still good at what you're doing. So it's like, it's just that sort of it's not impossible, but the jump off point to where it's good enough to sell, it's just much higher.
So let's kind of peel this a little bit back and make it a bit more tangible, right? Kind of, you're throwing some statistics around, and hey, that should be easy. You know, why is everyone struggling so much? But from your perspective, what are the 1, 2, 3 items that sales folks are not getting right now? Which, if to your point, be better prepared, better educated, better trained, would actually be doing much better.
So I think we've heard this before, and I said this in other contexts. I didn't invent that. The CFO is the new CEO. You've heard that too, probably. Yeah. And I think really understanding that and the implications of that is a big deal. So when shit hits the fan, the CFO becomes much more important because burn rate becomes much more important. How much cash you have in the tank. People change their strategy to retaining money and just making sure they survive until the wave's over, whatever that means. But it's what's happening. I don't know if it's right or wrong, but it's what happens. And so when companies go into cash saving mode, they immediately go into, okay, we have 60 tools. How can we cut down to 10? Right? We had sort of this wild growth of tools. We had sort of a very low barrier of getting into new things. And naturally, the person who is typically sort of the enforcer of that is the CFO. And so as well for getting into a new company, the CFO is much more important than it used to be maybe 2-3 years ago, but also for staying in that company, which leads to a couple of things we're going to talk about also maybe, but like, for example, customer success becoming much more important. And so learn to understand what a CFO needs. A CFO communicates maybe differently from a CEO. Maybe it is much more bottom line than top line, for example.
Do you think this whole, push on ROI, I mean, I have my own perspective on this, but this whole push for ROI, everyone's asking for a return of, investment. What do you think about that, actually?
I want to know what you think before I say it.
I think it's a little bit BS. That's what I actually think about this. I think it's a great tool if you're the CFO, if you're the CEO, if you're someone with decision-making power, to just say no without needing to say no, right? One of my talk tracks is almost like if I as a CEO would have gotten all the ROI that was promised to me and we bought, we would have sold for $1 billion instead of less than that, right? And I think that same is still true, right? When I was kind of going out and buying all kinds of expensive tools, it rarely ever was there like, okay, what's the ROI calculation and when is it actually going to happen, right? I think what in many cases where an ROI document or something like this is helpful, it's like, okay, this is the rationale of how you should be looking at this problem, and that's how we can maybe solve what can we solve for you. But it's less so the 30x in 3 months. I think every CFO is calling BS on that as well, right? So, and I think if you want to maneuver that, I believe you need to try and talk to this guy or lady as much as possible, right? You need to try and get in front of the CFO, which in many cases will simply not happen, right? They will kind of just shut you down. They're trying to kind of stay behind. But then what you then need to do is you need to equip your champion or your influencer in the process to not have them talk about why they want to have the tool, because the CFO doesn't care about that. You need to teach them how they need to pitch it to the CFO in the end, right? And I think this is really difficult. And I think this is why the top reps are actually still good. Yeah. Because they're basically kind of, okay, I understand the power map of the organization. I understand what needs to be done. I'm educating my champion to maneuver through the account as best as possible, and then actually be, successful and, bring the deal home. I think that's what they have done all the time, by the way. So that hasn't changed, actually.
You're saying there's an amount of salespeople who are like, I don't know what you're talking about. Everything's the same for 10 years now.
Yeah, no, exactly. Yeah. But so tell me, do you have like a different view on this ROI thing?
So I think I wouldn't say, I think there's a reason CFOs do that. You sort of sort of hinted at that. It's not just BS, really. And I agree they probably don't believe the ROI number that's there at the end. So that's all a charade, and everyone knows that. You still have to produce it and whatever. Like, nobody believes that. I mean, no CFO who actually did the work to become a CFO would believe those numbers. But it is, as I said, they become the enforcer of sort of increasing the barrier of entry.
Yeah.
And that's one of the ways that they do that. So before, you're like, Tony, RevOps guy, this guy, data guy, all these people are coming to me with, I need money, I need money. And before I was like, okay, just have whatever you want, here, eat some money. And now, you're like, okay, how do I raise that barrier? Well, I make you think about that 2, 3, 4 times.
Yeah.
So I don't just say yes the first time, I make you come back a second time, I make you come back a third time. And the process of doing that is that ROI thing.
Yeah.
And so that's one thing. Funnily enough, it's sort of a wrong approach from the CFO, because like if you're my internal RevOps guy, you're maybe as a RevOps person, maybe, but typically not, you're not used to doing that.
No.
So that's what you're talking about, which is the salesperson then has to get into the role of empowering and developing that kind of thing together with the client, which is quite a demanding task. I mean, the good salespeople have been doing that already maybe for a while, but now you really need to do that sort of to even have a chance to sell.
Yeah.
And this is, I think, I agree with that. Like, it's something that really changed is your understanding of the stakeholder map, your understanding of how to leverage people within an organization needs to be at a much higher level than it used to be 2 years ago to earn the same amount of money.
So I'm thinking, so we've been talking about AEs a lot, so account executive sales reps a lot. So this is kind of go-to-market. Go-to-market is more than just account executives. I would actually go up one level and kind of talk about, well, there also haven't been as many opportunities lately as there used to be, right? It's not only a conversion problem from the AEs, it's also how much demand is there in the market, how can we harvest that, and so forth. What's your perspective on that?
I mean, I think it's sort of the same, the other side of the coin. If there's less conversion, there's less demand, there's just less general time or like interest allocated, volume, whatever, attention allocated to dealing with new tools. So just whatever it is, what the kind of resource you're going for, it is at the end of the day, a lead is about time. It's about getting the time and the light of day to talk to someone, the attention. So that is limited. Money is also limited. But all the factors, all the resources are being limited. They're being pushed somewhere else. They're being pushed towards bottom line. They're being pushed towards surviving. They're being pushed towards getting to the next round, making sure we keep the right people. We maybe have to do layoffs. That's all understandable. But then that's why for the attention that is left, and apparently it's there, and also the willingness to actually spend money and time on these things actually increases, you have to become just much better at getting that.
So I think that's kind of true. But I also think that what has happened in many organizations that kind of I've been working with now over the last year, people have kind of indiscriminately just cut across the board, right? It's like, okay, sales minus 30%, marketing minus 30%. CS usually kind of, there was a new like pavilion in Germany, kind of research on, who was actually laying off how many people. By the way, it spiked this last month, by the way. That's kind of,
What is that, September? It spiked?
Yeah. So this thing is still not over kind of in that sense. But what I have seen is, you look at your top funnel and everyone is just slicing off 30% or 40% or 50%, whatever. But what they're not doing is, what is actually working, what is not working. Let's cut the stuff that's not working and maybe even take that money and put it on the stuff that's actually working to begin with, right? And I do see this as sometimes connected to simply not understanding your revenue engine to begin with, right? Yes, maybe it's a pitch for, revenue operations, maybe it's a pitch for grow blocks in here, but at the end of the day, it's like, if you do not understand how you actually predictably, generate more cash on the, through basic opportunity generation, and you just cut across the board, yeah, you know what? You will have few opportunities sitting there. And I don't think it's only a interest in the market kind of problem. It's actually kind of how you go and capture that, right? And I think this is one of the main reasons why we've seen, opportunities collapse in general, demos collapse in general, and then leading to this slimming down of your top funnel, giving this to sales rep that are having trouble time navigating this whole thing, and then you get even less out, right? So it's really a thing that, at least from my perspective, is a double whammy knock-on effect of cutting indiscriminately. You kind of reduce your opportunities. Then the sales rep struggling to sell into those accounts because of the CFO blocking the deal most of the time. And then you basically kind of instead of this 20% loss, you suddenly have like 50, like half coming in, right?
I think we don't go too deep into that cutting indiscriminately part. I think that's a big part. And one of the biggest reasons why you need to be very firm on your numbers and on your revenue engine in general. Absolutely on point with that argument, I think. On the customer side, it's the same thing though. So the customer is also cutting, and the customers, especially, and now I want to get to the point of customer success, you're one of 60 vendors that the CFO maybe has at their monthly payment schedule. And they're going to go to their heads and then they're going to say, hey, Tony, you're currently using 17 tools. Make that 3.
Yeah.
It's like, all right, fuck. Like, first of all, for you, how do you do that? But then if I'm the customer success manager of the 17 tools he's using, I better know about that.
Yeah.
And I mean, you should know that's probably happening. It's probably a good idea if you're a software vendor, for example, to assume that this process is happening right now at your customers, at most of them. But then that is what differentiates me. Like how do I make sure that I stay in those 3 that are not being falsely cut by the CFO because they don't understand what's going on?
Yeah. So let's just kind of have the whole product side outside of this conversation, right? Because it's you can always blame products like, well, it just needs to be better and all of those different reasons. But let's focus on the go-to-market side in this one. What I've heard from CFOs, they basically stack rank the different tools and then just slice it off. They usually don't slice it off at 3 in this case, but then at 10 or something like that. That's sometimes, already enough gain. I think the other piece is, and this always gets so many clicks on LinkedIn from Jacco van der Korf from Winning by Design. It's like, well, if you want to have recurring revenue, you need to deliver recurring impact for the customer, right? If you are not able to do that, then you will be one of those, on the list that are fairly far down actually, kind of. What is my current impact that I'm getting from this tool today? I don't have anything anymore. Okay, I can move on with that, for example. It's an easy churn, basically. But for me, this is also connected to, well, is that value actually fully understood on the customer side, right? Which then simply means you need to train your CSM folks not only to do the point-and-click onboarding, which in many cases, I feel that's kind of what CSMs have become to be. Hey, you need to click the red button, and now you need to click the green button. But really focus on, number one, what was the value that this specific company wanted to unlock with us as a vendor? Or what were the 3 main pieces potentially? Are we able to prove to them that we unlocked 1, 2, or maybe 3, right? Basically trying to prove those outcomes, and then find a way to communicate that back to that customer. So at least when they have that conversation, that they're top of mind, no, actually, kind of we achieved X, Y, and Z, right? And what's really tricky here, I believe, is when you sell the deal to begin with, which is really, building value, building the pain, etc. You might be talking to the economic buyer, talk to if you can, to the CFO. They will have one certain set of pains, but the user that you're onboarding and that the CSM will have, 95% of the relationship with, they're just like, oh, I really like the visualizations. And if they're then being asked by the CFO, what do you like about this tool? And they say, oh, it looks pretty. You know what? You're going to get kicked out. But actually kind of using that communication, using this in order to almost indoctrinate the user to be able to say like, hey, those are the 5 things we actually were able to achieve with this thing. Yeah. And I think, coming up, we have the same problem. So I think we shouldn't kind of throw this thing out. Or alternatively, well, if we do, here's the alternative scenario that we would be looking at, right? And I think there's usually something going lost in this translation from why did someone buy this originally? What was the real pain you wanted to kind of sell into versus what is the actual, user ending up and what is the pain they're seeing, which will not, in all cases, lead back to the original reason why someone bought this thing.
So it's the same thing again, just on the customer success side.
True, yeah.
You have to educate your stakeholders, and maybe even the learning is even upfront in the sale. And actually, this is something that I discussed with a venture of ours. If you're selling right now, this thing is going to go on for a while. Ask already now. Hey, Tony, maybe you're a CFO, maybe not. What should we do right now so that in 6 months from now I'm not on a chopping block? So I'm pretty sure most CFOs would receive that positively because it means you understand what's going on. You understand that there's a lot of scrutiny. And that's maybe a good way to start that ROI discussion. Rather than saying, what do you want to achieve and what is the ROI and 50x and 10x? Maybe you could just go out there and say, hey, how do we make sure in a year we're not being cut?
I think that's pretty cool advice, actually. I think really, and some other people call it quantifiable outcomes. So what is, and you could say, it sounds like ROI, Tony. And it kind of, maybe it kind of is actually. But what you really want to be able to achieve is in 3 months, 6 months, whatever the time frame is going to be, here's a quantifiable impact and quantifiable outcome that we were able to achieve by using this vendor and then kind of playing this back to the other side, right? And ideally, when you ask that question, and maybe you even have the ability to ask that to the economic buyer in the end, right? You have like an email thread going to a degree, and you can hit reply on that email thread and say like, hey, here are the stats. I appreciate that this is really difficult to figure out and achieve. I think one helpful thought process here is find ways that you could actually prove this through product usage, right? And then put those triggers and trackers basically in place to kind of prove that through that, right? So really extending some of this, what's the outcome that we want to achieve, and connecting that to some pieces in the product in order kind of to build that case.
It's a hard one, though. I mean, so especially this building the product in such a way that we can understand and even showcase you within our product, how you're using it and how it's bringing you value. That's a tough problem, man. Like, it's not, especially if you haven't already built it that way. It's a nice thing to have, and it's probably a good idea to build it that way. But that's probably not going to happen tomorrow.
No, but I mean, building products is generally really difficult. Yes. Right? Let's just say that that's not easy either. I think the main point is actually to, and now we're talking a little bit about product. Have a conversation with your product management team and be like, how could we prove this? Yeah. We're sitting on the sales side, we're sitting on the CS side. We need to prove that this thing is valuable on a recurring basis to those customers. How could we actually kind of build this case, and how could product actually support us in that, right? So I think having that conversation and I mean, product managers are pretty smart people also. They might be actually to figure out some of those different problems, right? And then I think on the flip side, I don't think it hurts to educate your product management team on what are the pieces that you on the sales side and the CS side sell as the main value items, and then try and rally around that and whatever comes out of that.
Yeah. On a short note, just to sum that up, because I think we talked a lot about sort of building cases, getting the people involved, the right people involved, staying in there. And I think, as fluffy as it sounds, this is how good salespeople sell nowadays, and how good sales orgs work. This is what we see. This is what works. Become solid in making business cases. Become solid in selling to CFOs. Just one more up in the air question. Is AI going to save us through this? Like, should we invest all our cash into finding some way to just automate all these SDRs away and just make the robots do the work? Obviously, a very reductionist point, maybe another podcast, but high level, what's your thought?
No, I think, I don't know, this whole AI thing, I'm trying to skip it as much as possible in my head.
Just sleeping on that one.
It's like, yes, and there will be a train hitting me, and I was like, oh fuck, what did I do here? But I think this, this AI piece has a lot of like little use cases, and if you string them together nicely, it's gonna help you a little bit. I don't think it's gonna solve it. I think there are plenty of people out there that think the opposite, especially on your top funnel, that AI is gonna screw a lot of things up for you, right? Yeah. It's, spamming, super cheap to generate content, super cheap to kind of reach out to those people. Everyone is just waiting for this button on Apollo to kind of be like, boom, AI on everything, please now. Is that going to help you or the rest of the market? I'm not so quite sure about that, actually.
I mean, to be fair, there are some tools out there that are good at saving you a little bit of time in some specific areas. But to me, at least, the point is not even do I think yes or no. I know that right now I haven't seen anything that is able to do that thing which we talked about, which is build solid cases, get in front of the CFOs, make sure they understand the value, and you're still going to sell in 2023 and 2024. Unless that happens, I also don't believe AI is going to solve this particular problem.
No. And if you figure this out, it's not going to hurt you once some of the CFO crap is over. So, it's only going to be positive. I think we're out of time, actually, Raul.
Yes. Let's cut it here.
Thank you, everyone.
Thank you guys so much. That was awesome. By the way, very cool socks, Tony.
That's it.
All right, everybody, stay seated unless you know the difference between a product-led growth and customer-led growth, which I don't. So I'm going to for sure stay seated. We just need 2 minutes to change some mics and we're ready to go, yeah?
Wollen wir es abschicken?
Also ich bin dafür. Okay.
Ja?
Ihre Druckidee jederzeit online bestellen. Online-Printers. Jetzt testen.
All right. Okay. Yeah, exactly. Super excited for this one because I really don't know the answer to some of these questions. So we're going to talk about customer-led versus product-led growth. It's going to be Philipp Werner, one of our own partners and a total operator, talking to Felix Brucher, who's actually leading the venture capital arm at Salesforce, and we're very glad he does because he helps us, the VC, and our ventures out a lot. So yeah, take it away, boys.
Thanks everyone for showing up. Really cool to have you here. So brief intro maybe. So I'm a partner on the early stage team at Project A. I've been with the firm for 9 years, I think. Used to be an operator though. So I was a CMO before this and ran commercial teams. And when I switched over to the investment side some time ago, I started receiving a lot of decks, obviously, from companies asking for investment. And something that we read and heard very often was product-led growth. So when we talked to the founders about how do you want to scale this company, they would often say, we build a product-led growth motion, or they would say, we are community-led, right? And it all sounds pretty smart. And then eventually you end up giving them money. And then they have to start showing numbers. And oftentimes, and I'm not saying every time, but oftentimes they would realize that actually product-led growth is pretty damn hard to pull off, and that they weren't able to show the traction that the next investor would want to see at seed or even beyond at Series A, where it's all about numbers, really showing the traction. And then they would come and basically say, we have to actually think about our go-to-market, and we have to do something about it because it's not really taking off. We're not able to show the numbers that the next investors want to see. And then they would go and basically come up with Excel-based processes. They would build lead lists, etc. And then that would scale to some extent. And then they would see it's still not enough. Then they would go and implement some lightweight CRM, etc. And then it goes from there. So when we were planning this conference and thinking about what can we do on the go-to-market side, we were thinking, why not invite Felix, who's with Salesforce, which is actually the buzzword that is always being dropped at exactly that stage, when companies realize, okay, we have to do something more than just a lightweight CRM and some Excel processes. We have to talk to the proper experts. And Felix is actually working with a lot of companies that are scale-ups and that are exactly at that point in time where they implement oftentimes Salesforce, but sometimes some other solutions, in order to solve exactly these problems and to make their go-to-market more scalable. So we thought, why not have him here and ask him a couple of questions? He's also brought some slides to back some of the theses that he'll share. So Felix, is that, I'm coming more from the VC side, is that something that you can relate to?
Yes, I can. Before I answer your question, hi Philip, hi everyone, thanks for having us. We're really happy to be here. So what's funny, and before I answer that question, is that we've been wanting to come here, right, and kind of spread the word about Salesforce, and we've thought about things we could discuss. And one of the things that came to mind was AI, and we thought about titles like AI, then the next NFT, or is it here to stay and whatnot. And then we had a conversation with Project A, and then the GM of Project A approached us, and he kind of explored and outlined the scenario that you were just talking about, and he was like, is that resonating with you? Is that something you experience as well? And we were like, yes, every day. So let's talk about it. And eventually we end up here, which is kind of funny, and are actually discussing that. And it all came into play, I think, about 1.5 weeks ago. But I think I've been discussing this for the last 6 years, and I'm here to share a bit of that. So yes, we do see all of that. And we see that especially with founders that are first-time founders. Or we see that with founders that very much root the values or the culture around the product itself within the company rather than the customer. And I guess the issue with that, or the challenge with that, is that they miss to understand how decisive it actually is to early on think about what tech stack I should establish for my company to be ready to scale at some point.
So I outlined a little bit the situation from our perspective when companies typically reach out to you guys and ask for help, honestly. Can you go a little bit deeper into that? So what is it typically that they approach you with? What's the situation that you find when they give you a call and say, hey, we want to implement Salesforce? How do they come to that conclusion? What are the questions that they ask you? What are the common denominators that you see them struggling with in that position?
Right. So first, maybe who is approaching us? Because it was a lot of questions. I'm trying to digest on all of them right now. So what we do see, and that's kind of funny. I think there's 3 major chunks of people or customers that are prospects that are trying to approach us and talk to us about Salesforce. And I guess one major one is the ones that have founded a company before and have worked with Salesforce beforehand and just understand the importance of setting yourself up in a way that eventually allows you to scale past building the product and whatnot, right? So we have that. But we also closely work with various VC funds, and a lot of VC companies understand, because they've seen from the past, that eventually once you want to scale your company, you need some kind of platform that allows you to understand the customer from a 360 angle in real time, right? So they basically introduce a lot of stealth mode ventures and whatnot to Salesforce. So we even talking to companies or people that have not even registered the company yet, simply because they were advised to do so, right? That's one large number of the people. The other one, and I would say that's a huge amount of our business, is that I would say somewhat established startups, been out there for 2-3 years, 50 employees roughly. Product is all set. And they've kind of launched a commercialization, and they're going into that second phase where they maybe think about going to different countries and whatnot. But what they come to realize is that they are working towards their processes, and their processes are actually not working towards their customer. And then they're like, okay, we got to change something about that, and maybe the answer is Salesforce. And then we start talking to them. And that typically ends up in a somewhat larger project because it's a replacement project, and a replacement project costs a lot of time. And typically, time equates to money in some way, right? Positively and negatively. And then there's a third chunk, and that rarely ever happens, but I just came across it 4 weeks ago, or 3-4 weeks ago, when we were in San Francisco at Dreamforce, and we were there with a German unicorn, actually, and we sat down and we ran a few workshops, and they originate from a best-of-breed strategy. And it has worked for them for quite some time, at least I guess they believe so, and I mean, they became a unicorn, so they must have done something right. But when we sat down and trying to figure out how can we get them to the next level, you know, how do we become enterprise ready, IPO ready, whatsoever, they came to realize, not in this way, it's not very efficient, and also in terms of total cost of ownership, it didn't make all that much sense, because what we came to realize, and that was crazy, that was really crazy, and I still can't forget that number. That company now has roughly above 500 employees. Is reasonably profitable, and they have more than 500 tools in place. And the largest portion of those tools go into the revenue model. So it goes into the commercialization process. And now we kind of have to map all that out, and we're trying to aggregate it. That's a huge project, right? They should have maybe talked to us right from the get-go, would have made a bunch of things a little easier.
So you outlined a little bit what the situations are at these companies. What I found quite surprising was when I read recently that 90% of the German unicorns, that at the point in time when they became unicorns, were already using Salesforce. And 90%, that like really blew my mind, especially because I always thought that it's actually more for B2B sales companies that they would be using Salesforce. And I really didn't think so much about a B2C company. So when you think of the German unicorn space, that 90% of them were using it at the point in time they became that was just blowing my mind. Could you maybe give us a little bit of insight into that, what like the typical situations would be where Salesforce makes sense on the B2C side? Because I think the audience probably knows B2B sales quite well, otherwise they probably wouldn't be here. But that part really surprised me. Can you help me understand a bit like what it is that you do with these companies?
Yes, 100%. So I actually think it's quite funny, because I was asked the same question yesterday. Yesterday we had some kind of recital dinner, pre-drinks. Was, by the way, quite fun. Thanks for inviting. And I was asked the same question, so I'm going to answer it, and I'm going to answer it like I kind of answered it yesterday on a beer, right? So we do work with a lot of B2C companies. So essentially, whatever you are doing digitally with a B2C company could be Salesforce. So no matter whether it's your Adidas buying experience, your bank number 26 based here in Berlin, or whether it's your bus provider, it's all kind of based on Salesforce, right? In essence, it doesn't matter if it's a B2B or B2C customer. In the end, we're trying to help our customers, help their customers, understand them with a platform, and accompany them throughout the entire customer journey, And what comes first to us is always customer success, and we try to translate this in customer lifetime value. And we try to help the CEOs and founders we talk with understand that once you have a product developed, you need to gift customer lifetime value the same degree of importance you do to the product itself, especially if you want to make or help your company survive. So the cool thing is about those B2C companies is actually that they often do not approach us with, let's say, a revenue case. Whilst SaaS companies, they come to us quite straightforward what we do, and they want to do in terms of a revenue model something similar that we are doing, and we can more or less copy that, and it's very straightforward and simple. At least from the first angle that we look at. Now, if you look at B2C, a lot of them approach us from an operational standpoint rather from a revenue standpoint. And the person I bumped into last night, funnily, was a former colleague who was the colleague that firstly set up FlixBus with Salesforce and helped them grow. And the cool thing about it was that they didn't start with the typical commercial channels in Salesforce, but started setting up their operations on them, right? So they had the driving routes set up on Salesforce. Whenever you go in a bus and they scan with the phone, that's an app built on Salesforce. And just later on, they started going into kind of the classical CRM and marketing and whatnot channels that Salesforce provides. So yes, we covered all B2B and B2C.
And then maybe coming back to what is the topic of the talk, really product-led, community-led, sales-led, etc. So you've seen a bunch of companies, and you mentioned a few that are quite successful. And so would really like to get some download from you. What are the common strategies that you see work? Obviously, there's not one go-to-market motion that makes everyone successful. We know that very well. But what are the common themes that you, after having worked with many of these companies, could derive and can basically tell us about?
Yeah. So while I think customer-led growth, community-led growth, and all those principles and textbook methodologies make a lot of sense, and I think in the end it's a lot of hybrid solutions that a lot of startups use. I think there's one common denominator that all of these successful startups have in common, and that's essentially putting the customer in the center of the business model. Now, you might say, of course, the customer, yeah, it's important. I get it. But I want to dive into it a little deeper, because I think what we all need to understand is that whatever decision we make about the business, that ultimately we need to reflect and try to understand if this is something that actually pays into that customer value we're trying to provide. And there's one quote here by Walmart, essentially, that I like, and I'm sharing it with you, and try to read it for yourself. And I really like it because of the fact that it always helps me ground myself in a decision that I make with my team for the customer or just for the company, right? Because I think every so often we're so much in love with what we do, our jobs, our titles, maybe our salary. We're very proud of the processes we build, and we're really get a tunnel vision, and we kind of sometimes lose sight of the customer. Also founders, when they are kind of hung up on the product, and to be fair, I guess that's rather normal, right? And in the end, I think whatever approach you want to pick, you need some kind of model that allows you to put the customer in the center somehow. And that's something that we would call the customer company.
Got it. And that sounds good. It really does. And I fully agree that oftentimes scale-ups especially lose track of that for a period of time, because there's so many other things you need to get right. So what does it mean, customer company? I mean, you outlined why it's important to not lose sight of the customer. Can you help us understand how the companies you worked with do that? I think you mentioned once that there's like a customer office, which I really liked. Maybe that would be really cool to understand, like what are the best practices to keep the customer in the center?
Yeah, all right. I would kind of like separate the question and what is it, and then how do we approach it. So a customer company, I was trying to figure out how do I put this on a slide, right? Because there's so much to it, and breaking this down in 5 minutes was for me rather difficult. But what I tried to do is reflect on the companies that we have worked with that from our standpoint are very customer-centric, in as much were they able to align in certain principles. And what we found out that, first and foremost, quite straightforward, the human-centered, and I picked the word human-centered instead of customer-centered, because you might have a patient, you might have a user. In the end, it's mostly human. Sometimes it's animals, but I guess the purchasing decision is typically made by a human, so let's not overcomplicate it. And then The second thing is stakeholder alignment. What you want to do in your business model, whether internally or externally, you want to make sure that everyone working there is kind of contributing to the customer value, right? And not just the processes. You should start from there and then kind of declinate it, what are the processes, and then all of that, translate that eventually into the technology. And that's where kind of the platform mindset comes into place. And when we think about the best and the most successful and the fastest growing companies in the last 20 years, I think what they have taught us is that platform mindset works. And I think what platform mindset understands is that you need a technology in place that is scalable somehow, that is flexible and allows you to kind of evolve with your business model and your customer and whatnot. And at the same time, you need to be able to have this platform trying to gain real-time data from the customer along the entire journey, along all touch points to eventually orchestrate a customer journey that is worthwhile for your customer.
Got it. So coming to how to implement that, probably because I think the concept probably is quite understood and you try to boil it down a little bit, but how I'm looking for something more tangible, how me being a scale-up CEO and probably understanding that I lost track a little bit of putting the customer first, what are your suggestions on how to handle this? Like, what are the best practices of how other companies made that happen? Probably using Salesforce, but not necessarily, but what are the strategies that you can put into place to actually enable this customer focus?
Right. So again, here, I was kind of found myself in a situation where I was thinking, okay, what do all these companies have in common? What's the common denominator of a customer company? And how can I articulate myself in a way to you guys so you take some benefit out of this session? And that within another 5 minutes or so. And what we eventually understood is there is 3 things to it, how you can get started with building or transforming your company in a customer company today. And it's basically rooted firstly in the mindset. And it might be quite straightforward to think, oh, just think of the customer at all times, right? We all do that. And of course, Salesforce talks about the customer. That's what they're supposed to do. But in the end, the question is, how do you actually enforce that and practice that on a daily basis? And what I really liked is how Jeff Bezos is actually doing that. He introduced something like what is called the empty chair approach. And the way he essentially practices that, and we have 2 chairs here, right? He goes in a session, and we are all in a meeting, right? We're in a meeting, we're discussing a customer company and whatnot, and we might also have a forecast. Anything we have, we try to reflect in the end what would the customer say now? What is the customer thinking? And you don't have to bring in a chair. You can also use a customer mascot or nothing. But in the end, always try to understand, would this be something? Would this decision resonate with the customer or not? And once you've kind of incorporated this mindset, the question becomes, how do I operationalize it? And that's obviously a huge topic we could spend a huge amount of time with. But I think one of the things that has worked well with some of our customers is something like the office of the customer. And the office of the customer is when the CEO calls out essentially a committee and calls out people from various departments. That could be finance, could be sales, could be marketing, strategy, recruiting, product, whatsoever, and kind of brings those people together. And that meeting is a regular, just like a forecast meeting. And we all love forecast meeting, right? And we do that on a weekly basis. And in that meeting, what you're trying to do is you're trying to set up your business model in a way so it all contributes to that customer value and also customer lifetime value ultimately, right? And now this might sound very abstract, and I can't declinate it any further due to time reasons. But what I advise you to do, to schedule it with your team, with your company, right? And try to do it 4 times in a row. Just pick a month and schedule 4 sessions, 1 sessions each week, 30 minutes, and I'll promise you, it will make a difference. I guess the first session, people might not quite sure what to do, but eventually you start picking up on this discussion, and it will help. It will help. And the last thing is realizing all of that. Realizing all of that and evolving your customer along with technology. And this is kind of where we close the circle with the platform mindset, right? And we try to bring it on one platform as opposed to, going with a best of breed, for example. Whilst I guess a lot of startups say, okay, so wherever I have a pain, I just throw some money on it, introduce a tool, and eventually you have a dispersed tool landscape. And that essentially means you have dispersed data, you have siloed teams, right? And ultimately, you're not really able to understand your customer, nor are you able to orchestrate a customer journey that's relevant to the customer, and that's in real time, right? And when you do that, and I think for a lot of startups, it feels like the first year or two you can do a best of breed strategy. It feels like it. But then you would have to change that. And then you should ask yourself the question, does it make sense to administer 600 tools, 500 tools? I mean, that's a very extreme example, right? But why don't you try to get it right from the get-go? And a way to do it is essentially starting with whatever makes most sense in terms of pain. That's one thing. And the second thing in terms of customer value. And what we try to do with our team, we try to help companies along the entire customer journey, from how do I essentially find a customer through marketing, and how do I channel a proper lead through a commerce tool to a sales department. So that's essentially customer acquisition. Then the question becomes, how do I make a smooth customer journey to allow the customer to eventually come back? Because if you saw my SaaS facts earlier, you see that 88% of the people that are not happy with the customer journey are going to go to competitors, right? So you want to ensure that the service is smooth and it runs all along, right? And then the third thing is you need a platform that's operationally excellent. And I'm not really a big fan of that word, but what I mean by that is that you need a low-code or no-code possibility to introduce to your organization, where you don't need any super additional resources to administer that, and set yourself up in a way so you can capture your customer. And what's important about that is that you don't have to go with the entire C360 Salesforce platform. Definitely not, definitely not. And especially not for early stage startup. But you should get started now, and then slowly but surely along your priorities kind of expand, and ultimately you're gonna be able to capture your customer 100%, you're gonna be able to capture him, and then also evolve your business model alongside with the needs of your customer. And that's how you can slowly but surely build a customer company that's able to scale sustainably.
So you basically already answered my question on best of breed and platform, and I think we covered that. I have one question that's a bit more challenging, probably, because you being here as a Salesforce representative, also want to ask a bit more like what's a conception in the market, at least, is that a Salesforce implementation is typically lengthy, costly, and afterwards you need to hire a full-time Salesforce engineer. That's not only costly as well, but also hard to find. Can you help me understand? I mean, there's probably no definitive answer to that, but what is the typical stage that you see this being true to some extent? And what are the things where it was actually totally off because there are parts of this platform that companies would be using and there's actually not a complex process. You basically just implement something where there was nothing before, or you just replace existing tooling.
Right. I think it's quite straightforward to answer, getting back to who's actually approaching us, right? So when we see that chunk of people that approach us early stage, so they are typically not stuck in a lengthy implementation. Yeah. If you want to set up a sales funnel, you can probably do that yourself. We even have a guy right here who's been doing all the videos all along for that. So you can do that yourself, and it'll be smooth, easy, and also rather cheap. Now, if you're the second chunk, I explained 50 people in your company, you've been working for 3 years, then if you replace your tech stack with Salesforce, yeah, you're kind of faced with a larger project. So I would advise start with a priority, let's do that, and then kind of incrementally go from there, right? But yes, the third, if you have a huge company and you're trying to transform it, it's going to cost time and a lot of money. Ultimately, I think, yes, it would make sense at some point to hire somebody who is responsible for Salesforce, right? Because it just makes sense to have a person that is in charge of such an important platform, that is in charge of the customer. I mean, how much would you pay if you administered, 10, 20 tools?
Yeah.
I'd rather employ one person. That would be my answer.
Got it. Felix, we're already running out of time, unfortunately, and I understand we only scratched the surface, and there's a lot of people who are operationally interested in how to use Salesforce, how to implement, etc. So I think you brought engineers and architects from your team. Feel free to grab the team afterwards if you want to go a bit more into depth. I think you're definitely very open to that. For the time being, thanks a lot. I think we're being kicked off otherwise. So thanks for that insight, and then let's go into smaller discussions right now.
Thank you.
Thanks.
Wollen wir es abschicken?
Also ich bin dafür. Okay.
Ihre Druckidee jederzeit online bestellen. Online-Printers. Jetzt testen.
All right, so that's the last session for today. I hope you all enjoyed it. We kept something very special for you for the end, because this is an all-time returner for Pakon, 3 times coming back now. We have Björn Süd, nice, who's actually the managing director of Front Row, and we're going to talk about future-proofing our B2B products with sustainability and profitability. I butchered all of that. Sorry for that. Let's go.
Everybody, thank you for staying with me. So, my name is Björn Süd. I'm one of the founders and managing director of Front Row. My personal focus is on B2B performance marketing, particularly for software as a service companies, but I also work a lot on high-end analytics and CRM stuff. I'm happy if you want to stay in touch. Here's my LinkedIn contact and my personal email, and no bot is replying there, so feel free to reach out. So this talk is basically a continuation of last year's talk. So if you were here last year, you can go seamlessly through it. Basically, our goal in general is to go from a marketing cost to a measurable investment. And last year, what we did was basically go through 5 steps on how to build a measurable growth machine. If you missed it because you didn't attend Pakon last year, you can just scan this QR code and then get both the slides and also the video recording of the talk in one go. Last year, we covered a little bit of the basics, like how to build proper messaging hacks, how to structure your go-to-market easily, and how to do server-side tracking for long-running sales cycles. But this year, we're talking about the next level. So we are talking about 3 aspects: how B2B marketing at the moment gets much more personal, so you can actually deliver on your thought leadership with much more tools than last year. How can we capture demand in new ways? And what new options do we have to actually tie marketing and sales data together? Because the time where there are marketing silos and sales silos, they should have been over 10 years ago. That was one of the reasons why we went into B2B marketing, but they still exist in some companies. And slowly it is getting easier to fulfill the promise of looking at a customer journey in a holistic way. So let's dive right in. Let's talk about how B2B marketing at the moment gets more personal. There are 3 levers that you can use tomorrow that allows you to basically leverage a more personalized go-to-market strategy. The first thing is that you have a lot of new options to manage personal LinkedIn accounts of your C-level or of the founders, like social media accounts. And I'll tell you how that works in a minute. The second thing is that you can automate communication on LinkedIn to a much, much higher degree. Typically, you don't want to automate it 100%. You want to rather automate it by 80% so that it still feels very personal, because you have some human intelligence, like your own intelligence built in. And I'll show you tricks on how we do that at the moment. And third is that for the first time now, you can actually leverage the ideas that you have, the thought leadership that you provide, for example, in LinkedIn posts. You can scale that visibility through advertising, because we can now have access to a new ad format on LinkedIn, thought leadership ads, and I'll show you how they work in a second. So when I talk about that we run LinkedIn C-level accounts more and more like social media accounts, basically means this, right? The organic reach on LinkedIn is still on personal accounts. So I don't really care about what a company profile does on LinkedIn. I care much more about who the thought leaders are in a company that can actually deliver personally thought leadership, because they will get in the target audience organic reach. And of course, it's a little bit difficult if you don't measure it. How much time should you spend on it? What's kind of the equivalent? Would I have bought that reach otherwise? So there's a tool that we use at the moment, which we find really useful. It's called Shield app. And that allows us, on the one thing, to understand like the frequency from a lot of influencer accounts that we run, how they are posting. It understands for us also the earned media value. It's a metrics that if you were leveraging PR as a performance marketing channel in the past, this is a typical lever to do that. So you look at, okay, what would have been the value of this kind of traffic, of this kind of reach in that audience if I had to buy it through ads? And that gives you an equivalent on how you can work with reach data. And then, of course, you have the typical post metrics. For us, the goal is, and I think that's also something that is just a shift of mind in a lot of companies, is don't use the LinkedIn accounts of the thought leaders inside a company just as normal hobbyist LinkedIn accounts, but treat them as valuable social media accounts. You need to systematically manage them. You need to systematically build reach. You need to systematically build reputation. You need to systematically build kind of attributable revenue there. And the way to do that is to have a standardized measurement approach. The second aspect is that this kind of personal communication on LinkedIn can be much more automated than in the past. And of course, this is something that LinkedIn doesn't really like. On the other hand, it's something that LinkedIn kind of accepts to some degree because it also drives activity to the platform. So be careful, don't spam and not overdo it, but it kind of established by now over the last 5 to 6 years that there are, let's say, platforms that help you automate to a high degree. What are ones that we use regularly on client projects? Expandi.io and Dripify. But often you don't want these kind of conversation flows that you can see here on the right, like somebody visits your profile, and if they connect, you want to do something differently than if they don't connect. You don't want to just let that live in LinkedIn, but you want to also have that kind of visibility in your CRM on your go-to-market strategy so that you understand who in your company is doing what kind of connection, for example, on the sales team. And a good way is to use low-code platforms. Make is one of the sponsors of the conference here. We love to use Make. We're Make partners, so a shout out to the colleagues. This is actually something that you can use quite easily with Make. Some of those platforms have native Make connectors. They also have API connectors, so you can use it with that as well. But all of them typically provide webhooks, and you can use those low-code platforms to receive those webhooks in real time and then turn them into, for example, activities in your CRM, whatever CRM you have, whether it's HubSpot or Salesforce or whatever you like. And this allows you to use this kind of personal communication on LinkedIn as a scalable, manageable communication and marketing channel, including a high degree of automation. But this can still feel generic if you don't write good templates. So how do you make it feel super personalized, but at the same time scalable? So one of the tools that I really love personally is TextBlaze. TextBlaze is a Chrome plugin. It allows you to write text scripts, and then they will work anywhere you can write something in. Like here, you write /intro, and then it pulls the name of the LinkedIn profile that you're currently on, and then you have like a pre-written message that you created once. This is awesome because you can use variables in those. Those can be dynamic variables like a first name, last name, but it can even be calculated values. It can be company names. It can be anything that you do. This has changed my personal LinkedIn capabilities by a lot. For example, most of you will get a ton of contact requests every day, and 80–90% of them are spam, but there are some golden nuggets in there, like business opportunities. So one of the things that I do religiously is all of my contact requests get a qualification template. So they get a response through TextBlaze that I type in /LinkedIn DE for a German version, LinkedIn EN for an English version, and that says something like, hey, Eric, for example, thanks for reaching out. I can't put quite my finger on, have we met before? I'd like to keep my network around real people and tangible objects. Can you help me a little bit if there's anything in specific that you were reaching out about? And this allows me to really de-anonymize relevant interests, but also get rid of all of the spam. And at the same time also provide, for example, recruiting and hiring links, because a lot of you are founders. They will get approached from international talent on LinkedIn. They might want to look for a job, so I have another TextBlaze template that is very personal but puts people to the job page. So it feels like they're getting a valid response from a founder. We're responsive, but it's hyper-personal. So you don't have to automate everything by 100%. This is a great example of 80% automation. And you can use TextBlaze. I think it costs like $1 or $2 per month, so it's ridiculously cheap for the productivity it provides, and you can use it everywhere. We use this for Asana task templates that we want to reuse in different contexts. We use this for anything where we are in need of filling a form, a web form with some half-standardized content. The third aspect I promised you is leveraging your thought leadership in personal ways. This is a new ad format that's currently in beta. On LinkedIn, it's called Thought Leadership Ads. And the big thing here is that you don't advertise from a page, but you advertise from a person. Here you have 3 examples from sharing an opinion, from Alexander Graf, the Spriker founder, who's also here at the conference, sharing specific knowledge or sharing achievements from, for example, an employer branding perspective. And this is really different. If you are as old as me, you will remember that Facebook tried this once in 2010, 2011. They tried running Facebook as boosting personal posts. It horribly backfired, but this is a different thing now. We are all used to people communicating at scale with a personal profile. So we love this approach. It gives us a completely new visibility, and we know from the metrics that we already have that click-through rates, engagement rates are always higher with personal profiles, and these look like personal posts. They are technically. Technically, you are just adding ad budget to an existing post, but you can then target into exactly the target accounts that you have, exactly the job roles that you want to target into. So this gives us the possibility of having a completely new, much more personalized, scalable communication angle on LinkedIn. We don't have to just build the organic reach manually, but we can actually pay our way into the news feeds of exactly our target audiences. Enough about LinkedIn. Because you can scale LinkedIn only so much. In the end, you're targeting profiles, not demand. All right. So LinkedIn customer journeys typically longer than search customer journeys. So what does allow us to tap into the demand in new ways? We're all doing search advertising. We're all maybe doing software discovery platforms. But how can we leverage all of that a little bit different? I show you 3 levers. First thing is distributed gated content lead generation through content distribution networks. The second is Google has a new ad format since around 8 weeks, which is called demand gen campaigns. I'll show you how they work. And then the third aspect is how to leverage software review platforms like Capterra or in Germany, OMR Reviews in new ways, in clever ways, so that you can get a much higher payback on your investment there. So the first thing is there is a number of content distribution platforms that are focused on B2B. They're not very well known in Germany. They're really international platforms, but they have significant reach in Germany because they partner with websites and they provide kind of content libraries, like ebook libraries, et cetera, that people can download content from. They also provide brandable newsletters with basically sponsored content that people can download. And this allows us to position gated content pieces that can be white papers, webinars, best practice case studies, doesn't matter. And then we bid here on the leads. So we don't bid on the click, we bid on the actual leads that fill out a form, that download a content asset. It allows us to do industry targeting, it allows us to do account-based targeting, so we only want to pay for leads from very specific accounts. It allows us to do almost everything that we are able to target on LinkedIn on. But the journey is very different. So these are people surfing the web, websites like, for example, Hacker News. They have a ebook library there. This ebook library is powered by Netline. People discover, for example, something about IT security there. They fill out the registration form. You can fill in some GDPR compliance stuff into that flow. And then they see a confirmation page, download the results. You get passed on the lead information. We receive them via webhook. We push that into a CRM for further management. Keep in mind that those leads are not sales ready, right? We're talking about demand gen, not, sales ready leads to be shot in a barrel. So this here is, it still needs very much marketing automation, sales automation processes behind it. When you look at last year's talk, one of the key mistakes that software as a service companies make in gated content approaches is they talk about the product. Gated content should be about the pain point, and then you need to bridge into your product. Like, why is your product the solution to the pain that they're feeling? But what will not work here is you download your "this is my best software" white paper, and then people can download that. And then the third aspect is leveraging Google in new ways. Google has a new ad format. If you are really into Google, like us, you might remember discovery ads. They will be discontinued in November. And the new format that already started are demand gen ads. These are as close to native social ads in the Google ecosystem as you can get. So they run on YouTube Shorts, they run on YouTube feeds, they run on the discovery feed on your phone. So if you're using an Android, it's when you swipe to the right on the home screen, you see the discovery feed. And that's an awesome placement if that is targeted well, because people are in an exploration mode there. So you have to keep in mind that this is almost 100% mobile traffic here for demand gen ads. But it works, the targeting works extremely well, because this is a ad format that allows us to run lookalike audiences again. So statistical twins of your customers, people that are very similar to your customer base. And you can preview the creatives, you can reuse video assets, you can reuse video image assets. It allows you to basically run very low-key, easy, native feeling ads in a lot of different placements. We have very low CPCs, and in some cases this performs on the level of search for some of our clients. So here I put some benchmarks in. So you typically have a search similar click-through rate, much lower CPCs. So this is data from enterprise HR platform. Search we easily pay like $7 per click. Here we pay 50 cents. But we obviously also have a much lower click to sales qualified lead percentage. But because the click price is so much lower, and the sales qualified lead to opportunity rate in this case is surprisingly good for what is basically display traffic that is just very well targeted. This is an ad format that if you're running in the Google ecosystem, you should have a systematic test around. One of the things we discussed last year, which is super important, all of these new ad formats that you're running on, whether it's Google ecosystem or LinkedIn, they all share the logic that they're more machine learning driven, which means that you don't rely that much as in the past on manual campaign management. You must rely much more on feeding smart data signals into the algorithm. And this is something that has a lot to do with, okay, how do you pass back from your CRM? As for example, an opportunity moves along the stages, how do you pass back lead value data, deal opportunity value data back into the server-side tracking of a Google, of a LinkedIn, of a Meta platform? If you're not doing that, those experiments will typically fail because they burn out very quickly. So running them always comes with server-side CRM integrated tracking to make sure that you're steering the algorithm well through the data signals. And then you can leverage software discovery platforms for account-based marketing campaigns. That is something I think all of you, if you're SaaS entrepreneurs, will use Capterra, G2, OMR reviews to some extent. But most of the people that we start to work with don't do it systematically enough. So here's 3 simple levers that you can get more from your investment there. The first thing is people that come from these software discovery platforms, they are in the market and they are comparing tools. That's what you know about them. So the first thing that you don't push them to your homepage. Why would you? They already looked at you on the software discovery platform. You show them a specific page that maintains the context, like Crewmeister does here, right? So you don't show them Crewmeister is this and this. Platforms are great retargeting landing pages. So you don't need to retarget everybody back to your homepage. You can retarget them to your software discovery profile, where all of your customers say how great you are and why you are the best, because you're doing systematic review building there. And then you can leverage purchase intent data from directories. From a lot of directories, you can not only get the companies that look at your profile, you can also look at, get the data for the companies that look at the category that you're in. So if you're selling a CRM software, you can pay those software discovery platforms to give you information about who is looking for a CRM tool across the category, not just you. And then you feed that data from webhooks into your CRM. You automate that to then run account-based marketing campaigns, for example, on LinkedIn, because you know these companies are in the market now. There's at least one person that's comparing software on those platforms. I need to expand my visibility in those target accounts. That's why you do account expansion. you use a low-code automation platform like Make, feed that into LinkedIn ads, and have then always running super highly targeted account-based marketing campaigns targeting companies that are now in the market looking for software like the one that you are doing. Also, nice side effect, you can de-risk best of category claims, like this example here. My opinion is super risky. If you say something like beste hotel software, but you don't have proof, at least on the following page, it's a Wettbewerbsrechts nightmare, I would say. You can, of course, make such a substantiated claim much better if you do it a little bit like the Crewmeister example I showed you before, die Zeiterfassung vom OMR Reviews Testsieger. And last but not least, you need to understand how these platforms work. So a lot of those platforms are arbitrage models like Capterra. So they rank very quickly for categories, and then they send out the traffic quickly, and you bid on a CPC model. If that's the case, what you want to do is you want to bid very highly on new categories that you invent with the software discovery platform together. Because you can always think about, are you really a content management system or are you a digital experience platform? Nobody really knows what a digital experience platform is, but it sounds much more modern. So think about in the markets that you're in, can you invent new, more modern categories? And then can you be the leader in that category from a review perspective and broaden the footprint and leverage that in communication? So we have 40 seconds left to tie together marketing and sales channel data. What's happening there? We have one-click CRM and ads integration that's coming up now. So when we started to build our B2B marketing practice in 2013, one of the key things was to tie together revenue for marketing and sales. There is a lot of things happening there. LinkedIn just launched their revenue attribution report, which means that you have to unlock your Salesforce so that LinkedIn can do the attribution. So not sure if everybody wants to do this, but you can. So you should, if you're running on Salesforce, you can evaluate that. This is very interesting and will probably be expanded and better documented how the matching happens, etc. in the coming months. This is brand new. Second, a lot more CRM tools get multi-touch attribution. So HubSpot has this built in now on the enterprise plan, makes it easier. There are some specific B2B analytics tools by now. Dream Data is around for a few years now. They try to aggregate that a little bit. It's not cheap. It's like 7K to 20K per year, depending on the plan that you're on. New contender, which I personally like very much from the promise, is Hockey Stack. Y Combinator startup, still very early. It's a bit more expensive, 12 to 20K. It has a stronger lock-in effect because you need to implement their tracking. So I think time will tell if it succeeds, but it's a very holistic approach with a lot of good ideas. But you need to be in the middle that say, okay, I already am scaled enough that I can spend 12 to 20K on my marketing analytics, but I'm not scaled enough yet that I really care about avoiding lock-in effects and transportability of the data. So if you're in that, it might be a good choice. For custom analysis, this is example of like reports that we're building. Is Power BI data model is still the price value winner. You get enterprise-grade BI for €9.40 per month per user. It's still ridiculous. I know we just had the Salesforce talk with one platform that consists of a lot of bought-together tools like Tableau. So I think this is a good example why Tableau was sold to Salesforce because Power BI was getting so successful. And this is a great example how in one dashboard and reporting you can pull in data from CRM, web analytics, and BI. All right, that's it. That's what I wanted to show you. I'd love to stay in touch. Feel free also to approach me here. I'm still around for, let's say, the next 10 to 15 minutes. And I wish you an inspiring evening and hope you had a great knowledge conference. Do we still have time for questions? I'm not sure. Do we? There's no more speakers who can stay here until midnight, is what I'm hearing. So, are there any questions? I'm happy to take some. But I also don't want to keep you away from a beer. All right, I don't see any questions. Thank you for sticking around and enjoy the evening.